case you missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What a phenomenal month it's been so far. Still a few days to go, but the scores at the moment for the month of April, we're lower on the S&P by only 1.5%. Truly phenomenal, given all the volatility we've seen in between, down just 1.5% on the month so far. That can change a lot in the next few days, as you know, based on experience of the past few weeks. Equity futures down by 0.2 now on the S&P. On the Nasdaq 100, down by a similar amount. On the Russell, we're negative by 0.36. With 3 hours until the opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, Johnny. We're pretty calm on the individual stock levels. There's a few things moving around this morning. Boeing being one of them, higher by 1.7%. A few things happening with Boeing. For one, it got an upgrade from Bernstein this morning, saying its growth trajectory is moving along the right way. It also got one step closer to taking over Spirit Aerosystems, the embattled parts maker, which Boeing has wanted to buy. It offloaded some of its assets to Airbus, so that helped to clear the way. Moving to the downside this morning, again, not tons of drama, but it is notable that NVIDIA is weaker by more than 1%. There was a story over the weekend from the Journal saying that Huawei is getting closer to producing an AI processing chip that could rival some of NVIDIA's models, some of the models which China can't import because of U.S. trade restrictions. Still early stages, testing needs to be done. But again, is that U.S. tech exceptionalism going to be brought into further question? Finally, rounding things off with Tesla, still higher yet again after seeing its best week of the year after its earnings. Those shares up by 2%. We did hear over the weekend a report that they're starting to raise prices in Canada by as much as 22%. They're also embarking on this new campaign, basically saying, come and buy your Tesla now in Canada before we see reciprocal tariffs, before there are higher tariffs for Canadians. So we'll see if that tactic works. John.
We've seen a lot of front loading of purchases across several dimensions, several industries over the past few weeks, that's for sure. Danny, thank you. On our radar this morning, our top story, President Trump saying his sweeping tariffs will help him reduce income taxes for people making less than $200,000 a year. Trump previously arguing tariff revenue could replace income tax revenue.
So they've talked about this a lot, actually, but the issue you have is how are you going to have those revenue raisers enough to offset the taxes that generate to keep the government afloat, policy afloat, when you actually don't know what the revenue is going to be if you're in the middle of all these negotiations when it comes to trade. Very complicated, but it really starts to put the tax policies in focus in Washington, D.C., something this White House really wants to move forward to. You have the Secretary, Scott Bessent, going over to Congress this week, planning to meet again with all of the leaders in Congress, trying to get this forward. They want to get this done by Memorial Day. That is going to be incredibly challenging. Maybe we'll get some more information today when the president sits down with Speaker Johnson.
We've said it already a few times this morning. This is a very aggressive timeline. They've got to deal with trade. You mentioned the Treasury Secretary, Scott Bessent, also saying that trade discussions with Asian countries are, quote, moving along very well. Bessent adding that talks are ongoing with 18 important trade partners, with China part of special negotiations. Lisa, we walk away from Washington unclear on whether those talks actually took place or not.
There was a lot of discussion with the president saying that they had had a discussion. You had Scott Bessent saying he had no idea whether Xi Jinping and President Trump had an actual phone call. And then the Chinese coming out and saying, we are not in talks with them in whatsoever, in whatever kind of case. Here's the issue. The length of time it takes to get any trade deal done, even if two people are willing to come to the table, is really long. That is what everybody told us in Washington, D.C. So even though the rhetoric from finance ministers around the world was, we're working with them, we're optimistic we can get something done within that 90-day timeline, people who have ever worked in trade have told us again and again, this is not feasible. This is absolutely not realistic.
So what's China doing? China is saying there are no talks, and they're also doing this. Policymakers in Beijing vowing to provide more support for exporters impacted by tariffs, including plans to boost domestic consumption, which once again is something that this administration would quite like.
They do, because they want to see China rebalance and put more pressure on domestic consumers. They're doing things like assisting firms also to diversify markets. Potentially, we could see China starting to dump in different places if the U.S. consumer is not going to be the one to take on that final product. Reducing costs for domestic trade, rent, streaming fees, optimizing the exchange rate hedging tool for trade firms. They are trying to combat it internally before they potentially really go to the negotiating table. One thing I will say, Treasury Secretary over the weekend, though, did say he had communications, contact at the IMF meetings with his Chinese counterparts, but he didn't say they were about trade. He said it was about the traditional financial stability of the global economy.
How many times have we seen this now, both in Europe and China? President Trump pushing these countries, these trading blocs, to do things that are good for them.
Well, it's a great point, because a lot of people have been saying for a long time that the only way for China to get a sustainable economy is to bolster domestic consumption, and that's been a problem. Here's the key question. Is the gap going to be filled by consumer spending quickly enough to offset some of the tariff barriers at a time where China, given that it's a more autocratic government, can sort of bear through this mess, and it's a gift to them. This is what I heard from the IMF, that the Chinese are so pleased that they can blame all of their financial problems over the past 5-10 years on Donald Trump, and that's basically what's sweeping social media, and it's actually helping Xi Jinping quite a bit.
The nation's capital is going to be exceptionally busy over the next couple of months, that's for sure. If you are just joining us, welcome to the program. Equity futures here just a touch softer. We're negative by 0.2%. Investors, as you know, are waiting signs of progress in U.S. trade talks. The former senior Trump trade advisor, Kellyanne Shaw, writing, I do not expect to see a full-blown U.S.-China trade deal this year. Kellyanne joins us now for more. Kellyanne, welcome to the program. What can be achieved in the interim between now and year-end?
Good morning. Thanks for having me. Well, we're certainly in a he said, she said when it comes to U.S.-China relations, and I'll put that to the side just for a moment. I think in the short term, the administration is looking to ink potentially up to 17 deals. Now, those won't be full-blown trade deals, but they will be agreements in principle, and we'll get the details of those written by lawyers in the months to come. But that is part of the negotiation strategy with China, and that is to lay the groundwork where the U.S. has deals with a number of key trading partners going into a broader discussion with China so that they have more of a leg up. China's taking a very similar strategy in its charm offensive with a number of countries around the world. But this U.S.-China relationship is going to get worked out over years and not months.
Kellyanne, how do the Europeans fit in?
Well, a U.S.-Europe deal has eluded multiple administrations for decades now. I do think that there is a genuine effort between the administration and some European leaders to see what they can do in terms of stopping the bleeding with respect to these 20% reciprocal tariffs. But the European Union is a very advanced and entrenched regulatory system, and it's going to be very, very hard for them to pivot and to change and to concede on some of the requests that the Trump administration has. So I'm not particularly optimistic.
Kellyanne, what are those requests that the Trump administration is telling the Europeans they have to see in order to get a trade agreement?
Well, they haven't made those demands public, except for this national trade estimate, which President Trump and Jamieson Greer have held up on multiple occasions and said, here are the list of non-tariff barriers. But they are longstanding and well-known, so they are talking about the VAT tax, but some of the regulatory barriers in agriculture, in automotive, some of the EU subsidy programs, the digital services taxes that a number of EU countries maintain. There are quite a few barriers to trade that are going to make it very, very challenging, and tariffs really are just the tip of the iceberg.
When it comes to China, what needs to happen for one of them, either Beijing or Washington, to blink? Because right now, it's just a tremendous amount of noise.
Yeah, certainly. And drama is certainly a feature of U.S.-China trade negotiations. It was during Trump 1. I fully expect it to remain a part of Trump 2.0. I do think that behind the scenes, both sides are looking for a political off-ramp that saves face. These 125% and 145% tariffs are not sustainable in the short or medium or long term. So I do expect to see some sort of de-escalation in the coming weeks or potentially months. But in terms of a full-blown trade deal, I don't know that that's possible anytime soon, if at all. Now, I do think both sides will at some point sit down and try to work out some of their shared differences. But at the end of 4 years, I think the U.S. and China are going to do less trade with one another and not more.
But you're talking about an off-ramp potentially we could see before they sit down. When do you think that off-ramp would be?
Well, I was hopeful that the two sides could have found something in the first couple of weeks. But you've got, on the one hand, President Trump saying that I only want to do this at the leader level. On the other hand, you have President Xi who's saying, I'm not going to do this at the leader level, appoint someone else. And so both sides are engaged in this game of chicken, arguing that the other side has more to lose than they do. Now, back in Trump 1.0, we had the G20 and these other international forums that were happening around the same time as the trade war, which gave the two leaders a political opportunity to meet on the sidelines. We don't have that in the short term. So it is either going to be President Trump saying, okay, I'll appoint someone, or some back channeling, potentially some track 1.5 or track 2 diplomacy between CEOs going back and forth to try to work things out.
Kellyanne, you pointed out that we're about 2.5 months into President Trump's 3-month window to make trade deals with virtually every nation in the entire world. And it points to how infeasible this is. How much is this just a period of time to reset the narrative before having another extension and then another extension before there is a realistic time frame for how long it takes trade deals to be inked?
Yeah, and this is where there's a distinction between these full-blown trade deals versus these agreements in principle. And I do think that it is possible to reach agreements in principle, which is basically an outline of some of the key components of what will be in those deals in a short period of time. But if you want to have drafted text that captures these trade deals, that's going to take months and months and months of time and a ton of work by various lawyers. Now, that said, if you're still dealing with 17 or 18 countries, that's still a lot to do between now and July 9th. So I do think for countries where substantial progress has been made, the president is likely to extend that period of time, although he has not said that he will do that. And then for countries that are maybe not as far along, the president's going to feel some pressure to turn those tariffs back on so that his threat means something and to try to squeeze some countries at the end of that 90-day period. So I think we'll see a mix.
On April 2nd, there was a big question around what the ultimate goal was of this new tariff regime. Was it revenue raising? Was it penalizing national security issues or potential trade partners that hadn't been doing the right thing? Or was it fairness? Now that we've seen some of these negotiations, do we have a better sense of the overarching framework of what the goal really is?
Yeah, and I think that different tariffs have different goals. So clearly one of the North Stars of the administration is addressing this substantial $1.2 trillion trade deficit. And that, to me, is what this 10% global baseline tariff is about. But when it comes to these more advanced reciprocal tariffs, like that 46% on Vietnam, that 20% on the EU, that is about fairness and leveling the playing field and addressing some of the unfair trade practices, the unbalanced trade that the president has been talking about. National security tariffs are really those sectoral tariffs, so those on semiconductors, pharma, steel, aluminum, and autos. And then this revenue point, which the president raises, to me is more about messaging. It's about selling that domestically to the American people about why leaving tariffs in place, particularly why negotiations are ongoing, may not be the worst thing in the world because look at the tariff revenue that's coming in. But I don't see that as one of the primary goals.
Over the weekend, the Treasury Secretary was asked about this whole strategy, putting tariffs on, pulling them back. And the Treasury Secretary said, actually, it's called strategic uncertainty in game theory. You were an individual at the negotiating table. Do you think this strategic uncertainty is damaging or actually useful?
Well, I think it depends on where you're sitting. And as a negotiator, I used to say that, and I spent 10 years as a negotiator for the U.S. government, that I had the most fun working for President Trump because my trading partner sitting on the other side really had no idea what my leader was going to do, which actually gave me a fair amount of leverage at the table to try to advance U.S. interests. Now, sitting on the other side now representing companies, that uncertainty, that lack of clarity, that will we have tariffs tomorrow, won't we, is incredibly challenging in terms of making investment decisions and supply chain decisions. But that strategic ambiguity is really aimed at other trading partners, and the message is not for the business community. And so I think that tension makes it a bit challenging, particularly for domestic stakeholders, while the president works this out.
Kelly, appreciate your time as always. Kellyanne Shaw, the former senior Trump trade advisor, framing things perfectly at the end there. What can be good for talks, in the short term at least, can be bad for the economy.
Exactly, and that's why we saw executives from Walmart have to go into the Oval Office. That strategic uncertainty is making their job incredibly challenging. But if you're a negotiator, that leverage could be very useful.
Equities right now negative 0.25% on the S&P 500, with an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hecker. Say, Yahara.
Hi, John. President Trump is pushing back against the idea that market turmoil could lead to changes in his tariff policy. In an interview with The Atlantic, Trump said Wall Street's reaction to the trade war impacts him, quote, a little bit, but said that there's no red line or certain number that would compel him to change course. Meanwhile, tensions are escalating between the U.S. and China over the Panama Canal. China's market regulator is reviewing C.K. Hutchinson's sale of dozens of ports, including 2 in Panama, to a BlackRock-led group. China says the $22 billion deal shouldn't be implemented without its approval. And China's Huawei is reportedly preparing to test a new AI processor that it hopes can replace some products made by NVIDIA. The Wall Street Journal reporting that Huawei has approached some Chinese tech companies about testing the new chip. The report says development is still at an early stage, with firms slated to receive the first batch of samples next month. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on in the next hour. Up next on this program, a whole new world.
Our view is that global growth this year and next year are both going to be much weaker. The U.S. has been the center of the system for decades, and now the U.S. is standing up and rejecting in very fundamental ways key features of the system.
Lots of economic data coming up through the week. We'll get to that with Christian Keller of Barclays from New York City. This is Bloomberg.
In case you missed it on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up. If you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that.
No, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime. anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Mega Cap Tech in focus this week. Check this out. This is your calendar for big tech. Meta and Microsoft on Wednesday. On Thursday, Amazon and Apple. The scores going into that. On the month so far, only down by 1.5% on the S&P 500 through April. But for big tech, some of these names have been in a bear market for quite a while. On the Nasdaq 100, we're down by 0.2%. On the S&P, just softer on the session by 0.25%. Under surveillance this morning, a whole new world.
Our view is that global growth this year and next year are both going to be much weaker. The U.S. has been the center of the system for decades, and now the U.S. is standing up and rejecting in very fundamental ways key features of this system. And I think the rest of the world is just kind of looking around and saying, what's next? This is a completely different world.
It's a shock to the cycle, potentially a shock to the system. Here's the latest. According to one estimate, cargo shipments from China to the US falling as much as 60% since early April. Kristen Keller of Barclays writing the focus is now on negotiations and potential central bank action. We still see mild recessions in the US and Europe as a reasonable base case going forward. Kristen joins us now for more. Kristen, good morning. Good to see you. Help us understand the way you see the sequencing of this playing out. A lot of people are tracking the ports, looking at the shipments coming from China to the US and watching that nosedive. What happens next in your mind?
Well, there's a lot going on right now. I mean, the shippings are coming down, the inventory is being built, there's been a lot of front running, so it's very difficult to sequence this. Someone in Washington told me there's no longer uncertainty, it's not what we don't know, but unpredictability of how things behave, how things react. This is nothing we can look at for the last 40 years and say, well, this is a sequence. But it would seem to us that, you're going into the second half, and then things should be visible. I mean, probably the price increases come first, starting already April, May, and then the activity, the slowdown will come a bit later. Like labor market data we're going to get this week. It's probably going to still look quite robust, but we expect that then to come off in the second half with a few months lag.
We've seen lots of comparisons to the pandemic, negative supply shock. Biggest difference is we shoved a demand-side stimulus package like we've never seen before into a negative supply shock. How different is this moment on the demand side?
On the demand side, this time, obviously, we have, if anything, the fiscal, we don't know yet what will happen, but the fiscal should be actually rather, the demand from the fiscal should be coming down, right? So we don't have the kind of positive demand stimulus, if you want. And at the same time, we have a supply shock that's a bit different from the pandemic. Yes, it's a negative supply shock, but it's, with the pandemic, it was you shut down, but you hope that somehow it opens. This time, it's a systemic shift. And I think this is the big issue here for corporates. Even if within the 90 days we get some letter of intent or some idea of principal agreements where it wants to move, this still doesn't mean as a corporate you know where things will be and how much you should really rearrange your supply chains globally. And I think that uncertainty stay with us, and that will probably continue to weigh on growth.
What's interesting to me, we were speaking with Lori Calvasino of RBC earlier this morning, and she said, yeah, tariffs look like they're going to be higher than we expected, but companies can still deal with that. If you look at the bottoms-up type of analysis, it looks like companies are in an okay position. What are you seeing that's different, that points to recessionary conditions that really does undermine some of the rosier scenarios that are getting priced in?
Well, I would say one thing. You say, tariffs are higher, but companies can deal with this. I think the consensus in a way that seemed to shape up in D.C. last week was we end up something with 10% universal tariff from anyone, and then maybe 50 to 60 on China, and then sectoral tariffs of 20-25%. That is still like tenfold or so from what we had for the last 50, 60 years. So, to say that this has been dialed back now from the extreme, but what we end up, if we end up with what seems to be the consensus now, is still very high tariffs. And I think that would, and that is desired, right? I think the U.S. administration does want, to decoupling from China and to move supply chains out. So I think, I would not underestimate those tariffs.
Well, that baseline is what the president spoke about consistently on the campaign trail. If we were to see that, how do you view the economy shaping up? Those baseline tariffs, is that potentially meaning a recession, or can we muddle through?
We have a recession. We think the second half, it is very likely because, let's step back. We already thought the U.S. economy would be slowing. Most people thought it would be slowing this year, right? And now you have on top of this, this incredible uncertainty, which, probably holds back investment. And at the same time, we think going to affect the consumer as well. Then you can see it in the surveys. There's a lot of, questions by consumers where this will go. I think, lower energy prices help at the moment. We have a mild recession. I think this is a good chance. Balance sheets are quite healthy. There shouldn't be like the kind of deeper financial recessions that you've seen before. But we think a recession is quite likely.
Unemployment at 4.2%. The Federal Reserve has showed little desire preemptively easing into this shock. What would it take? 4.5, something closer to 5? How do you think about that?
That's a good question. Where is that NIRU? Where's that rate where they get nervous? Often, though, it's not necessarily just the level. I think, yes, going over 4.5, I think, would make them nervous. But it's also, once you hit the first negative non-farm payroll prints, I think that always has an impact. But otherwise, I think the big difference to what we had during the pandemic in the last really decade or so is that this time we have inflation expectations really having risen substantially. And the market isn't there yet. It's mostly in household surveys, but that is something I think that's very crucial. If you're on a central bank that has inflation target, that's something you can't ignore.
How do you reconcile the difference between what you're seeing in survey-based expectations and market-based expectations at the moment?
Yeah, it's a very good one. First of all, the market expectations in the short run also see the inflation increase. What's very interesting is that break-evens over 10 years don't see it. And that means that, there's still a belief that over the 10-year time span, there'll be recession and the Fed will, do the right thing and we'll end up with a broadly 2% average. That's very interesting. And that anchor of break-evens remaining there, I think is quite important. If they move, that will be very alarming for the Fed.
The Fed doesn't have to use the T word. The market's doing it for them. Is that your takeaway?
Yeah, although they kind of are using the T word as well, so there is that as well. Going forward, I just wonder how much the Fed has that luxury, even as the ECB continues to cut. And I think that that's really interesting. It's a growth differential that is not favorable to the U.S., but it's also an inflation differential that is not favorable to the U.S., which puts the Fed really in a bind.
Christian, it's good to see you, sir. Thanks for dropping by. Christian Keller there of Barclays. An important conversation about the economic data still to come this week. The overwhelming consensus is it's too early to expect to see this in the labour market. We'll check to see if we see it in the labour market when we get payrolls on Friday. The estimate in our survey at the moment is about 130K. Up next on the programme, Abby Yoder of JP Morgan, Henrietta Trays of Vader Partners, Mark McCormick of TD on a big election taking place in Canada, and Amanda Lynham of BlackRock on this fixed income, this debt market. From New York City, the second hour of Bloomberg Surveillance. Up next.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes out in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
People are equally as nervous of American tariffs as they are of Chinese excess capacity.
Ultimately, Xi Jinping's got to make some serious decisions about how they rebalance that economy.
I don't think China tariffs are going to be resolved in the next year.
The U.S. is trying in many instances to force countries into choosing. These countries are desperate to avoid being forced to choose.
But you'd like to see a couple of deals done, right, to show that he's willing to come to the table and make a deal.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this in the equity market. Equity futures negative by 1/3 on the S&P, following a 4-day winning streak. Over those 4 days on the S&P 500, higher by more than 7%. That rally taking the scores to April to just negative 1.5% for the month, which is unbelievable. Think about all the volatility, the pain, the stress, the some days you were working, and we're down just 1.5% for the month of April. In the bond market, some comfort. Yields down for a couple of weeks now. In the bond market this morning, yields up by just 3 or 4 basis points. The 10-year 427.39. This week, and the price action of this week will be dictated by this screen right here. The economic data through the week, including payrolls on Friday, and Lisa, absolutely stacked with earnings from some of the biggest companies on the planet.
Yeah, we've got Microsoft, we have Meta, we have Apple, we have Amazon, we also have GM, we have Mercedes, we also have a whole host of different consumer-facing companies, whether it's Starbucks, whether it's McDonald's. 40% of the S&P 500 market capitalization will be reporting this week. Will that be enough to give us some sense that we are not in a dark room, blindfolded, bumping into walls with chairs in between us? Or is this going to simply be, okay, well, we have no visibility and they have no visibility, so we'll wait for the next shoe to drop?
They certainly don't have any visibility at all. The fate of this market, the fate of this economy at the moment, in the hands of one man, the President of the United States.
And it's called strategic uncertainty in game theory, according to Scott Bessent. He was pushed on what actually is the strategy. So you have to think the market only down for the month, some 1%. What are they really rallying on? A phantom, as you've called it before, Jonathan, phone call? President Trump keeps talking about that Xi Jinping has called him. The Treasury Secretary says basically don't want to touch that, not really sure if that's accurate. And then you had Marco Rubio saying, I'm not going to comment on that. what actually is the framework for any potential deal between China and the U.S.? And that is the most important deal. Forget these 18. I know they think they're important, but that's the most important deal because it's two biggest economies.
How credible is the rally? We've asked this a few times. If we don't know how credible the talks are, it's a big question for this week. Big question for us trying to follow the economy. The sequencing of things. We're looking at the obvious places. Clearly, trade between China and the United States is nosediving. You can see that almost everywhere. What happens next? Prices climb, demand falls off. The sequencing of this is going to be interesting in the weeks and months to come.
We had a lot of Fed speak last week. This week is a quiet period, so if we don't get any Fed speak, that's why. And a lot of them seems to suggest that sequencing would lead to maybe a short-term price bump, and you would get some inflation, but longer term that it would be a disinflationary type of trend. Max Kettner of HSBC put out a note this morning, which the headline was, "Why Washing Machines Matter." And he talked about how the washing machine experience of 2018 gave a sense of how much demand declined in the face of some tariffs and how people rearranged some of their spending patterns, and why that is making him prefer Europe to the U.S., both in fixed income and also when it comes to equities.
Equity futures right now, negative 1/3% on the S&P 500. No real drama. This is a snooze compared to what we've seen over the past few weeks, that's for sure. Coming up this hour, we'll catch up with Abby Yoder of JP Morgan as investors prepare for a busy week of earnings. Mark McCormick of TD Securities on the fallout from Canada's election, and Amanda Lynham of BlackRock on a temporary reprieve for bonds. We begin this hour with stocks marginally lower, following 4 days of very big gains. Abby Yoder of JP Morgan writing, "We view the upcoming earnings season as important for the market as we work through downward revisions. We have widened our base case range to 5,700 to 6,200 to reflect increased volatility and uncertainty." Abby joins us now for more. Good morning, Abby.
Good morning.
There's plenty of uncertainty, let's put it that way, and companies are using different approaches to offer clarity and visibility to investors. Southwest was upfront, brutal, direct. We're in recession. What are you hearing elsewhere?
Well, so I actually think you all were talking about last week and how strong the performance was, and obviously there was a lot going on from a macro perspective in the discussions around trade. But actually we were getting pretty good earnings results, and particularly as it relates to the AI power demand side, I would say that was like an area of particular strength. And I think in terms of the way that companies are approaching their guidance, look, this is obviously a very difficult environment for them, but we thought it was going to be a lot like 2020, where they kind of just like, no guidance, we don't know what's going to happen, so we're just going to pull this. And that's not really what's happening. Like, you're getting them trying to work through these different scenarios. Like, sometimes you're getting two different scenarios, maybe you're getting a muddle through. And it's been really interesting to hear which companies, and in our view, become more de-risked. If let's say they extrapolate April 2nd tariff rates throughout the year, like that to us is an attractive entry point for whatever company that may be. But like, you're not really getting these massive guide downs in terms of the full year outlook. And to us, that's, a lot of that is really driven by the AI power demand story that happened last week, but overall it's just been better than expected in terms of earnings.
Some of the earnings themselves have been pretty decent, to your point, but I'm finding it difficult to draw a distinction between good underlying demand and just a rebuild of inventories worried about supply not being there.
Yeah, I mean, I think that's a really difficult line to thread in terms of what really is real demand, but I think for the most part, right, if we're thinking about the banks who reported earlier on, overall, the overall spend outlook, you didn't see a massive bump in terms of, it was mid-single digit spend in terms of a consumer outlook. That's pretty in line with what we've seen over the past couple of months. And importantly, looking forward, you didn't see really massive reserve builds in terms of the banks either. So their outlook doesn't feel like it's that uncertain as it relates to the consumer at the moment.
I'm feeling a massive disconnect right now. We just spoke with Christian Keller of Barclays talking about how recession in the U.S. is his base case. We were talking with Laura Calvasina of RBC, who said if recession actually does transpire in the U.S., you're talking about 4,200 to 4,500 for the baseline S&P 500. You're talking about gains from here. 5,700 is your low in terms of this range at a time where we're currently at 5,525. Why is there such a disconnect between economists and stock analysts?
Well, because look, I think, and taking a step back and thinking about where we came into the year, we're coming off of a really strong base. I think comparing this to the 2018 period is a little bit difficult because it was a completely different economic backdrop, right? We're coming into the year and we're in a pretty solid footing from both a consumer and a corporate standpoint. And so you do, there is a position of strength that we're coming from that we can take somewhat of a hit. Obviously, time is ticking in terms of how long this uncertainty persists. And, the president heard this from some companies last week when he he met with them, saying like, look, this is a matter of weeks in terms of empty shelves, and that is very important, right? Like the longer this goes on, the more uncertain the uncertainty pervades, the less likely, you know, the upside becomes a reality.
How many companies are actually gaming out that anything even close to the tariffs as announced on Liberation Day are going to stick? In other words, how many of the analysts, how much of the ranges and the outlooks that companies are coming up with are basically expecting to go back to something like that 10% baseline, as well as some sectoral tariffs?
Well, so I would say the amount of companies that are going back to April 2nd is like kind of few and far between. And again, those are like kind of gems to us in terms of the opportunity set. But what you are getting is you're getting some idea of like what it's going to cost from a tariff perspective from companies. And this is across the board. Like pharma companies, we've heard from a lot of healthcare companies, and like we haven't even had those sectoral tariffs announced. And they're trying to like figure out how much they're going to have to spend. And so we're assuming it's based on the current environment, right? Without having to really extrapolate. And so there is like a cost structure around it, and there's obviously a revenue headwind that they're trying to take into account. So wrapping their heads around how they're getting there is like important for us to help us think through the year ahead. But I wouldn't say there was like a ton of companies that took April 2nd and extrapolated, but they're at least incorporating, I think, that 10% universal.
When you think of the potential upside to your figures, what would it take? Is it policy? Is it the Fed?
Yeah, it's policy. I mean, I think the Fed, you know, if you, for like a couple weeks ago and you got asked like what would be the bull, like what would cause the bull case, I think it would have included the Fed and it would have included some policy pivot from the administration. I think a Fed pivot at this point wouldn't necessarily be short-term positive, right? Because it would be because the Fed saw weakness. So I think really the only like bullish outcome is that you see this pivot from the administration, and the market obviously seems to be sniffing that out in terms of what we're seeing from a PE perspective. We're at like close to 20 times again. And again, only down 2% since Liberation Day. So there is an element of that, but I do think that that's where the bull case is now.
They're talking a lot about these 18 deals they can get with other trading partners, but when you're talking about a bullish case, you're really talking about one, right? It's China. What do you need to see?
Well, I mean, I think in terms of what the market's probably thinking, it's closer to like 30 to 50% in terms of the effective tariff rate there. I think that would bring down the overall tariff rate, like effective tariff rate for the U.S., something between 10 to 15%, which is like digestible and something that, like if we're thinking about, again, going back into expectations for the beginning of the year, that's probably where it would have been, right? Like 10 to 15, maybe worst case scenario, still a massive increase in terms of where we were prior, but I think at least more digestible than the 25 to 30% that we had on Liberation Day.
This week is going to be chock full of things other than tariff talk, which is going to be exciting for people looking to sink their teeth into something that's more concrete with numbers and that reflect things that have already happened. I wonder how you look at some of the economic data that we're going to be getting. A labor market report that a lot of people preemptively are dismissing as backward-looking and not really important. JOLTS data, ISM manufacturing. How much does it matter to you based on what you just said, which is we are coming from a very different place economically than we were in 2018?
Well, I think it's important, but I think it's also juxtaposed to what's happening in terms, like we're going to be focused mostly on earnings. Like you said, we have 40% of market cap reporting and some of the biggest names. And I think that's going to be like what has been the story for the S&P 500 over the past couple of years is this AI story, which nobody seems to be talking about anymore. So you're getting these like very, you know, high growth, high quality companies at a discount at the moment, obviously aside from what we saw last week, but still trading at a discount. And so that's really where our focus is, right? Because it's part of our bullish thesis is that you continue to see that spend, and that's pervasive through the rest of the market in terms of AI CapEx. So we're going to get a lot of information there. And I think that's what we're going to be focused on from an equity market standpoint this week, is aside from macro.
The thing that conflicts with that, as you know, is that they are secular growers, but they're also facing an international backdrop, which is increasingly fragmented. I'm thinking more like Apple, directly Apple. I'm just going to bring up the name directly. They're facing a big situation in China. They're going to have to spend a lot of money moving supply out of China into places like India. For those kind of companies, how difficult is this moment for them?
Well, look, I think this isn't the first time they've seen this. These tensions have been going on in terms of trade as it relates to particular industries like semiconductors since 2018. It was continued throughout, you know, the past couple of years under the Biden administration as well. So this isn't new news, and obviously a lot of that rerouting had already taken place post 2018. So look, it's not easy. It's still difficult. difficult, but they have, you know, their global supply chains, they at least have negotiating power as it relates to, you know, other countries and suppliers. So they at least are coming from a position of strength in that standpoint when I'm talking about these large diversified companies. And so I think it's not easy, but if anyone's going to be able to navigate it, I would think it would be these larger companies.
That one's a must-watch. Apple reporting on Thursday. Abby, good to see you. As always, thanks for being here. Abby Yoder there of JP Morgan. If you are just joining us, welcome. Equity futures down by a little more than 0.25%. Not a big move on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hecker. Say, Yahara.
Hi, John. Cargo shipments from China to the U.S. have plummeted by as much as 60% since the U.S. raised tariffs on Chinese goods to 145% earlier this month. Still, by mid-May, thousands of companies will need to replenish inventories. Both Walmart and Target told Trump last week that shoppers are likely to see empty shelves and higher prices. Elon Musk's XAI Holdings is in discussions to raise $20 billion. Sources telling Bloomberg the deal would value the company at over $120 billion and could be used to pay down debt from Musk's conversion of Twitter into a private company. If completed, the deal would be the second largest startup funding round of all time, according to PitchBook. And DoorDash is offering to buy UK-based Deliveroo for $3.6 billion. A filing with the London Stock Exchange shows DoorDash proposing a cash offer for Deliveroo shares at $2.40 apiece. DoorDash owns 2/3 of the restaurant delivery market here in the U.S., and a deal would help it expand into the UK and cities in Europe. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, easing the tariff sting.
We're going to cut taxes for the people of this country. It'll take a little while before we do that. I think the tariffs will be enough to cut all of the income tax.
Up next on the program, Henrietta Trays of Vader Partners. Just how aggressive is this timeline for tax cuts in Washington? From New York City this morning, good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Just to get you up to speed on a developing story at the moment, Spain, Portugal hit by a major blackout, a power cut to phone lines at around midday today. In those 2 countries, we are seeing public transport, traffic lights, phone services mostly down across Madrid, Barcelona and Lisbon due to that outage. Train services mostly halted. The latest from the team here at Bloomberg at the moment, no reason for that at the moment. Just an update for you that we are seeing a power cut, power blackouts across Portugal and Spain. We'll have more on that when we have more for you. The latest elsewhere, the price action looks like this. Equity futures on the S&P negative by 0.3%. On the Nasdaq 100, down by 0.3 also. On the Russell 2000, we're negative by 0.4%. Under surveillance this morning, easing the tariff sting.
We're going to be taking in a tremendous amount of money. We're going to be taking in a lot of jobs, a lot of plants and factories. They're already coming. I mean, you see it. And we're going to make a lot of money, and we're going to cut taxes for the people of this country. It'll take a little while before we do that, but we're going to be cutting taxes. And it's possible we'll do a complete tax cut, because I think the tariffs will be enough to cut all of the income tax.
So here's the latest this morning. President Trump saying tariffs will allow him to cut taxes for people making less than $200,000 a year. Bloomberg's Tyler Kendall joins us now for more. Tyler, pretty aggressive stuff from the president. We talked about it in the last hour. Talk to us about how aggressive the timeline is for this tax plan.
Yeah, hey, John. Well, the stakes are clearly rising amid a flurry of polling over the weekend that shows that Americans are growing increasingly concerned with President Trump's economic plans. But those economic plans have always been staked on a twin agenda of tariffs followed by tax cuts. But amid fallout with the former, it's clear that this White House would like to see the latter get done as soon as possible, even as President Trump dismisses the polling himself. Now, some in President Trump's orbit have floated that they could see this done as soon as Memorial Day. That includes House Speaker Mike Johnson, but that is considered to be a very ambitious timeline. We could get firmer guidance on exactly where lawmakers are aiming when the Treasury Department updates its X date. We are expecting that potentially in the next week or so as they update that number as more tax receipts do come in. So that could potentially spur some fire here to try to get lawmakers to move more quickly when it comes to President Trump's tax cut agenda. But there is still just so much for these lawmakers to decide on. We're talking about tax cuts, of course. Congress is back in session today, where they are going to start working on crafting that reconciliation plan. Right now, they're working off of the Senate budget blueprint that allocates about $5.3 trillion in net tax cuts. It's likely enough to make permanent the 2017 tax cut plan and could include some other priorities. But there is just so much on the table, including no taxes on tips, overtime pay, and Social Security. And we also have to keep in mind, John, they are also talking about those spending cuts. And that's also going to be incredibly difficult amid concerns that there needs to be, one, more pay-fors for the tax cuts, and what that could, two, mean for potential cuts to Medicaid. Keep in mind, Republicans are doing this through the reconciliation process, which means they really have no room for error here because they are not going to court Democratic votes to get this done.
Tyler, who holds the leverage when it comes to the different groups that Speaker Johnson has to cajole? The deficit hardliners, the individuals from New York and California that care about SALT, those that care about protecting all parts of Medicaid. Who has leverage?
At this point, it really does appear that they all are making their voices known, though we should say that since they have agreed on the Senate budget blueprint, it does appear that those fiscal hawks, those conservative fiscal deficit hawks, did actually acquiesce in some sense here, because they had wanted in writing that there would be steeper spending cuts in order to get them on board with crafting the reconciliation bill. Ultimately, that didn't happen. Instead, they just got House Speaker Mike Johnson's word that there will be more spending cuts. President Trump himself has said that there would be more, in the ballpark of potentially $1.5 trillion. So we're going to have to see how this evolves, but it's clear that all the players really do want to have their voice made as they go to the table with this White House. Now, House Speaker Mike Johnson is expected to help kick off those negotiations today. He is expected to be in the Oval Office around 2 p.m. Eastern. As of now, it's closed press, but we'll be watching it closely because I'm sure they'll want to share an update if there is any movement on this.
Tyler, thank you. Tyler Kendall in the nation's capital down in Washington, D.C. To extend the conversation, Henrietta Trace of Vader Partners joins us now for more. Henrietta, just what is achievable with this tax bill and this timeline that could roll through the next several months or so?
Yeah, my base case expectation is that we'll get this tax bill passed in late July. We're really waiting on Treasury Secretary Bessent's announcement about the X date for the debt ceiling. That can be a significant point of leverage for Speaker Johnson to twist arms and get what will be a very, very difficult and politically painful bill through the House and then potentially the Senate as well. It's unrealistic to anticipate that this bill will pass by Memorial Day. I know investors have been saying, hey, I've heard speculation that this could all come together really quickly. You know, those were topics of conversation that I was having with them a couple weeks back. That's obviously false. There's no path to that. we're going to need several more months at least to get this bill to the president's desk. My base case is July 24th. And then, secondarily, I really appreciate the president saying that he needs to do quite a bit more in this tax bill to make it a tax cut. Because as Tyler just pointed out, this is mostly an extension of the same rates that have been in place for the last 8 years. So they need quite a bit more here to be either stimulative or timely.
Henrietta, the sense I got from the Treasury Secretary is that the ex-state is going to determine almost the timeline because they're going to make sure that they can raise the debt ceiling in reconciliation. Do you still see it playing out that way on Capitol Hill?
I really hope it does because this is really a tricky bill. If you're going to try to cut $600 billion or so from Medicaid, $230 billion from SNAP, another $330 from the education programs, there's a lot of senators, I can list 9 right now, who won't vote for that. So what you really are going to need is some sort of existential crisis to get members to vote for this package. And the great existential crisis we have right now is the potential for a debt ceiling default. And so the hope for Treasury Secretary Bessent, as well as Senator Thune and Speaker Johnson, is that they will have that sort of Damocles hanging over members and get them to come to the table on things like the fact that the SALT cap will not be as high as Mike Lawler and other New York Republicans would like to see it. The IRA is not going to be fully repealed, for example. They don't have enough room to do no taxes on Social Security, which is $1.8 trillion. So it's really helpful from a leadership perspective to have that tool to go into negotiations with and force members to the table at the end of the line.
Basically, they need a cliff for President Trump to pull them back from. When it comes to the things like deficit hawks, there's individuals like Mike Lawler who's pushing for a higher SALT cap. When it comes to those different groups, who do you think blinks first?
Well, I also agree with Tyler on this one. It has to be the senators who win the day. The House conservatives, the Chip Roys of the world, are going to have to either vote against this bill or acquiesce to the Senate's demands. What's underappreciated right now is that Senator Thune has a 2-seat majority to operate with in the United States Senate because I suspect that Rand Paul will not vote for this bill in the event that it includes the debt ceiling hike of $5 trillion, which is what's in the Senate budget. And on the House side, Speaker Johnson has anywhere between 4 and 7 votes to lose. So what that means is that unlike the beginning of this year, right now, the senators have all the control. They have the slimmer majorities. They have the margins that the House will need to tolerate. And of course, their budget is starkly different. I am biased as a former Senate staffer to think that the senators will win, but that's because they always do. So that's my base case.
Henrietta, over the weekend, we saw a slew of polls that showed a real deterioration in public support for tariffs and for some of the plans that President Trump has put out there. Does that matter at all to Congress members and their willingness to vote for this tax plan?
Yeah, it's a fascinating question, Lisa. I'm trying to track the data for everybody on our side as well because the polling has been so precipitously dropped off. You've seen a net 6-point swing just since November away from the Republican Party. And that's not just for the president. That's for all of generic Republicans, which, of course, is what we're going to go into this midterm working with. So David Wasserman at the Political Report, that is an excellent at House prognosticating, puts 39 House Republican seats at risk due to the current polling data and the special elections in Florida's 1st and 6th districts. So this is a very serious problem. What we need to think about is the end of primary season, where Republicans have to run as close to President Trump as humanly possible, and then getting into the general, which starts in a couple months. And at that point, they need to distance themselves from the president in order to get through a general election cycle that has Democrats, independents, and Republicans all voting. So that's really the needle they have to thread. Right now, they stay as close as they can to the president. But later on in the year, they might drift away to try to win a general, which is going to be really important for the senators from key states like Maine and North Carolina as well.
Henrietta, thank you. Henrietta Trace there of Veda Partners. Important final point. Deutsche Bank's Biggie Charter basically saying that the 6150 is looking for year end depends on a credible relent on trade, and that credible relent is driven by exactly what you brought up, softer polls.
That was what a lot of people think the ultimate check will be at a time where it has not been the stock market. Occasionally it's a yippee bond market, and it certainly isn't blowback when it comes to a number of people on the other side of the aisle.
The stock market's softer this morning. We're down by 0.2%. Up next, Mark McCormick of TD on Election Day in Canada. this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
After 4 days of really powerful gains on the S&P 500, the losses for the month of April were down 1.5%. Since April 2nd, the S&P down just 2.6%. Equity futures this morning softer by 0.1%. On the session on the Nasdaq, we're down by 0.12. With 2 hours until the opening bell, with your morning movers, it's Danny Berger. Hey, Danny.
Hey, John. The biggest loser on the S&P 500 pre-market so far is Eli Lilly, only down 1.6%, but it got a double downgrade from HSBC, rating it as a sell, saying that the risk-reward is no longer attractive. All the optimism is priced in, and maybe too much in terms of things like market share, also pointing out that there is economic sensitivity to the rate at which people adopt GLP-1s. Also on the downside in the S&P 500 this morning is Nvidia, the second worst performer after Eli Lilly, down nearly 1.5%. A Wall Street Journal story over the weekend saying that Huawei is getting closer to developing chips that can rival that of Nvidia. Still early stages, testing still needs to be done, but it just shows that continued challenge to some of the American tech exceptionalism. Now, finally, we had Domino's Pizza earnings out in the last hour. Those shares off some of the lows, but still down 2%. A really weak showing when it came to domestic sales. Domestic same-store sales fell more than 0.5%. The expectation was that they would grow 0.33%. International markets, those look strong. Really the only thing that held up the results for them. And the CEO of Domino's Pizza, like so many executives have said, that macro uncertainty is weighing on the chain. John.
That stock is down by about 2% at the pre-market. Danny, thank you. More from Danny later this morning. On our radar this morning, a battle for influence. Pressure ramping up on the Panama Canal. China dialing up scrutiny of a Hong Kong billionaire's plan to sell Panama ports to a group backed by BlackRock, while President Trump is calling for, quote, free of charge passage for U.S. ships.
So here we have a scenario where basically President Trump is saying we need to make sure that the United States gains all control of those ports in Panama Canal. And what happens? BlackRock says we can make that happen for you. We're going to buy these ports. And China's saying not so fast. The regulator coming out saying nothing's going to happen with Li Ka-shing and selling of these ports until the regulator releases it. Also, Bloomberg reported in March. Recently, we've heard the CCP told state-owned firms to hold off on any new collaboration with businesses linked to Li Ka-shing or his family. So they're going after Li Ka-shing and his family right now. Potentially this deal just completely falls apart.
The president is very good at putting things on the radar that you typically wouldn't hear about. And this is one of them. This is a national security issue. And it's gained greater interest over the past few months because of one man in the White House.
And a lot of people agree with him in terms of free passage for the Panama. And he talked about the Suez Canals, but this has to do with the Panama Canal in particular. Interestingly, BlackRock, Larry Fink, in an economic club speech earlier this month, said he still has a real conviction that it's going to get through. It's a 9-month process of oversight. A lot of things can happen. But it feels like it's increasingly become a pawn in this larger debate of a trade war between the U.S. and China.
Let's build on that trade war. The latest from Shein, hiking prices by as much as 377% ahead of tariffs on small packages. E-commerce giants are facing a 120% tariff on their products when the U.S. government ends the de minimis exemption on Friday.
Okay, the headline was hikes prices as much as 377%. And then when you look into the details, there is a thick hand towel that you can have for your kitchen that was increased in price by 377%. Let's talk about what these prices are too. And I think that that's actually really important. We're talking about a razor holder for no drill shaving rising from 46 cents to now $1.11. So that's a rise of 141%, but it still is a very cheap product. The question is that going to be enough for people not to order from Shein, and whether people will absorb that? Because on the margins, maybe they'll say, okay, we can buy those $6 hand towels, even if they've increased from $1.25.
The trade is collapsing and the price hikes next, and this is something we're all tracking at the moment. Also tracking this, a rare morning White House press briefing this morning. Press Secretary Caroline Leavitt expected to speak alongside the border czar, Tom Homan, at 8:30 Eastern Time as they look to mark 100 days. And most people would say that this is one of the issues that the president has had great success on. This is what they voted him into power for, to shut down the southern border, and border crossings have collapsed.
Absolutely. When you look at the polling right now, what you see is the president isn't doing so well when it comes to the economy or this ability to lower prices, but the American people do like what he's doing on immigration. I imagine part of this before the market opens press briefing, which honestly never happens, a press briefing at 8:30 in the morning, let alone anything before noon in Washington, D.C., that they're trying to also make sure they're getting ahead of a narrative. Over the weekend, there was an undocumented individual, not an American citizen, deported to Honduras, but had children as young as 2 years old that are American citizens but deported with her. And I think they want to try to set the clarity on this, because Tom Homan was asked about this on the weekend shows, and he says, the first time I'm hearing about this case specifically, but we do not deport American citizens, but the mother will choose to take her children with her.
That news conference takes place in about 55 minutes. When we get the headlines from it, we'll share them with you. I want to turn to Canada. An election reshaped by President Trump's trade policy. Prime Minister Mark Carney looking to lead the country's Liberal Party to a victory against Conservative Pierre Poilievre. Joining us now from Ottawa is Bloomberg's David Gura. David, welcome to the program. Always good to get your thoughts. This election race has changed a lot. How much has this changed in just a few months?
The political terrain has shifted radically over these last few months. If you go back to the end of last year, when Prime Minister Justin Trudeau's political hold began to get very tenuous, there was an expectation among the Conservatives in this country that this was going to be a change election that centered on economic issues, so centering on tax and the wide unavailability of affordable housing, for instance, debts and deficits. And while that's certainly the backdrop to this election today, it was the reemergence of Donald Trump, his re-entry to the White House for a second term, that totally upended the election that's taking place in this country. And Mark Carney, the Prime Minister, has been able to capitalize on that going into the election today, presenting himself as a figure who is best positioned, in his words, to deal with Donald Trump, based on his experience having navigated major crises before. So, of course, he was the governor of the Bank of Canada back in 2008 during the global financial crisis, and in that position took a real leadership role in the G7, helping the world economy navigate that crisis. He moved from there to England to lead the Bank of England, of course, when the Brexit vote happened. So he's calling upon that experience here, telling voters he's the person who knows how to navigate a major global crisis like this one. And I mentioned the role that Donald Trump is playing here. There was a moment when it seemed like a joke when he would talk about Canada as the potential 51st state. It's fair to say that joke didn't land, and Mark Carney has said from the get-go here, he never thought that joke was funny. In fact, he never thought it was a joke. He took him seriously from the very beginning. So those two issues are really salient here with voters today. The issue of a threat on sovereignty of this country, and the second issue on trade and how this country will negotiate with, communicate with, push back on Donald Trump as this trade issue continues to heat up. It's been interesting to watch over these last few days how those polls have narrowed. Not only have Liberals gained that ground that they lost to Conservatives over the last few months, they've surpassed them. It has ebbed a bit, and I should mention there was this tragic incident over the course of the weekend in Vancouver, a vehicle ramming in British Columbia that killed 11 people, injured more than a dozen others. And we saw the way that changed the contours of the campaign yesterday. Jagmeet Singh, the head of the New Democratic Party, was at that event just a few moments before that occurred. It changed the tone and tenor of this campaign. Mark Carney scaled back a number of the events that he did yesterday, and he had to kind of navigate these dual roles. Yes, as the sitting prime minister and as the candidate for that job going forward here. So folks, go to the polls today. They've just opened, and of course, this is a vast country, a large geography. Polls will stay open until about 10 o'clock tonight. But all of the candidates have returned to their ridings, their districts, John. That's where they'll be over the course of the day. They have events here in Ottawa for both Mark Carney and Pierre Poilievre tonight. We'll see who comes out on top. But looking at that most recent polling, at that public opinion polling, it seems like the Liberals do have the edge going into the campaign in the election today.
David Gura, looking forward to your coverage there. Thank you. David Gura up in Canada throughout today for that election. The move we've seen in the polls has been absolutely amazing, dramatic. At one point earlier this year, the Conservatives had a 20-point lead. Poilievre was destined to be the next Prime Minister. Things changed fast.
Things changed fast when the president starts truthing that he wants to make Canada the 51st state. And then what did you see? You see arch rivals in Canada, in provinces where individuals really didn't get along, all start to coalesce on, well, we need to stand strong against Trump. And now what you see in Canada is basically these individuals that are thinking maybe it's time to switch course, we're going to go for a conservative, are saying, nope, we're going to stay the course and go for someone who we know is likely going to maybe stand up for Canadian interests and not be conservative in nature, maybe on the same side at points with Trump.
To build on this, Mark McCormick at TD Security joins us now for more. Mark, welcome to the program. Before we get to the politics, I want to talk about the economy. What position is Canada in at the moment? How is the trade volatility, the policy volatility south of their border started to infect their economy?
Well, I think what's interesting is you bring it back to the markets and the economy is that Canada is actually the playbook for probably Europe and partly Asia as we think about trade uncertainty and as it filters through. If you go back to the start of the year, the whole focus on trade uncertainty and tariffs and all these things that were unleashed basically came to Canada and Mexico first. So this was a North American story. So you can see how things have progressed. The Bank of Canada has cut rates more aggressively than other central banks. They had to do it first, but they're nearing the end of the cutting cycle. So the interesting thing is the market's kind of picking up that one of the main drivers for macroeconomics and currencies and rates is a shift from monetary to fiscal policy. And that is a theme that has been driving markets. You know, we've called it a vibe shift in terms of what markets are focused on and how they want to think about the vibes are changing over time. But I think an important thing for Canada is they've already gone through a lot of the uncertainty and volatility that comes on this trade side. So we're seeing what it looks like on the other side. And what we see is a transition from the central banks cutting rates to fiscal stimulus taking over and the currencies and volatility and positioning all starting to respond to that.
So just to put that more plainly, Mark, is that the reason why you have seen dollar weakness, even as the Fed is more likely to hold rates firm while the rest of the world cuts rates in response to disinflation?
This is the million-dollar question in FX because what's interesting is that inflation expectations are rising. You look at 1-year, 2-year inflation swaps pricing, and it's going higher. We know that inflation, core PCE, is going to be running at least 4% in the next couple of months, maybe if not for a little bit longer. So what the market's thinking is that the Fed could see through this. And I think this is the biggest debate because there's so much uncertainty for the next 2 years, the next 3 years. We have no idea where any of this is going. We know that globalization is moving backwards. We know that this feels, again, like a bit like a mini supply chain shock like we had during COVID. So the central bank response is critical. And I think it's very important as well because Trump has been coming after central bank independence and he's been coming after Powell. How did they react the first time this happened? They actually hiked rates. They were more hawkish. They tried to assert their independence. So I think the market has no idea what the Fed's next move is. And again, the thing that we are now, we are all back to data dependency. So we have to watch the hard data. We got payrolls this week. So keeping that all in mind, I think, you know, the number one thing we want to focus on is that U.S. is going to deal with higher inflation and weaker growth. But right now, inflation seems to be more prominent.
Well, Mark, if you look at the hard data, though, that leaves the Fed with what, being on hold the rest of the year?
No, we anticipate that they're going to cut, but it could be backloaded. Again, you see more aggressive cuts in the back end of 2025, and you can see a lot more aggressive cuts coming in 2026. But whether or not the Fed could cut in the next 3 months, I think is going to be, again, very dependent on the data and very dependent on how market pricing evolves around these changing narratives. I think the thing you want to think about is the growth shock, just like we just talked about in Canada. The growth shock is going to land in Europe first. It's going to land in Asia first. So again, if you kind of think about what curves should be doing, what currency should be doing, we probably should have in the very, very short term a little bit of consolidation, a dollar, a little bit of a weaker euro, because we should see front-end pricing in Europe, in the UK, in euro, move lower on the 2-year interest rate differentials.
Hey, Mark, appreciate the input from you. Mark McCormick there of TD Securities on the FX market. At least we've seen a lot of rebalancing to guess where? to Europe. And Mark's basically saying that's where you're going to see the pain first.
Which is ironic, considering the fact that a lot of people are thinking that this is good for both fixed income as well as the equity markets. Did you see Switzerland? People are basically expecting negative rates there because they are concerned about how strong their currency has gotten. So right now, it is so strange to try to understand the traditional paradigm of more rate cuts means a weaker currency, because something odd is going on that makes it very hard to understand exactly what the driver is going to be.
There's nothing traditional about the market regime at the moment, that's for sure. Euro dollar 113.45. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hakos. Hey, Yahara.
Hi, John. Most of Spain and parts of Portugal were hit by a major blackout at around noon local time today, impacting power and phone lines. Public transport, traffic lights, and phone services were mostly down in parts of Madrid, Barcelona, and Lisbon due to the outage, and trains were mostly halted. The reason for the outage is still unknown. Meanwhile, a series of new polls suggest discontent with President Trump's economic plan among U.S. voters is damaging his popularity. A CNN poll released yesterday found 39% of Americans approve of how Trump has steered the economy, and an NBC poll also showed only 39% of respondents agreed with his tariffs rollout. And in sports, Liverpool are Premier League champions for the second time after a commanding 5-1 win over Tottenham. The win seals Liverpool's 20th top-flight English League title, matching the record of their rival Manchester United. It's the culmination of a career year for first-year manager Arne Slot and superstar Mo Salah, who leads the league in both goals and assists. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for that. Winning it at Anfield, pretty special stuff.
It was a shellacking in their own field, I think is fair to say, and the celebration was pretty fun to watch. I've got to say, their dance moves, sort of, very
impressed by that?
Yeah, really,
Nice.
all of them going together.
Pretty brutal for TK's Tottenham, that's for sure. We'll leave that there. Up next on the program, making the bond market great again.
The important thing is that we are setting the fundamentals for a strong dollar, a strong economy, strong stock market, and for investors to know that the U.S. government bond market is the safest and soundest in the world.
We'll get a view on that in just a moment. On the debt market, Amanda Lynham of BlackRock from New York City. You're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age. Imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the
markets. Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures on the S&P negative here by 0.1%. On the Nasdaq 100, just a little bit softer as well. Big week for the Nasdaq, tons of earnings. You know what the calendar looks like. Wednesday, Meta and Microsoft. Thursday, Apple and Amazon. In the bond market this morning, yields just a little bit higher. 10-year yields up by 4 basis points, 4.28 on a 10-year. Under surveillance this morning, making the bond market great again.
Anything that happens over a 2-week, 1-month window can be either statistical noise or market noise, and we're in this for the long term, and the important thing is that we are setting the fundamentals for a strong dollar, a strong economy, strong stock market, and for investors to know that the U.S. government bond market is the safest and soundest in the world.
So here's the latest this morning. The Treasury Secretary looking to reinforce confidence in U.S. debt and put a floor under the recent sell-off. Amanda Liner of BlackRock writing, we see scope for additional spread widening and credit. Underpinning this view is our expectation for a more challenging growth inflation mix, as well as our expectation that the hard economic data will eventually catch down to the soft sentiment data. Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
Eventually. Can we put some details on eventually?
So I think taking a step back, the market seems to be taking a bit of, I would say, a temporary reprieve from the fact that we haven't seen this soft data translate directly into hard data immediately. If you actually look at what these companies are saying, though, which even the companies over the last 7 days of reporting haven't really baked in expectations of shifts in trade policy. And so I think actually where we're looking for is the second half of this year. If you look at home builders, they're not expecting higher costs to hit closing until the third quarter or fourth quarter. Industrial companies aren't expecting higher costs until they work through inventory, possibly to the second half of this year. So corporates are, I think, still figuring this out to a large degree. So it's not surprising that we haven't seen it in the hard data yet. I think just because we haven't seen it in the hard data, though, doesn't mean that it's not eventually in train. And so we are bracing for that. But I would say it's probably going to be a second half of this year.
Some of the hard data, of course, flattered by front loading. We saw that in retail sales. And I think you see it in earnings as well to some extent. How are you distinguishing between genuine underlying demand and just a stockpiling, getting ready for supply not being there?
So I've spent a lot of time in company earnings call transcripts, and they actually are even having a really difficult time figuring out what is front loading and what is actually real demand. I think it's going to be a matter of time before we see that play through. But even in the autos, for example, we did see a really large jump in auto sales. I think you can kind of put the mosaic together and figure out that that is some front loading. But I think when we take a step back at corporate credit markets, high yield spreads, for example, have retraced 47% of the widening since mid-February. It's been striking how quickly these markets are kind of mean reverting. So investors, I think, are getting these opportunities to put money to work at more attractive spreads, but they're becoming short-lived. They're snapping back. We don't think we've seen the end of that. We're around 360 in high yield spreads. In order to bake in a real material growth slowdown, we would need to be 550, 650. A recession would be even above that. A recession's not our base case, I should say.
Just to put some numbers on that, on April 8th, the average yield on high yield bonds was 8.7%. It is currently down to 7.8%, just massive snapback as everyone piled in. I want to understand the buying dynamics, how much you're seeing the buyer base for credit instruments shift, maybe away from the foreign buyer, away from the Japanese, away from the Europeans, and toward a more domestic audience.
So foreign investors own around 1/4 of the U.S. corporate bond market. So it's not just treasuries or equities. They also own corporate debt. I would say the marginal dollar has been in place to reallocate to European credit for couple of years now, ever since the ECB started hiking rates, because you had some yield buildup in that market. I would say on the margin, given some of the optimism around the fiscal support, there is incremental interest in putting money to work in Europe. It's tempered by two things, however. One, the growth backdrop in Europe isn't great either, and so we are expecting some headwinds from shifts in trade policy. You can see that, and even some of the survey data from Europe. And two, the U.S. corporate bond market is the most diverse, deep, liquid market for corporate investors. So if you're looking for high quality spread product, there's not a lot of availability in Europe. So I think by that extension, investors will still need to allocate a significant amount to the U.S. market.
Which is the reason why you haven't seen the numbers fall off that much. I wonder how much of competition the credit market is getting from the Treasury market. The fact that the U.S. Treasury Department is going to be announcing their quarterly refunding estimate today, and then on Wednesday, their actual schedule of issuance. How much is that creating a real challenge for you in understanding the dynamic going forward for how the fair pricing of credit really works?
So related to this is part of the reason why we like actually moving down in quality in Europe, in U.S. corporate credit. For this reason, the Treasury market has been very volatile. We're expecting steeper curves. We're expecting a rebuild in term premium. For that reason, we think it's important for investors to capture the additional spread premium where they can in corporate credit to kind of offset some of that volatility and boost those total returns. Actually, parts of high yield have outperformed investment grade on a total return basis so far this year, and even the lowest quality portions of high yield have outperformed the equity market. So actually, the credit market, even though it's been a really volatile year to date, is still offering a bit of a reprieve in terms of total returns because of that spread pickup. If you move down into the high end of high yield, you're not actually foregoing that much credit quality relative to, say, for example, the low end of investment grade. So we do like moving down in quality a bit to pick up that extra spread premium to kind of cushion those total returns. As for the competition point, we're just bracing for a significant amount of Treasury supply. That's been a theme for the past several quarters. We know that because of the deficits. But I do still feel that corporates recognize the difference between the sovereign risk and the corporate credit risk. There's still a really significant need for corporate credit allocations. But I think really the name of the game is actually duration has been very volatile. We're better off allocating to credit for carry and income, so favoring that short duration and picking up spread when you can.
Are you seeing investors abroad discriminate between the two, between sovereigns, between treasuries and, say, corporate credit in America?
For sure. I think the allocation to corporate credit is really in its own bucket. I think the decision for investors really from our conversations has been twofold. Am I investing for total or excess returns? And so where am I aiming in the credit quality spectrum? Am I aiming for duration or not? And then also the relative value, as you alluded to, Lisa, across regions. The other tricky thing for Europe is that valuations haven't reset that much. So if you are allocating that marginal dollar to Europe, the valuations haven't given you a great entry point at this point.
Certainly at times this month it's found like all US assets are trading in one bucket, day to day.
Which it has, except not when you look under the hood. And what you've seen even in the flows is that, yes, foreign investors have been shifting away on the margins from treasuries, but not credit, because of some of these ideas. And that's why people could say we can still get around some of the corporate story in the U.S., but maybe not the government story right now.
Amanda, it's good to see you as always. Thanks for dropping by. Amanda Lynham there of BlackRock. Equities at the moment, just a little bit softer. We're down just 0.1% on the S&P 500 as we commence a brand new trading week following a decent week of gains on the S&P, a week of gains north of 4%. And over the last 4 days, a gain of more than 7%. Up next on the programme, we'll catch up with Seema Shah of Principal Asset Management. We'll speak to Angelo Zeno of CFRA on a big week for Mag 7 earnings. Neil Dutta of Renmac and Lotfi Karui of Goldman Sachs. From New York, this is Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world, and so that has been very lucrative as a business.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Short-term volatility that then can resolve itself. The concern is if we cannot have some certainty in the markets.
These markets are looking for certainty, they're looking for direction.
The U.S. markets are still the most liquid and the deepest.
Nothing is safe. Everything is a risk today. This is not the time to get out of the market, right? You need to play this out.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance starts right now. We've got a big week ahead and we're rallying hard into it. Equity futures this morning softer, but following a powerful 4-day rally on the S&P 500, gaining by more than 7% over that period. The S&P a little softer, the Nasdaq 100 as well. Over the previous 2 weeks, bond yields down, lower on a 10-year. Some comfort coming from fixed income as we stabilize. A 10-year Treasury around 430, up this morning by 4 basis points, 427.97. Something for stock traders and bond traders alike throughout the whole of this week. Lots of economic data, concluding with payrolls on Friday. Lots of earnings as well. Meta and Microsoft on Wednesday. Amazon and Apple on Thursday. Listen to this for a 4-day performance. Apple up 8%. Microsoft plus 9%. Lisa, Meta up 13% over just 4 days.
The bear market in big tech was really called into check when you got some of the earnings last week, which showed that the AI investment cycle is still going strong and that people were still paying up for advertising across the board, but particularly with Alphabet. Abby Yoder of JP Morgan Asset Management put it really well when she said everyone seems to have left AI and the AI trade for dead, but that is the reason why they see a pathway for some sort of rally into year end, because she sees Microsoft, Meta, Apple, and Amazon all just reflecting this big tech spend and continuing to deliver profits that really underscored the American exceptionalism that everyone seems to be bailing from.
And it's happening as the president tries to change the conversation from punishing allies and trade partners to striking deals with them. And now, alongside that effort, pushing to deliver a tax plan and deliver it fast.
And it makes sense, right? Because what you see in a lot of the polling, a lot of the surveys, is that Americans are very concerned. There's a lot of consternation about what the tariffs may mean. Price and hikes, does it mean we're going to have empty shelves? So push the conversation forward to tax bill. They want to get this tax bill done Memorial Day. That is in 1 month. And no one really thinks that's going to happen. But while there's a lot of optimism coming from the Treasury Department and the White House, when you look at Congress and the composition of how slim these majorities are, this is going to be an incredibly challenging tax bill unless it's just the extension of current policy.
The more consumer sentiment moves against them, the more the market pressure continues to build, the more price hikes start to be announced from corporate America, the more the pressure will build on Washington, D.C. to act and provide an offset. Equity futures this morning on the S&P a little bit softer. We're down 0.1%. And coming up this hour, Seema Shah of Principal Asset Management as stocks look for a second straight week of gains. Angelo Zeno of CFRA with more Mag 7 earnings on deck. Huge week for big tech. And Renmax, Neil Dutta on the rug pull to the consensus view. We begin this hour with stocks steady as traders await a busy week of earnings and data. Seema Shah of Principal Asset Management writing, without a meaningful step back in tariffs and in the absence of growth-boosting measures, the U.S. economy would slide into recession. Seema joins us now for more. Seema, welcome to the program. Let's talk about big tech with that in mind. How resilient are Mag 7 earnings in the face of cyclical risk?
Hi, John. Well, I mean, there is some resilience, as we were talking before, in terms of the amount of capex. I think people are still not necessarily questioning the long-term growth potential of these companies, but they do sit in the eye of the storm with regards to tariffs. I mean, when we're doing the sectoral analysis, technology is the sector which is most vulnerable to the various tensions. Now, we are hearing from investors that they're looking to maybe dip their toe in the tech trade again, given the very big re-rating that we've already seen. But I guess that we'd be a little bit skeptical at this point that there isn't further downside to go for these tech firms.
Seema, the price that people are willing to pay on US assets right now, valuation in question, but also international exposure, which is something you've touched on, something you've talked about. Can you build on that for us? International exposure for the likes of Apple, is that going to be a plus or a negative for this quarter?
I think when you're looking back at Q1, I think it's still a plus. It's when you're really starting to look out, just like it is for any of the other earnings guidance, earnings calls that we're going to be hearing over the next week or two. It's really about what goes forward. Now, from that perspective, particularly regards to China, we have got growing concerns. Even for Europe, we're now expecting recession for the euro area, for the larger economies there. So I think it is still going to be a really challenging quarter ahead. I think the question is for a lot of investors is that we know that the short term is going to be very challenging for a number of companies, but they're still putting a lot of weight on the long-term potential, what they believe is still a sustainable story.
Seema, how much credence do you give the Sell American trade? This idea that people are souring on the U.S., both bonds and stocks, at a time where there's a lack of clarity and already a pretty expensive valuation that's been baked into equities?
Well, I think it's a big discussion. I mean, I was in Berlin last week, at a conference just talking to investors, and I think there is a growing feeling, concern about where the U.S. is going. But when you really dig deeper into where are they going to allocate, they do believe that it makes more sense to think about the marginal dollar coming back to Europe, especially given currency considerations. But no one is really testing the idea that in the long term, the US is still going to be a key player. So it's a conversation, of course, since there's a conversation, and if the Trump administration were to pursue the tariffs along the line that it already has in the last couple of months, then that question starts to become a bit of a roller coaster. And as it gains momentum, that becomes more concerning. But I think in the short term, it's just an interesting discussion rather than really questioning what the future of the US is in terms of US exceptionalism.
About 2 weeks ago, we saw that toxic mix of both bonds and stocks in the United States selling off in tandem, and suddenly people were questioning the idea of treasuries as a haven asset, the idea that they would have to seek gold or maybe boons as a possible alternative. On the margins, are you starting to shift the concept of what the ballast of your portfolio will be away from the idea of full faith and credit in the U.S. government?
I think that to an extent, yes. I think when we're thinking about the asset allocation, international starts to look more interesting. And when I say international, we've always had global diversification. but it's the specific regions which have suddenly become more interesting again. So specifically Europe, again, in the near term, we do believe a challenge, but into 26, 27, things to start to look a little bit brighter. So I think it's a combination of the US looking a little bit more concerning, but also the attempts by a lot of governments to reshore their economies. We're hearing more and more of these headlines. So it does mean that from an international perspective, there are more opportunities, and I think that is starting to play through. But it doesn't necessarily mean that investors are going to be aggressively moving away from the US. It's just that the world is a bigger place.
Seema, how do you sort of filter out the noise that we're going to be hearing on a consistent basis, whether it's from Washington, D.C., or whether it's the stacked calendar this week of earnings, of economic data, as well as potential corporate actions? How are you filtering this out and understanding what to pay attention to the most closely?
So I think for this week, when it comes to the macro data, and I think a couple of other people on your program have already said this, which is that the soft data, we know it's dire. We don't see any chance that in the near term it's going to improve. The question is really going to be what happens to the hard data, and I don't think the payrolls report this week is going to give us any early indication of what's to come. So I think that this week we're going to get through it and probably not know anything more than we did at the beginning of the week. When it comes to earnings, it's a similar story. It's really about what the forward guidance is, what are companies doing with regards to tariffs. So actually, I think in the near term, we're not going to know much. It's really once you get towards June that we potentially could have some idea of where things are going. And of course, at the end of the day, the only thing that really matters is what the Trump administration is going to be doing. When we're thinking about the economic forecast, we have a huge amount of uncertainty built into that because it really does depend on what they do with tariffs and specifically what they do with tariffs to China.
Policy and policy driving this equity market. When it comes to what the market likes to hear, they like to hear the idea of the United States and China sitting down for negotiation. We sometimes see the market react when Trump puts out these truths or an interview says he's spoken to Xi Jinping. But most believe that that conversation actually hasn't happened. Why does the market like something that maybe not be credible?
Well, I think the key thing here is that the market is just hoping that we've got the worst of the tariff story behind us. And so from here, even if it's a very, very gradual upward trajectory, at least it's an upward one. The other thing that we are hearing about is, when you look at the effective tariff rate and how much it's increased because of the 145% tariff on China, that's all that matters. So the key thing that investors are focusing on is not necessarily discussions with Europe, discussions with Japan or India. What they really want to know is anything to do with China. So any bit of good news is going to be received positively. Now, to your point, it doesn't necessarily mean that anything's actually going to happen. So there is going to be that continued volatility, but that is the key point of news that we're going to be looking out for over the coming weeks, months, and unfortunately potentially quarters too.
But Seema, at the moment, this is just noise, and this is just, an olive branch that they want to come to an agreement. The fact of the matter is there's a 145% tariff rate on imports coming to the United States. When is the market going to really start to absorb that?
Well, I think it's once you start to see the economic data deteriorate, we've been talking about empty shelves, those are the kind of things that it will really hit home that there is a meaningful deterioration in the relationship. But still, one of the reasons that we haven't come out of equities, that we're still in risk assets, is because there is a potential for a positive headline. This is not probably the time to be closing out your positions. There is still the potential for upside. And I think investors, when we're looking at the economy coming into Q2, it still looks fairly robust. And if you have a fairly robust economy, plus potential for any positive announcements, that is the time that you still want to have exposure.
Seema, appreciate it as always. Seema Shah there of Principal Asset Management. I think for investors right now, it doesn't matter whether the talks are happening or not. It matters that the president wants you to think they're happening because the president is looking for an off-ramp.
He's looking for an off-ramp, and also the Treasury Secretary has made pretty clear most recently this weekend, as well as an interview with me, that these rates are unsustainable. The issue is, when is that off-ramp going to be? Because if it's going to be soon, maybe the damage can be contained. What if it's in 6, 7, 8 months? It's going to be incredibly challenging for U.S. companies.
That's the risk, that you start to see it hit profits, you start to see it hit the economic data. We get more data this week, including payrolls on Friday. Equities at the moment on the S&P just a touch softer. We're down by 0.2% as we kick off a brand new trading week with stories elsewhere this morning. With your Bloomberg Brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Most of Spain and all of Portugal were hit by a major blackout at around noon local time today, impacting power and phone lines. Public transport, traffic lights, and phone services were mostly down in parts of Madrid, Barcelona, and Lisbon due to the outage, and trains were mostly halted, though the stock market continues to operate normally. The reason for the outage is still unknown. Meanwhile, the Vatican has chosen next Wednesday as the start of the conclave. More than 100 senior clergy members will take part in the process to choose Pope Francis' successor. Discussions and 4 rounds of voting will take place each day until a candidate receives 2/3 of the votes. At that point, traditional white smoke will be seen over the Vatican, signaling a new pope. And a series of new polls suggest U.S. voter discontent with President Trump's economic plan is damaging his popularity. This as he closes in on 100 days back in the White House. A CNN poll released yesterday found 39% of Americans approve of how Trump has steered the economy. And an NBC poll also showed only 39% of respondents agreed with his tariffs rollout. That's your Bloomberg Brief. John?
Yahara, thank you. On day one, they hit the ground running. They have not stopped. The pace has been absolutely unbelievable. Up next on the program, the Morning Calls, plus Angelo Zeno of CFRA with Mag 7 earnings in full swing. From New York City, this is Bloomberg. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Absolutely stacked week ahead. Talked a lot about the earnings. Payrolls as well on Friday. The estimate in our survey, a sneak peek, and it can change as we get more estimates. The median at the moment is 130. The response from the sell side, Stuart Kaiser of Citi, an inline print is modestly positive, but with a soft print will likely be negative, and a sign that tariffs have pushed the economy on a path to recession. That's the risk for Friday. You get a negative print, this market will run in the other direction pretty fast after a rally of more than 7% in just 4 trading days. Equity futures this morning softer by 0.2%, down a quarter on the Nasdaq 100. That's your price action. Let's get to some morning calls. First up, Truist, upgrading Peloton to buy, seeing recovering fundamentals and anticipating revenue growth in 26. That stock is up by close to 5%. Your second call from Citi, cutting its price target on Under Armour to $6, citing tariff impacts and a weakening sales backdrop. And your third and final call, HSBC, double downgrading Eli Lilly, expecting economic sensitivity to impact weight loss drug adoption. That stock is negative by 1.6% in the pre-market. Let's turn to tech. Meta, Microsoft, Amazon, Apple, all reporting earnings this week. Angelo Zeno of CFRA writing, we expect guidance to be conservative and may be deferred in instances given the low visibility tied to policy uncertainty. Angelo joins us now for more. Angelo, welcome to the program, sir. Let's just talk about the companies in front of us this week. Of all the business models, which business model do you think we should get exposure to, given the risks that we all face at the moment?
Thanks for having me, John. I think the one that's at most at risk would be Meta, as far as kind of deterioration from a macro perspective as a result of the tariffs that are being implemented here. So, but that said, I think Q1 results across the board are going to be fairly good. I think even Q2 guidance for those that do provide Q2 guidance are going to be okay. My bigger concern would be more in the back half of the year if we don't start seeing greater momentum in terms of deals and a pullback in some of the tariffs that have been announced. Because as far as Meta is concerned, when you think about Meta, they've got the biggest hike in terms of cost in 2025 versus 2024. And, they're also, I'd say, the most exposed in terms of macro factors, given they are, more digital ad focused.
Meta's rallied really hard into this print. It's up by 13% over the past 4 sessions, Angelo. Can we just sit on Meta and ad revenue? What is the difference between the profile of ad revenue over at Alphabet and the character of ad revenue over at Meta? Because the revenue story over at Alphabet was pretty decent. What's the difference between the two?
Yeah, I'd say historically, Alphabet's, their ad-related revenue has been a lot more sturdy during challenging times. They're typically the last to fall because that platform typically has just much greater eyes. I'd also say, as far as Meta is concerned, a little bit more exposed in terms of smaller, mid-sized businesses, also more exposed from a percentage of revenue basis as far as some of the concerns related to the China e-commerce names, the Sheins, Temus of the world. So again, a little bit more exposure for Meta in some of those riskier aspects of the digital ad markets. Now, that said, the great thing about Meta is they've got some great secular and new revenue opportunities tied to them in 2026 and 2027. So the hope here for Meta is hopefully they can find some benefits on the cost side of things that allows them to maybe get through the next 6 to 9 months, and then investors, I think, will be willing to look past that and look into 2026 and those great opportunities ahead.
On some level, Angelo, do you kind of pair Meta and Apple together in terms of having a disproportionate exposure to China and the international footprint relative to, say, a Microsoft and Amazon, which I know you don't cover, but there is this feeling that maybe there is a bifurcation or just a segmentation of big tech, and we are going to see it in the earnings later this week?
I think that's a fair point to make. I think for Apple, clearly they've been kind of this poster boy child on the tariff side of things, and they are going to be more exposed because they are a hardware vendor, and they've got to talk the strategy more on the manufacturing side of things. I think at least that's what investors want to hear is China-related domestic exposure, which a lot of these other hyperscalers really don't have exposure to because they're not as entrenched in the local China market. So we want to hear what Apple has to say on that side of things, and then of course what they have to say in terms of shifting some of the manufacturing away from China, de-risking some of that here, whether or not it be over the next 3 to 6 months, more so over the next 2 years or so. So Apple probably a little bit more riskier in terms of the Apple play, but I think there's also a story to be made where Apple could benefit from the tariffs long term.
Please elaborate on that. What are you saying? That they can benefit from the tariffs long term? That sort of was a pretty wild card.
Yeah, so long term, when you think about it, the great thing about Apple is they have some great pricing power, right? They've got a great brand. They've got the pricing power. If there are tariffs that are implemented here in the second half of the year, which we expect, I mean, we need to wait for this 232 semiconductor investigation to really play itself out and see what those tariffs are. But ultimately, Apple will have to increase prices, we think, to offset those tariffs. But over time, as we go into 2026 and 2027, Apple is going to be able to push back or roll back, we think, some of those higher costs by moving some of the manufacturing, also kind of maybe manufacturing some of the chip components in the U.S. Let's call it some of the processors with Taiwan Semi, and over time they're going to be able to roll back some of those higher tariff-related costs, and we don't expect them to pull back in terms of pricing. So ultimately, we think 2 to 3 years down the road, they could actually benefit from a margin perspective through higher tariffs.
This is fascinating to me, Angelo, and it has implications well beyond just this company. And it goes to the heart of the thesis that Abby Yoder was explaining earlier this morning of JP Morgan Asset Management, where essentially the Magnificent Seven, I don't want to say have been left for dead, but really saw a big drawdown. And all of a sudden last week, we saw Alphabet beat expectations, reaffirm the commitment to capital expenditure spending. How much do you expect that to be the tone this week as well, particularly when it comes to tech expenditures, the AI revolution, and how much some of these companies see in terms of opportunities going forward that maybe people have kind of ignored for a bit?
Yeah, no, that's a great question. I think overall, across the board, these companies are going to sustain their CapEx spending plans. And I think now that has kind of been, that's the overarching theme out there. I don't really see any change to that. I think where you could see some benefits or some pullback on the cost side of things is on operating expenses. When you kind of look here over the last kind of 18 to 24 months, what a lot of these mega cap companies have done is kind of shifted more, increasing on the expense side of things, on the CapEx, pulled back, or at least kind of been a lot more conservative on the OpEx side of things. When you look at a company like Meta this year, they threw out a nice jump on the OpEx side of things. I think high teens growth year over year. So we think there's the potential for them to roll back some of that, and that should help the margin side of things, at least relative to where some of the expectations are, where the expectations were already expecting for some margin compression this year. You saw some nice outperformance from Alphabet just last week on the margin side of things, because that is something that they are working on. So I think you see that across the board here over the next couple of quarters, and frankly, over the next couple of years, where the focus is on those long-term investments, because AI is such a great opportunity, and it's something that these companies can't miss out on, because if they're not investing in it, somebody else will.
Well, Huawei Technology is investing in it. We have a Wall Street Journal story this morning that they're gearing up to test a new, very powerful processor when it comes to semiconductor space, which basically they hope that will replace what right now NVIDIA sells to China. Are you concerned about what that means for how much NVIDIA could be selling into Beijing?
Yeah, I mean, I think at this point in time, as far as NVIDIA is concerned, you've got to really almost put negligible revenue tied to China here over the next couple of quarters. I'd say less than 5% of their sales at this point are probably going to go into China. I think Huawei clearly is going to be the dominant factor in China as we kind of look 2-3 years down the road, just given what this administration is looking to focus on. I think there's another concern out there as far as the AI diffusion rules are concerned going into May. But when you look at when you look at NVIDIA's exposure outside of China, I mean, I think really kind of this GPU ban really takes out the risk of these AI diffusion rules as you kind of go into next month. So I think we're in pretty good shape as far as NVIDIA is concerned, as far as the worst case news being out there in the market.
Angelo, appreciate your input, sir. As always, good to catch up, buddy. Angelo Zeno there of CFRA on the earnings through the week. You're familiar with the calendar. We've been through it a few times, but once again, Meta, Microsoft on Wednesday, Apple, Amazon on Thursday. Just to sit on Apple, I think a great case study for the broader economy at the moment. We're all grappling with this. We saw it in retail sales last week. What's the difference between genuine, sustainable underlying demand and just a front loading of purchases? And that will apply to Apple earnings later this week. We saw all the stories about people piling into the stores buying what? iPhones. Is this the elusive upgrade cycle we've been looking for, or is this just the front loading that we've seen elsewhere?
Lori Calvasino was our poster child earlier this morning when she said she bought an iPad to get ahead of her child running out of his at a time when prices were going up. It's a good question, and it really raises the issue of how much they're going to double down on the next model or the next great thing to try to generate that excitement. Everyone wants to know, what are you doing about China? How quickly can you move to India? What exactly is going to the hit going to be?
A big 4-day rally into these earnings. Apple up 8%, Microsoft up 9%, Meta up 13% in just 4 trading days. Equity futures this morning softer by just 0.1%. Up next, Neil Dutta of Renmac, Lofi Karubi of Goldman Sachs on the risk of recession. Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly. There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Earnings season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
The opening bout 60 minutes away. At the moment on track to snap a 4-day winner streak, but very marginal losses. Softer going into the cash open by just 0.1% on both the S&P and on the Nasdaq. With a few hours to go, or rather 60 minutes to go until that cash open, let's get you some morning movers with Danny Berger for more. Hey, Danny.
Hey, John. It's going to be a busy earnings week, and ahead of that, we're getting a lot of sell-side action, the most recent of which coming from HSBC and Eli Lilly, giving it a double downgrade to sell, saying that the risk-reward for these shares simply aren't attractive anymore. Too much optimism is priced in, especially because there's economic sensitivity to the adoption curve of GLP-1s. Those shares down 1.2%. Also down over the weekend, we got a report from Wall Street Journal on Huawei building chips that look like they might be able to rival NVIDIA. Anne-Marie mentioned this with Angelina Zeno. Those shares down 1.33%. Still early stages, more testing needs to be done, but again, challenging that narrative of American exceptionalism when it comes to tech and AI. Finally, we did get some earnings this morning. About 2 hours ago, we heard from Domino's Pizza. Those shares down 2.5%. Sure, their earnings for the most part held up, but that was just because of international sales. Their domestic same-store sales fell 0.5%. The expectation was for it to gain 1/3%. We heard from the CEO, all of them singing from the same hymn sheet, saying that macro uncertainty is weighing on consumers, John.
Danny, thank you. That stock is down by 2.5%. 3 movers to watch going into the cash open. Lots of data to look for through the week. Job openings, ADP, claims, ISM, payrolls on Friday. Mike McKee has it all. Morning, Mike.
Good morning, John. Might be a steel cage match this week between earnings and the economy. We haven't had a lot of economic news to trade on lately, but we do get it, as you mentioned, this week. Starting tomorrow, really, today you kind of get the day off, but we get trade, the first figures on trade for the month of March. Will it show any kind of impact from tariffs? Jolts, maybe not so important this time around. And consumer confidence, everybody's keeping an eye on that because of what Danny was just talking about, our consumers pulling back. Wednesday is what I'm calling acronym day. ADP, GDP, ECI, Employment Cost Index, and PCE, along with the personal spending and the personal income numbers. Thursday claims, of course, and then ISM manufacturing. There's going to be a lot of interest in what those people are seeing in terms of new orders. Are companies pulling back as well as consumers? And Friday, everybody's favorite, the jobs report, ISM Services, comes out after that. Won't have a big bearing on trading, but the jobs number certainly would. The good news this week is the Fed is in blackout period, so we are not seeing any Fed speak. You can take that part of the week off.
Mike McKee, thank you. Looking forward to that. Appreciate it. Thank you very much. And the lack of Fed speak as well, I think, is welcome, given how much we've had just recently. Neil Dutter of Renmac joins us now for more. Neil, welcome to the programme, sir. Before we get into details, Neil, you wrote about it recently. I just want to sit on this just for a beat. The rug pull that we've seen to consensus, Neil, that you've written about, just frame that historically, how quick, how vicious this has been.
Well, as you know, I mean, I think one of the ways recession works is through that element of surprise. So people think things are going to be okay, and then they're not, and that prompts the clearing out of inventories, investment, hiring, and so forth. And it's been quite dramatic. I mean, remember, we went into the year looking for Q4 growth of around 2%, and now it's around 0.5%. So you've seen a fairly meaningful downward revision to GDP growth expectations for 2025. And if you go outside the COVID years, the last time anything like that's happened is 2009. So it's pretty dramatic.
You've been tracking some weaker data, not just at the start of this year, but from the back end of last year as well, Neil. Just give us the trend of things at the moment and how you'll navigate payrolls on Friday, because I can tell you for a lot of people in the market at the moment, they seem to be willing to ignore strength and they'll triple down on weakness. What's your approach?
Well, I think that makes sense because, I mean, to me, it's to the extent that any number is strong, it's probably somewhat backward looking. And if it's weaker, it just means that the economy was even softer than we thought going into all this. But, take a step back and think about what happened last year. We saw very strong growth in consumer spending that was driven primarily by, or to a large extent, by a decline in the savings rate. If you look at real incomes excluding transfers, it's up only 1.5%. So even if you assume the savings rate stable, you're going to get weaker consumption. At the same time, non-residential business fixed investment contracted towards the end of last year. It only added about 30 basis points on average to growth in 2024. Believe it or not, John, that's actually less than the contribution from healthcare services consumption. So it just tells you about the sort of cyclical momentum in the economy going into 2025. This year, I think what's been notable is the ongoing increase in completed unsold new housing inventory, which sort of begs the question about what home builders are going to do. It probably means they're going to cut back on residential construction. And I think in turn, that probably means some slowing in residential construction employment. So, I think the onus is really on the economic growth bulls. My sense is that, things can get a little bit sloppy over the next couple of quarters.
Let's say, Neil, every single Fed official is watching right now in their quiet period. They're taking advantage of that and reading all of your reports and saying, okay, we're going to cut by a full percentage point. We'll cut dramatically in the next couple of meetings in order to get ahead of this. How much would that help?
Well, I don't know that it would help that much because I do think to some extent the train has sort of left the station. That doesn't mean I wouldn't encourage them to start thinking about recalibrating monetary policy. But I think it's important to keep in mind that, think about the areas of the economy that are affected the most by the trade war. It's stuff like consumer durable goods. It's stuff like housing. So those are the areas that the Fed can help. But I don't think they can offset a full impact of the trade war. So the Fed is just one part of this, but really to kind of totally shift the narrative, I mean, you need to see, the uncertainty sort of abate.
I feel like we've switched roles, Neil. It sounds like you're just really downbeat. And I'm thinking, well, the companies are not sounding that downbeat. Corporate executives are coming out and saying we can manage through that. And their estimates have actually surprised to the upside in a large number of instances. Why does that not come for you and give you a sense that actually maybe it's not as bad as people are saying?
Well, I mean, time will tell. I mean, I don't know that that's true. I just saw an article in the Wall Street Journal this morning talking about how companies are sort of shelving their CapEx plans. The fact that we're talking about a large amount of companies pulling their earnings guidance, Lisa, I mean, if they're pulling their earnings guidance, they're not spending. Point, simple as that. So, I don't really see that much optimism out there. If anything, CEO confidence has been waning because people got the sequencing wrong, right? I mean, when they bet on Donald Trump, they bet on tax cuts, deregulation, and tariffs in that order. And obviously, we started with the last thing first, and that's kind of the big issue, in my opinion.
Because as you know, Neil, the last thing is the thing that Trump can do unilaterally by himself. You recently had a piece out where you talked about Trump's recent comments around Powell, soothing comments around China, and you said that Trump is starting to, quote, feel the market. But at the end of the day, the tariffs are in place when it comes to China. How quickly, Neil, do you think that they need to start evaporating, or this is going to get brutal very quickly?
Well, I think we're already there. I mean, there's a lot of interesting comments that the market sort of runs with on any given day. But at the end of the day, just look at what's going on. We effectively have a trade embargo in place with one of our largest trading partners. And the primary debate right now seems to be whether are they talking or not talking? Are they fake talking? Are they talking through back channels? I mean, it's a little bit ridiculous. Just focus on what's actually happening. We have an effective tariff rate in the 20s, and we continue to have fairly substantial tariffs on with China. That's effectively resulting in a zero in terms of bilateral trade. To me, that's important, and that's going to mean that inventories are going to be pretty problematic relatively soon, probably sometime over the next month.
Neil, final take. Kevin Walsh, how close are we to installing a shadow Fed chair?
Well, I mean, he has a habit of just, you talk about the blackout period. Mike McKee mentioned that. I find it hysterical that he's out in the Wall Street Journal with an op-ed. But, look, I took a quick read of his op-ed. I think it's ridiculous to really say that the Fed is the reason why we have profligate spending. I mean, remember, when interest rates were zero and the Fed was doing open-ended QE, the government at the time was going out on an austerity budget, and we talked about sequester and all that. So I think he has the cause and effect wrong. I mean, the reason why rates were so low was because probably there was austerity, not the other way around. I think talking about firing Powell is bad. Replacing him with Kevin Walsh wouldn't be much better.
Neil Dutter of Renmark, with a strong and powerful punchline at the end there. Neil, thank you, sir. Appreciate it. On Kevin Walsh in the Wall Street Journal.
Right, but he did talk about the fact that there is a terrible fiscal trajectory, but he said this: I struggle to absolve the Fed, basically, of the nation's reckless spending. Neil has been very consistent on Kevin Walsh. When his name was floated to become Treasury Secretary, then the whole idea was actually he'll save for the position of Fed chair. He's clearly on the short list, but Neil's point is this is someone who actually is hawkish when it comes to whether or not he wants to cut interest rates or raise them. That is something that does not jive well with President Trump.
Historically, that's certainly been the case, that's for sure. Lotfi Karui there of Goldman Sachs joins us now for more. Lotfi, welcome to the program, the head of credit strategy over at Goldman Sachs. Lotfi, I'm not going to ask you about that, don't worry. We're going to talk about credit. Let's talk about where credit is at the moment. And I think the big question, what investors are willing to pay for US assets. Has there been a major reassessment or not?
Well, based on last week's price action, no. Actually, if I take high yield spreads as an example, we're back below 400 basis points, which is, no matter where you stand in terms of where the effective tariff rate is going to go, this is not the adequate compensation that you should demand in the face of the current path of the macro environment here. So the answer is no, as far as spreads are concerned. Now, I think we've talked about this multiple times the last couple of years. In credit, there's two conversations. There's a spread conversation. There's a yield conversation. I'd be more constructive on the value proposition of credit from an all-in yield or total return standpoint. The math is actually quite simple. Take investment grade as an example. You're being paid a little less than 5.25%. I would consider that to be actually a pretty good value proposition. If tomorrow we have a recession, it's very likely that whatever widening you're going to have on a spread component will, to a very large extent, be absorbed by the base yield or the treasury yield component. So it depends how you see it.
So it matters what lens you're looking at this credit market through. Let's look at it through this lens. The economy is about to break down. The hard data is about to catch down to the soft data. What does it mean for you then?
Spreads should go wider. Look, we are, I'll take high yield as an example again, 400 basis points. You're probably below the first quartile of the last 25, 35 years. If you see that catch down where the hard data actually, catches down with the soft data, then we think spreads should, at the very least, go back to levels that are more in line with historical medians. And by the way, we touched those levels about a week and a half ago, and we were there already. So you should, I think, the path of least resistance should be for some rebuild of premium.
Is that not going to happen outside of the U.S.? Is that almost the haven right now, given that there is less volatility, at least from a policy perspective, generating from the likes of Europe?
Yeah, I mean, look, that's definitely a big debate we've been having with investors. I will tell you, a lot of folks actually push back on that idea, and a lot of people have in mind sort of the playbook of 2018, which, by the way, pales in comparison relative to what we have today. But a lot of people think, look at that episode and say, oh, actually, back then, U.S. assets did better. So, you look at the dollar market in credit, it outperformed the euro market. I would take the other side of that argument today. I do agree with you. I think the U.S. feels like the epicenter of the shock today. By the way, if you look at relative performance of U.S. stocks or U.S. credit versus Europe, the outperformance of Europe has been largely preserved after April 2nd. I don't think it's reasonable to expect Europe to tighten while the U.S. is going wider. I mean, that would be highly unusual. But I think in relative terms, you should expect the euro market to outperform sort of its beta relationship.
Just to build on that, there was a theme for a long time, a mantra, don't fight the Fed. Everyone said, don't fight the Fed. Now, the Fed isn't in a position to be cutting as aggressively as, say, the ECB, the Bank of England, the Bank of Canada, I mean, the Swiss National Bank. At what point don't fight everyone else but the Fed because they're going to be cutting more aggressively?
I mean, that is precisely one of the reasons why I prefer the euro market relative to the U.S. market, because the ability of the ECB to step in and provide easing is just stronger than the Fed. I mean, this is not 2018 where the Fed, or early 19 where the Fed was in a comfortable position to deliver those insurance cuts. The reality is this is a stagflationary shock. It just constrains, I think, the Fed in terms of its inflation mandate, and it constrains monetary policy. Those constraints are a lot weaker in the rest of the world, particularly in Europe right now. And so that would be another reason, actually, to look at markets outside of the U.S. in terms of benefits of diversification.
Inside the U.S., is that a bigger risk for the sovereign or the credit?
I'm not in a camp that thinks this is a problem for the sovereigns. And so if you ask me, basically, where will Treasury yields go in the event that we have a negative growth shock, I would say lower. The path that gets you there might be a little bumpier than usual, and the long end of the curve might be a little bit more volatile for a variety of reasons. But I do think that Treasury yields will deliver that hedge that you expect in a bad state of the world.
This, as you know, is a really important conversation and a debate happening on investor committees all around the world right now. What will Treasuries do in that economic downturn? Do you see, and we asked this question in the previous hour, I'd love your take on it, do you see investors treating corporate credit and the sovereign debt as the same thing in one bucket, or are they discriminating between the two, at least over the last month?
Not yet. Not that I know, basically. But I think, you know, people are, even for AA or AAA credits, which are granted are trading with a spread of maybe 15, 20 basis points, I think most people are still drawing a very clear distinction between the sovereign curve and the credit curve.
Well, we were just talking about that with Amanda Lynham. How much of a crowding out will there essentially be with the U.S. government issuing so much debt and an increasing amount? They're going to be announcing some of the estimates for the current quarter today and then giving more details on Wednesday. How much does that matter to you?
I think it matters as far as swap spreads, for example, go. So the relationship between swap rates and Treasury yields, I think, yes, supply drives that a lot. On the credit side, I would actually say we started the year quite bullish, for the lack of a better word, on supply. We were expecting $1.75 trillion, but you're not seeing any M&A. You're seeing actually very little M&A. And so that acts as a self-stabilizing mechanism in credit. And I would say from a net supply standpoint, which I think is what matters eventually, matters more than gross supply, things have actually been quite benign in credit. I mean, certainly in high yield, net supply is barely positive. In IG, it's always positive, but it's much less positive than most people had expected going into the year. So I would get concerned if we see both markets kind of pushing in the same direction, where you have more supply on the Treasury side, more supply on the credit side. Honestly, we're not seeing any of that now.
Lotfi, well framed as always. Good to see you. A clinic on corporate credit with Lotfi Karoubi there of Goldman Sachs. As Lotfi speaks, equity futures turn positive, just about on the S&P 500, turning negative throughout the whole of this morning's session and just turning positive for the first time on the S&P. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara Hackers with more. Hey, Yahara.
Hi, John. Spain's grid operator is holding a press conference to address the major blackout that started about 2.5 hours ago. The blackout impacted power and phone lines, with public transport, traffic lights, and phone services mostly down in parts of Madrid, Barcelona, and even in Lisbon over in Portugal, while trains were also mostly halted. Meanwhile, a suspect has been charged with murder in the Vancouver festival attack. Police say 30-year-old Kai G. Adam Lowe rammed his car into a crowd on Saturday night, killing 11 and wounding dozens. Police said they're confident the incident wasn't an act of terrorism and that the suspect had a history of mental illness. And IBM announcing just now it will invest $150 billion in America over the next 5 years. The company's saying it's part of an effort to, quote, fuel the economy and to accelerate its role as the global leader in computing. The investment includes $30 billion for research and development of IBM's U.S.-based production of mainframe and quantum computers. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next on the program, I know I say this every single week, but this week, seriously, absolutely packed with earnings and economic data. We'll bring you a preview up next. From New York, you're watching Bloomberg TV.
You missed it on Balance of Power.
The statute governing the FTC says commissioners can only be removed for cause. Was there any indication that you were fired for cause?
No, there was no claim of cause, and the statute actually specifically says cause means neglect, malfeasance, or inefficiency, and there was no claim of any of those.
So as we talk about some of those other examples, keeping in mind we are having this discussion with you on the day we got a Fed rate decision, is this directly applicable to what is supposed to be an independent central bank? Is that one way in which market participants should be looking at this?
Yes, that's exactly right, and market participants should be scared. To be clear, there's no legal difference between Jerome Powell and me. In fact, he and I were both originally appointed by President Trump, and if the president can illegally remove me, he can illegally remove Jerome Powell. People should be very worried about that.
Don't miss Balance of Power live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Quite possibly my favorite week of the quarter. When you get those earnings from the big tech names, plus you get a payrolls report as well. Equity futures going into this week just about positive into the opening bout. The opening bout 38 minutes away. Earnings, data, and lots of commentary from this administration coming right up. This quite literally is the busiest week I've read in a long time. Today, executive orders at 5 p.m. Eastern time, plus Canadian elections tomorrow. President Trump holding a rally in Michigan, plus JOLTS data and consumer confidence. Wednesday, PCE data, plus earnings from Meta and Microsoft. Thursday, another round of jobless claims and results from Amazon and Apple. And finally, on Friday, April payrolls to round out the week going into the weekend. Plus, you'll get a lot of news conferences coming from this administration for the first 100 days of Trump's second term in the White House. Happening right now, the White House press secretary, Caroline Leavitt, holding a news conference alongside the border czar, Tom Homan. Joining us now, Bloomberg's Tyler Kendall from outside the White House. Tyler, let's get to it. How many news conferences are we going to get this week?
Yeah, hey, John. Well, we're expecting a lot, and most of them are going to be early, including tomorrow. We're going to expect that Treasury Secretary Scott Bessent will be there with Caroline Leavitt at 8:30 a.m. Eastern. I have to say, I'm here a lot of early mornings, and this is by far the busiest that I have seen the White House before 9 a.m. It's clear that this administration is trying to kick off the day here with some headlines, particularly as we see recent polling over the weekend showing that voters are issuing that concern, particularly when it comes to President Trump's economic policies. Perhaps that's why we're seeing some more coverage on the immigration policies, a polling area where President Trump is doing relatively well. Now, of course, we're going to be watching ahead of tomorrow. Treasury Secretary Scott Bessent, I will say that he came and spoke to us reporters earlier today. He said that there will be a tax meeting, something that we've been covering all morning, because this administration is really putting up the pressure, ramping up on lawmakers as they come back to Washington today to try to get done that reconciliation package that this White House really is banking on to fulfill the rest of its economic agenda when it comes to tax cuts.
So it sounds like the Treasury Secretary will be hosting the Big Six. Then you have the Speaker going over to the White House with a meeting with President Trump. Tyler, this timeline, getting it done Memorial Day, outline to us why this is so difficult.
Well, it's considered to be incredibly ambitious because we have to keep in mind this is being done through the reconciliation process. That means that there's very little room for error here when it comes to Republicans because they can't afford to lose any votes because they're not going to have the help of Democrats to get this through. Now, our reporting indicates that we could likely see a different sort of date pushing Congress forward, and that would be a revised X date from the Treasury Department once they get in more of those tax receipts to show when the U.S. is expected to ultimately default on its payments. And that could potentially be really the deadline that is pushing lawmakers here. Because one thing is for certain, this White House wants to see this done as quickly as possible. But whether or not they can agree on tax cuts, but also keep in mind the spending cuts that are going to be included in this bill, which is very, very politically fraught at the moment, particularly when it comes to potential cuts to Medicaid, just really remains to be seen. But both chambers are going to have to agree here with some pretty difficult conference members that have to agree to.
Tyler, appreciate the breakdown. More from Tyler Kendall throughout today on Bloomberg TV and on Bloomberg Radio. Bramo, what a week. Earnings and data. If you could pick one right now, what would you take?
Absolutely earnings, because right now we're looking at the forward look and potentially how companies are spinning this forward. You said that this is the busiest week in a while. The busiest week with stuff we can sink our teeth into and get some concrete information. And that's the key. Can some of the other stuff overwhelm some of that granular data that we keep getting throughout the week?
Do you know what I'd take? The president's drafts on his Truth Social account. That's what I'd take.
You think that they have drafts?
I still believe that the fate of this market, this economy is in the hands of one man and the social media account and whatever comes out of these talks.
Absolutely. When it comes to trade, what comes out of these talks is very important, whether or not he's actually having this conversation with Xi Jinping or it's, you know, just negotiating tactic. The tax policy is going to be interesting. Scott Bessent telling reporters like Tyler, they're all going to be in there. No tax on tip, overtime, etc.
Equities turning positive. Looking forward to navigating this week with you. Coming up tomorrow, Brian Nick of New Edge Wealth, Savita Subramanian of Bank of America, Kathy Jones of Charles Schwab, and Kathy Boschanczyk of Nationwide. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Mayuka Ichiyama clinched her first top 25 win as she took out third seed and recent champion in Charleston, Jessica Pegula, in straight sets. The victory also marked the first time the 23-year-old has won 3 consecutive matches on the WTA Tour. And don't forget, you can watch all the action live daily on Tennis Channel.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
In case you missed it, on the close.
I think our sports fund is very exciting. We've invested in a number of new leagues that are doing exceptionally well. A number of the investments we've made, we've already seen prices that have gone up already about 50% plus. So what you find in new leagues and new teams is if you're right, it's going to grow exponentially, right? So the whole key and the nice thing about that is you see the ratings the next day. So I can tell you if it's grown, like we've invested in PBR and professional bull riding. That league is growing 30% plus a year.
There's professional bull riding?
Yes, do you want to get on a bull? You'll end up, if you could stay 8 seconds.
I know, this sounds awesome. Do I have to go I don't have to go to rodeo for that. That's
no, you could do it. We are here in New York.
Okay.
We own the New York Mavericks, so you can come anytime you want to go.
Okay.
Come, you'll love it. Yeah, we'll chat offline.
Don't miss the close, live every weekday.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good Monday morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Shonali Basak.
And I'm Katie Greifeld. Bloomberg opened.
And coming up, it's the busiest week for S&P 500 earnings, with companies worth $20 trillion set to report results.
Plus, we have a wave of eco data, including the jobs report this week, to show how the economy performed during President Trump's first 100 days.
Meanwhile, a vote of confidence. IBM plans to invest $150 billion in America over the next 5 years. All of that and more coming up. Let's get specific here and look at some stocks. We start with NVIDIA dropping pre-market after a report that China's Huawei is getting ready to test a new AI processor that it hopes can replace some products made by NVIDIA. You can see shares a little bit lower right now.
All right, also, Boeing is climbing today as Spirit AeroSystems makes a deal with Airbus that will lead to Boeing's acquisition of Spirit pending regulatory approval. So a lot of moving parts, but the bottom line is Boeing up 2%.
And let's take a look at big tech, where it's headed to start the week, because 4 of the Magnificent 7 stocks report this week, which is the busiest earnings week for the S&P 500 this quarter.
Yeah, specifically, we're going to hear from Meta and Microsoft on Wednesday after the bell. Then we have Apple and Amazon on Thursday. Bloomberg's Tech's Caroline Hyde has more on these high expectations for these numbers. And just to put that in context, so the Magnificent 7, Caroline, expected to deliver an average of 15% profit growth this year. That forecast has barely budged since the start of March, which feels like a long time ago. So the bar is still quite high.
It certainly is. You've seen companies, well, the analysts out there, downgrading the price targets. But we really haven't seen a budge in terms of earnings expectations. And I think, well, Dan Ives put his note out over the weekend just saying there's so much fog. This lack of clarity means even analysts, yes, you see them, Amazon in particular has been downgraded on its earnings for look ahead by about 2 percentage points over the last 4 weeks. But really, it's very resilient. What's going to be interesting about this fiscal quarter is the pull ahead. For the likes of Amazon, how many people have rushed out and bought goods on Amazon because they're worried that the price is going to increase? Now, according to Bloomberg Intelligence, about 70% of all Amazon products and from their third-party sellers come from China. So no wonder we're all worrying about the price points that are going to go up. So how much is there a pull forward there? How much is there a pull forward when you think about what's happening over at Meta? Now, remember, they get VR and AR over from China as well. But what's going to be worrying for the likes of Meta is how much are Shein, how much are Temu, how much are Chinese retailers, and retailers more broadly, cutting back on their advertising. Microsoft's probably going to do okay because it's all about Azure, it's all about cloud, it's all about us still using AI. But then you look at Apple, how much are they going to have seen a pull forward in terms of us rushing out to get our iPhones and our various equipment? again, worrying about prices.
Well, what I'm waiting to see is how many of these companies are going to be cutting costs drastically. We heard from Dow Chemical, we heard from Boston Scientific, we heard from Procter & Gamble, we heard from so many companies last week that they're doing anything in their power to cut costs. And that means reducing headcount, that means not opening new factories, that means maybe putting off leases for AI data centers. So what do you think we're going to hear from the big ones?
And look, you have been leading the charge on the worry about leases and AI leases being cut back in January, when we were just worried more about the deep-seat concerns that arose in February and in just an over-exuberance rather than what's happening in the macroeconomy. But then you look at Alphabet. End of last week, they still stuck by their $75 billion capital expenditure. Most analysts think that they're going to remain committed to the extraordinary amount that they're all going to be spending, whether it's Meta is one of the biggest spenders, Amazon's one of the biggest spenders, and of course Microsoft is too. The data center rollout is still going to probably look relatively resilient because it's long-term in nature. But in the short term, how much we're going to see once again a focus on cost-cutting and cost control from a headcount perspective. Remember, Amazon's been on this years-long focus on trying to strip out middle people, trying to ensure that they get to do more with less from a personnel perspective.
Caroline, we thank you so much. That is Caroline Hyde of Bloomberg Technology. More on that at 11 a.m. for Bloomberg Technology. We're going to bring you back to the trade front. Cargo shipments from China to the U.S., they're plummeting by as much as 60% as tariffs begin to impact supply chains. And this weekend, President Trump sounded hopeful for a deal.
They want to make a deal, obviously. Right now, they're not doing business with us. You know, people talk about going cold turkey with China, meaning just forget about it. We were losing hundreds of billions of dollars a year with China, and now they're not doing any business with us, you know, not because of them, because of me. Because at 145%, you can't do business. But something's going to happen that's going to be positive.
Meanwhile, China today said it is not in trade talks with the United States right now. And Treasury Secretary Scott Bessent says it's up to China to de-escalate because they sell 5 times more goods to the United States. Bloomberg's Tyler Kendall has joined us now from the White House. Tit for tat, where do we stand right now, especially given the latest comments from the Treasury Secretary?
Yeah, hey, Shonali. Well, the disconnect between Washington and Beijing is continuing. You mentioned China's foreign ministry. They're saying that there are no talks currently happening. But then the Treasury Secretary this morning said that, quote, all aspects of the U.S. government are engaged in talks with China. Now, I did shout a question to the Treasury Secretary when he was done here at the White House, asked him who exactly is the point person leading these talks. He did not answer, but we do know from our Bloomberg News reporting that an important precondition for Beijing was that somebody else other than President Trump be appointed the point person to lead these talks. Now, the Treasury Secretary himself did say that he was in touch with his Chinese counterpart last week during the IMF spring meetings, but we did not get a readout of that meeting like we have with some of the past meetings that he held last week. He did say, though, that they discussed financial stability. It appeared, according to him, that trade was not the main focus of those discussions. Still, this White House is reiterating they think that a 145% levy that's currently imposed on Chinese goods is very high, amounts to a trade embargo, but at the same time, they want to see China ultimately take the first move here. We're going to have to remain watch to see how this develops. Scott Bessent called it a special negotiation separate from 17 other countries that the U.S. is negotiating with. He said that we could expect the technical details of some framework agreements with some other trading partners, particularly Asian countries like Japan, India, and South Korea, to be announced as soon as actually this week.
Yeah, well, let's talk about that a little bit more because we heard from the White House press secretary a couple of minutes ago saying that Treasury Secretary Bessent is scheduled to join the press briefing on Tuesday at 8:30 a.m. Wondering if there's anything to read into that, Tyler.
I mean, potentially. I have to tell you that I'm at the White House early often, and this is the busiest I have ever seen it. It is clear that the White House is trying to start the day early with some of these headlines, particularly as we start to see polling come through that shows that Americans are growing increasingly concerned when it comes to President Trump's economic plans amid the tariff fallout. Now, we could expect to see some of these details. It really does remain to be seen. They are telling us technical details are being worked out this week when it does come to those 3 trading partners, India, South Korea, and Japan. But also, we're not quite sure exactly what is going to be in those framework deals. It's sort of serving as like a letter of intent almost that they are going to put this deal in place. Potentially we could see revised tariff rates, and then ultimately they will work towards a larger, longer-term deal down the road. Now, with that said, we're still waiting for clarity on exactly what the administration is looking for, but Bloomberg News is reporting that at the moment they are now putting forth a more concrete framework for these discussions that will have specific columns that they're trying to tick here when it comes to tariffs, non-tariff barriers, barriers, but also digital trade is one of them, as well as economic cooperation. So we're starting to see maybe some of the contours of those deals emerge.
All right, Tyler, thanks very much. Bloomberg's Tyler Kendall reporting for us from the White House lawn, standing in front of a slew of posters of people that the White House has, that President Trump has deported. It's going to be a busy week of economic data ahead, from PCE, inflation, to GDP growth, to Jobs Day on Friday. Here with a look at the week ahead is Bloomberg's Mike McKee. So, Mike, what do we expect?
You remember economic data? We used to have economic data move the markets. I think this week it's going to be between Carol and me, the tech company earnings or the economic data. We'll see how the markets react to this, but it's going to be a very busy week. We've got trade tomorrow, and that's going to be something people are focused on from now on, basically looking at imports. JOLTS, not so important now, but consumer confidence. What are consumers doing these days? Wednesday is what I've called acronym day, ADP hiring, GDP, economic, the employment cost index, and the PCE inflation numbers, along with income and spending. Thursday, jobless claims, and ISM manufacturing. Everybody's going to want to see what new orders look like there. Are we seeing businesses pull back on spending? And of course, Friday's Jobs Day. Everybody's going to be paying attention to that. The good news, though, no Fed speak this week. The Fed is in its blackout period ahead of next week's jobs. So you can see all the Fed speakers there on the screen. Everybody gets to take a break from that.
Well, one thing that I find very challenging to parse through is that you have the confidence data coming in earlier in the week and then the jobs data at the end of the week. So paper covers rock, does it not?
Well, the interesting thing about all this is a third one you mentioned is the consumer confidence numbers tomorrow from the Conference Board. A lot of what they incorporate is people's feelings about the labor market. And economists have said over the years that when people say jobs are hard to get, that's when you start to see the job numbers go down. So we'll see if there's any kind of correlation there. And we'll also see what the manufacturers are saying about employment.
All right, Mike McKee, we're going to see a lot of you this week.
Lucky you.
That is Mike McKee, of course, our international economics and policy correspondent. Meanwhile, check on this market ahead of a very consequential week. You can see in the pre-market, not too much higher, but a little bit on the S&P 500, coming off a 4.6% weekly performance last week. The NASDAQ 100, the Russell 2000, also quiet, but still modestly higher. Now coming up, betting on America. IBM announcing a $150 billion investment in the U.S. We'll discuss next. This is Open Interest.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom Mackenzie in Paris, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Let's get to high interest, look at what's making headlines around the world. Most of Spain and all of Portugal were hit by a major blackout that impacted public transport, power, and phone lines earlier today. The government is trying to determine the cause of the outage. Companies in Spain sent workers home, and the streets of major cities quickly filled with people, with police controlling traffic. A countrywide blackout is very unusual for any European country, with no event like this in Spain in recent memory, so we'll continue to keep you updated on that. Voter discontent with President Trump's economic stewardship is sinking his popularity as he approaches the symbolic 100th day of his term tomorrow. Polls from outlets including NBC, ABC, and Fox News show that voters perceive Trump to be falling short on his core campaign promise to strengthen the economy, with only 39% of Americans approving of his economic stewardship. Trump's strongest polling issue is on immigration in most of the polls, which is why they've dotted the White House lawn with those posters of people they've kicked out. The discount Chinese retail app Temu is passing on nearly all of Trump's new import taxes to U.S. consumers. It will more than double the cost of some products, and in some cases, the taxes are higher than the products themselves. A $19.49 power strip, for instance, attracted $27.56 in import charges, nearly 1.5 times the price of the product. Fast fashion giant Shein is also raising its U.S. prices with hikes of more than 300%, Shanali, for certain items.
And Matt, I'm going to bring you a story now on IBM being the latest company to announce a multi-billion-dollar investment in the United States. And it is a large sum. It will invest $150 billion over the next 5 years to bolster U.S. tech innovation and manufacturing. The company saying, quote, today's announcement reaffirms IBM's unwavering commitment to the future of American innovation, igniting new economic opportunity in the United States and around the world. Joining us now, Mandeep Singh of Bloomberg Intelligence. My question about this sum looks large, but is it a new amount of money, or is this largely symbolic?
Well, so when I compare this announcement to Apple's $500 billion announcement, it kind of shows that these are the two companies that probably weren't investing as much in AI capex when you compare them to the 4 or 5 big hyperscalers, which will be spending almost in excess of $350 billion in capex just this year. So from that perspective, I mean, Apple, IBM kind of joining the party, and most likely AI capex related investment makes sense. It'll be interesting to see what are the areas they invest in, because we know with the 4 hyperscalers, it's all AI capex, getting that training and inferencing capacity. I'm not too sure whether IBM is that big of a player or wants to be as big of a player when it comes to the AI infrastructure. So those are the details we don't know about.
And symbolic or not, we know that that has certain currency with this administration. So interesting to see this list of companies coming out. I want to talk to you about a story that the Wall Street Journal broke over the weekend that certainly made the rounds. That is that Huawei is set to test a powerful AI chip that it hopes will eventually rival NVIDIA. And you combine this with DeepSeek from a couple months ago. It just feels like these existential questions are piling up for our tech giants.
Yeah, so in the case of NVIDIA, we know they're not allowed to sell the H20s anymore. And in that case, Huawei is filling up the void. And the case in point we have is what they have done on the smartphone side. Remember, Huawei launched their own chip. They used it in their own smartphone, and they have taken share from Apple. So if that is the playbook that, investors can see, then clearly, the Huawei chip, and we know with AI, NVIDIA is pretty much the dominant player on the training side. On the inferencing side, everyone is trying to make a dent in terms of capturing some share. So maybe Huawei does have a play when it comes to AI inferencing, and I think that's what they're going after. It'll be interesting to see whether these models run as efficiently on Huawei chips, but clearly they have proven the chops on the smartphone side.
What are you hearing about job cuts? I mean, we led on investment, and we're talking a lot about CapEx, but it seems in this earnings season that CEOs are saying the one lever that I can control myself is costs.
Intel, for example.
Yeah, well, Intel, I think, was in a situation, a special situation because...
But Dow Chemical says it's not going to launch a facility that it was going to. Boston Scientific says it's going to watch headcount. You've got, Procter & Gamble saying this is the only lever we have, so in the face of uncertainty, we're going to reduce costs.
Absolutely. I think there is that aspect where when you don't know how your growth is going to look like in the second half, you will slow down. But AI is still the imperative that everyone seems to be focused on. And so far, from what we have heard, these companies, the hyperscalers, have reaffirmed their CapEx. The companies that are piloting these projects haven't really pared back. So to me, that is the key when it comes to, what happens to AI spend. And we haven't seen any pullback so far.
I will also point out Domino's this morning said that it eliminated certain roles in the first quarter. Didn't have a lot of comments on AI spend, though.
Fascinating. We will keep an eye on that, of course. We are now have been joined by Mandeep Singh of Bloomberg Intelligence. My question, guys, is if they'll spend on CapEx but not on jobs in the next couple of months. We'll see what investors really want to see from these companies. Now we're near the opening bells. We're going to begin the trading day with BlackRock's Gargi Chowdhury. Stick with us. She's with us next. This is Bloomberg Open Interest.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Season is here.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Well, Morgan Stanley's Mike Wilson is starting to favor the U.S. over international stocks. He believes that a weaker dollar will support U.S. corporate earnings, helping the American stock market outperform the rest of the world. Now, that differs from opinions from strategists at J.P. Morgan and SocGen, just to name a few. So let's ask someone else. Gargi Chowdhury, she is BlackRock's Chief Investment and Portfolio Strategist for the Americas, joins us at the desk now. Great to see you in person, Gargi.
It's good to be here. Thank you for having me.
So I want to hear your opinion on the state of U.S. exceptionalism, because it's been one of the hottest debates over the past several weeks, and you've seen it play out in the stock market.
Absolutely. So we just came out with our second quarter outlook today, our spring investment directions, and we actually tackled this topic. And what we're talking about is in the US, obviously there continues to be a lot of volatility, whether it's around tariffs, whether it's around Fed independence, whether it's just around how much will growth slow down. It's no longer a question of growth slowing down, but how much that's going to be, and whether we're going to see the R word. On top of that, people are falling over themselves to be more non-US focused versus not. So I think the way to think about it is, number one, how are people positioned? So we take a look at advisor portfolios, and we find that most investors are meaningfully underweight international exposures, meaningfully underweight Europe, EM, and we think this is a good time to bring that back up to at least market weight, because this story around other areas of the world continuing to keep up with, or maybe even extend versus the US, might have some legs. The second thing I think investors should think about is around what are the new broader opportunities that this creates. And I think in the US, what we're going to continue to learn this week is around AI. And the theme around AI CapEx, to the extent that that remains, we think that that remains an area of opportunity. And then lastly, I think within the US, just continue to think about maybe reducing your volatility with minimum volatility strategies.
So wait, you think the AI CapEx is going to continue, or at least remain as strong as we expected? Because we've been seeing estimates of like $2 trillion over the next 5 years, right? So, and that was in the run-up of this market, not in the drawdown that we've seen. You still think we're going to see those numbers hold steady?
Yeah, I think we're going to learn a little bit this week. And obviously, just when we look at some of the Mag 7 names, we're expecting to see over $300 billion in CapEx for this year alone. And as of right now, when we look at what has unwound the most this year, even amid slowing growth, it hasn't so much been cyclical. It's been the broader large cap tech names. So what we're telling investors to do is actually think about software as an exposure. And we've seen a tremendous amount of inflows into an ETF ticker, IGV, which we think makes sense in this environment. And then for AI, and specifically mapped to your question around CapEx, we think that that remains for now, but taking a more active approach to investing within AI, we think makes some sense.
So how deep do you dive into this market? We have seen a lot of profit taking. We've seen a lot of risk off the books of hedge funds and other big institutional investors. Do you think it's safe enough to really get in, given the volatility that you expect ahead?
I think when we look at just the volatility, to your point, that we've seen over the last month and a half, I think investors who've completely left the markets and moved to cash have missed out. And when we do investor polls for our client calls, what advisors are telling us, and even institutional clients are telling us, is that they're looking for opportunities to hear from us and others about how to reduce their volatility and yet remain invested. So about 25% of investors that answered our polls talked about looking for strategies to reduce volatility. And we think this is where stay invested in equity markets, in US equity markets, but reduce your volatility with things like the US minimum volatility strategies.
All right, we're going to dive deeper into that next. Gargi sticking with us through the opening bells, and here's the setup as we head into it. You can see the S&P 500 building a little bit on that pre-market rally. Pretty muted moves when you consider the performance that we saw last week, but it's a consequential week of earnings, so we'll see how those lines change. The opening bells are up next. Don't go anywhere. This is Bloomberg.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, you know, we've focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, you know, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller, and it looks like last week's big gains have left some momentum in the S&P futures. Only 0.1%, and less than that on NASDAQ futures. But this week, we're going to get a ton of earnings. In fact, $20 trillion of market cap is going to report this week. So I think earnings, it's fair to say, will overshadow the economic data, at least until Friday when we get jobs. This is weird, right? This is not the New York Stock Exchange. In fact, it's somewhere in San Francisco. There's a cybersecurity conference, and they've decided to ring the bell for the NYSE there. I don't know that I would have made that choice. This is more interesting. On the NASDAQ, Erie Insurance is ringing the bell. They've been in business for 100 years. They've been listed on the NASDAQ for 30 years. And I went back and looked at the performance over the last 3 decades. They're up 5,600%. So more than twice the NASDAQ and more than 3 times, Katie Greifeld, the S&P 500.
Pretty exciting for an insurance company. You mentioned earnings, and you're right. We just have a wallop of earnings this week. 4 of the Magnificent 7 stocks report this week. As you said, that is the busiest earnings week for the S&P 500 this quarter. You can see some of them in the pre-market, or rather just the open market right now. Not too much information to glean from what they're doing today, but it'll be fascinating to follow these stocks over the course of the next few days. Sonali.
I'm looking at Boeing over here, Katie. It's up 3% at the market open. They're climbing as Spirit Aerosystems makes a deal with Airbus that will lead to Boeing's acquisition of Spirit pending regulatory approval.
Yeah, that's a little bit difficult to wrap your head around, but we're going to get to Benny Camel in Berlin to explain all of that for you. NVIDIA is falling, see, less than 1%, but it's a very heavy stock. This after a report that China's Huawei is getting ready to test a new AI processor it hopes can replace some products made by NVIDIA, which is already facing issues in China, export blocks as well as import problems. We are back with Gargi Chowdhury, BlackRock's chief investment and portfolio strategist for the Americas. And Gargi, I'm looking at this week of earnings and waiting for the outlooks, if they don't cancel their outlooks. You know, I'm looking to see how many companies are going to be cutting costs, because that's the one thing they can control, right? It's like a corporate serenity prayer. So what do you expect in terms of companies facing uncertainty?
Yeah, so we've looked at all of the companies that have reported so far, and obviously the negative sentiment has picked up meaningfully, and we're looking at words like uncertainty and volatility and lack of words like optimism. You have seen that. What we haven't seen yet is any direct talk about cutting in the way of labor market resizing. So we haven't seen that yet, and maybe we haven't
seen big layoffs.
Right, we haven't seen that yet, and maybe that's yet to come. One of the things that we are looking for is just around how many companies are just not providing a guidance anymore. And I think that's bad news. And I think to the extent that we get more and more of that, it's going to be really hard to justify what your PE is or might be, because you don't know what that earnings is. So that's what we're looking at, I think, and a continued uncertainty, questions about layoffs and right sizing, and then continued focus on whether companies are able to move their guidance lower or not.
I want to talk specifically about sort of the estimates, because guidance, who knows, and I have a lot of sympathy for the C-suites trying to put together their forecasts for 2025. But this is a stat that we were chatting about with Caroline Hyde. You think about the Magnificent Seven, still forecast to deliver an average of 15% profit growth for the year ahead. That's very similar to the start of March, and the world has changed pretty dramatically since the start of March. And when it comes to the earnings picture overall, that's something that we've heard, that you need to see these estimates come down, that heading into the heart of earnings season, the bar is still really, really high.
It is really high. And if you look at our investment directions in our first, in our equity outlook section, what we talk about is what you would have to believe for you to expect equity markets to continue to rally from here. What kind of expectations of earnings growth would you have to believe that we're going to get, and what kind of multiple expansion? Now, at this juncture, we're no longer at the richest end when you look at what our PEs are, but we're around normal to slightly rich, and earnings expectations right now still at double digits, low double digits, but still at double digits. Maybe that comes through, but hard to see, especially if we see real GDP slow down meaningfully. So that is why we think at this juncture, reducing the volatility of your portfolio, moving to certain defensive sectors, and then using parts of the fixed income market as a portfolio diversifier, as well as liquid alternatives and gold as areas of opportunity in the market.
As much as I want to bite into that fixed income point, I do feel like I have to stick on earnings, because even beyond big tech, it's actually 180 companies reporting this week alone. Wow. So I want to pull up what the S&P 500 has been doing by sectors, because you're seeing a lot of pain in most of them, particularly consumer-heavy ones. You look into consumer discretionary, actually Tesla's not even your worst performer there. And so
it's amazing how defensive this is. I mean,
very.
Only the things you need are gaining, right? Yeah. Staples, utilities, and healthcare.
Yeah, for the year. And Bloomberg Intelligence is saying that consumer sectors are starting to show cracks. Sales misses have surged. Guidance is the worst in Bloomberg Intelligence's records going back to the pandemic. So how bad really can this week get when you look at the consumer sector really dragging down the rest of the index?
I don't know about how bad. I mean, obviously we don't know that yet. I think what we've seen over and over again is that there is a lot of cash on the sidelines, and investors are looking for opportunities to buy dips. Those dips have to be pretty significant, though. I don't think it's a 3 to 4% dip, but I do think if we get back to a point like we saw in the beginning of April, where we did see some major pullbacks, a major re-rating, I think there are opportunities, there are pockets of opportunities, and I think software is one. I think, again, some of these very high quality, strong balance sheet AI companies are other, and again, pockets of healthcare, which is another area of the market that we like, that can provide that opportunity when there is that pullback. But if you're looking at your portfolio today and you're wondering what you should be doing, and you're concerned about earnings continuing to falter, or you're concerned about growth numbers, obviously we're getting Q1 GDP this week, you're worried about that, maybe having even a negative print in front of it, what should you do? And this is where we think about maybe reduce the volatility of your portfolio, don't move to cash, reduce your volatility, move to more defensive sectors, add some diversifiers, and stay invested.
We have had, though, some pretty dark forecasts. I mean, Torsten Slok sticks in my head with a barrage of data over the last couple of weeks on his voluntary trade reset recession, right? He says 90% chance. And over the weekend, Ryan Peterson of Flexport says that ocean container bookings from China are down 65%. If you look at a map, Bloomberg has a fantastic terminal function, Maps Vessels Go. You can see that all of the dry goods container ships are holding on the Chinese coast and not coming here. it seems pretty dire to me, right? Empty shelves.
Look, I do think that we haven't yet begun to see the impact of some of the ideas that you're talking about in the market. We really haven't. We've seen the soft data be pretty weak, but the hard data, even if you looked at the durable goods number last week, has been pretty resilient. As we get into the meat of Q2 and as we begin to see some of the impacts of consumers feeling the stresses of higher inflation and higher prices, as we begin to see that in the actual hard data and in people's experiences in shopping and buying things, I think that's going to have an effect on equity markets. I do not think that has happened yet, and which is why I think investors should get ready, start preparing a more defensive portfolio, and look at areas of opportunities within fixed income and gold and other liquid alternatives to build that more resilient portfolio at a time when we do think growth will slow down from the very robust levels we saw last year.
I think that soft data, hard data dynamic is really interesting. I think it'll be really put to the test this week, and it is one that the Treasury Secretary in particular has been warning against. Don't worry about the soft data when the hard data is holding up, right?
Don't look behind the curtain.
Right, the politicized curtain.
I mean, to be fair, you've heard similar things from the Fed, maybe not in those terms, but they're looking at the data that they have, and to them, that largely means what we're going to see with PCE.
They'll wait for a recession to cut rates, right?
Exactly.
That's how it goes.
But when you talk about higher prices, something that I thought was telling was we had Domino's earnings this morning. One of the things they said was that the higher prices, they actually raised their prices, that was more than offset by negative traffic, and that sort of mixed there. So I hear what you're saying, prepare a defensive portfolio, but it seems like even the trade down sort of trades aren't necessarily working with higher prices.
Yeah, I do think that we haven't fully realized the impact of higher prices in the markets yet. One of the things that we look at is, what are inflation break-evens doing? And one of the things that the Fed has been very comforted by is the stability of long-term break-evens, and we're all comforted by that. But is this a time for investors to be concerned around those higher prices and add some inflation protection? We think so in the very front end of the curve. Buy some real rates because those are still attractive and they've moved significantly higher. I think that right now this has all been something we've read off in a paper. It hasn't quite materialized in our actual realizations of our experience yet in the markets or in our personal lives. I think it's about to come. And when that happens, I think you want to be invested, but you want to be very careful about where you're invested.
So what I'm hearing is sometimes the best offense is a great defense. Sgargi, we thank you so much for joining us this Monday morning ahead of a very busy week. That is BlackRock, Sgargi Chaudhary. Now let's get a look at some more stocks on the move with Bloomberg's Isabel Lee. Isabel.
Hey, Shonali, we're looking at Domino's. So we have the company's revenue that slightly missed estimates, but we have the profit that was higher year over year. Ahead, we have Domino's seeing a 2025 operating profit growth of about 8%. And get this, Domino's said it doesn't see tariffs having a material impact on its operational profit. But the company did also say that macro and geopolitical volatility will be affecting international demand. Up next, we have Merck. So this U.S. biotech firm is edging kind of flat. The company agreed to buy SpringWorks Therapeutics to boost its healthcare division for $47 per share in cash. So this represents a total value of around $3.9 billion and a 26% premium for SpringWorks. So SpringWorks is a maker of medicines for cancer and rare diseases. And this purchase is expected to boost Merck's overall healthcare division because SpringWorks has a drug portfolio that's already approved by U.S. regulators. And lastly, we're looking at Airbus. So this is an interesting acquisition. We have shares edging higher by around 5% for Airbus and for Boeing also as well, around 3%. So if Europe's Airbus agreeing to take over some assets and sites from Spirit AeroSystems, and this clears the way for Spirit to really be acquired back by Boeing, its former parent. So the deal includes Airbus taking over facilities in North Carolina, France, Ireland, and Scotland. So the Airbus deal is really a part of this complex three-way transaction that reunites Boeing with Spirit. And we have Bernstein upbraiding Boeing, saying it is now making, quote, progress that it needed for the growth trajectory. Back to you.
All right, Isabel Lee, thank you for that roundup. Isabel mentioned the Merck SpringWorks deal. I'm pleased to say we'll be speaking with Germany's Merck CEO next hour. But coming up, cargo shipments from China to the U.S. are plummeting, and a U.S. supply shock could be on its way soon. Matt Miller has an awesome chart to show you. We'll bring it to you next. This is Open Interest.
let's cut right to it. This is Bloomberg's new show, Primer. Technology is a $1 trillion game. Won, lost, won again, just by backing the right science at precisely the right moment.
My life has been focused on how can you elicit intelligence from brain cells in a dish.
This is the fundamental building block of our fusion technology.
We're doing things that have never been done by anybody, ever.
Everyone is selling the future. If you want to understand what's coming, you'll want to watch Primer, because details matter.
Lasers on?
So do lasers.
There we go.
Oh, and it's on all these lovely channels. Hope you're jotting this down.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up to the minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Luanda, Angola, and this is Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, Eli Lilly getting double downgraded to a sell over at HSBC. The analyst says that there's too much optimism in the share price and that the risk reward is not attractive. Next up, we have Jack in the Box getting upgraded to a buy over at Stifel. The analyst says the new CEO has created a plan to strengthen the balance sheet. Apparently, Stifel thinks it's a good one. Shares up 2.8%. And finally, we have Rhythm Capital getting raised to a buy over at Piper Sandler. The analyst says that the stock is overly discounted, and we'll be talking to the company's CEO next hour, Matt Miller.
All right, I'm looking forward to that. But right now, I get to show you the awesome Bloomberg function, Map Go. And if you type Map Vessels Go, you can see a whole bunch of ships around the globe. You can eliminate passenger ships and look at those just carrying dry goods. And you'll notice that they are all stationed right off the coast of China. They're no longer setting sail for the U.S., which is what we heard from Flexport over the weekend, that 65% of shipments are down, that 25% of the sailings over the past 2 weeks have been canceled. And this, Shonali, is a real problem for the U.S. economy, or will turn into one in the next couple of weeks.
Yeah, you really can see the satellite imaging showing you the clusters in China relative to the U.S. Amazing map. We'll keep an eye on it throughout the course of these tariff tensions. Now, fast fashion giant Shein is raising prices ahead of imminent tariffs on small parcels. Items from cleaning towels to wax strips are all seeing hikes as high as 2,000%, some even as high as 377%. For more on how this will impact consumers, we are joined by Poonam Goyal of Bloomberg Intelligence. We've heard similar stories from Shein, to some degree from Temu as well, but what about U.S. companies? When does this phenomenon hit Amazon in particular?
So it's already hit Amazon. We just don't see it. They're absorbing the price increases. We've heard from Amazon that they are going to keep prices low for as long as they can before pushing them off to consumers. That said, third-party sellers are raising prices because the 145% increase that they're facing in costs from China are impacting their bottom line. A big price increase will come this summer if we don't find relief to these current tariff levies that are placed.
And when you think about the ripple effect, like you said, I mean, you're already seeing it with Amazon. To see these moves from Temu and Shein, Matt, I think you called them the dollar stores of the internet in our morning meeting. But does this give an Amazon, for example, more room to pull that lever? Does it make it a little bit more palatable for them?
It does, yes, because now the competition is almost level setting the playing field, right? But that said, you also have to keep in mind that Amazon isn't just up against the Temus and the Sheins of the world, but also up against the Walmarts of the world. And Walmart had said that it will also push the pedal on price when it comes to keeping it low for its shoppers. So there's a lot to think about here. That said, when you think about Amazon, they have the deep pockets, right, that small retailers don't have to go ahead and absorb some of that pain more easily. And I think they'll try to for as long as they can to make sure that the consumer stays and doesn't have to deal with higher prices, at least not at the level that you're seeing against Temu and Shein.
Yeah, it's going to be difficult for small businesses, and unfortunately, they do 80% of the hiring and CapEx in this country. Poonam, thanks very much for joining us. Poonam Goyal there from Bloomberg Intelligence. Coming up, Airbus clears Boeing's path to Spirit. That's next. This is Open Interest.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. After a 4-day rally of more than 7%, the S&P is still gaining. So I guess it's a 5-day rally now. It's more modest, only 0.25% higher on the S&P 500 right now, only 0.2% higher on the NASDAQ. The only earnings we've gotten so far really is Domino's Pizza. But this week is going to be the biggest in terms of market cap of the entire quarter, $20 trillion. In terms of the movers, NVIDIA, the big heavyweight right now, down almost 2% after that Wall Street Journal report that Huawei will challenge them on chips. But Apple is up 0.5%. These are the, I guess, the Magnificent Seven chiclets here. Amazon is up barely, Meta up a little bit. Here's a story we're going to talk about with Benny Campbell in just a moment. Boeing up almost 2% after it's getting approval or working out the math to buy Spirit because Airbus is going to pick up a piece of that. Katie, you want to pick up on this story?
Yeah, let's get some more details here because like you mentioned, Airbus has agreed to take over some assets and sites from Spirit Aerosystem. This theoretically clears the way for the struggling U.S. aerospace supplier to be reacquired by its former parent, Boeing. So let's try to untangle this web now with Bloomberg's Benedict Kamal. He leads our global aviation coverage. So walk us through the logic here. This seems like it's really good news for Boeing. Why does it make sense necessarily for Airbus?
Good morning. Yes, it's a fiendishly complicated deal. So we have Airbus on one side over here, and we have Boeing on the other side, and Spirit in the middle. Spirit is principally the supplier to Boeing, but they also supply some components to Airbus planes. And then when Boeing said last year that they would like to reintegrate Spirit after 20 years, Airbus said, well, okay, not so fast. We don't want you owning the workmanship of sort of your biggest rivals. So they started sort of trying to untangle the operation, which is why it's taken almost a year to get this over the line. And then today we got the announcement from Airbus saying, okay, this is how we're going to do it. They're going to take over assets in the US, in Belfast, in Ireland, in Scotland, possibly in Malaysia. So really all over the map, making components for the A350 wide-body aircraft, for the A220, the smaller plane. And then step number 2 will be for Boeing to announce the closing of their portion of the deal. And then really sort of the cleanup job begins for both companies to get Spirit back to where they wanted it to be, because that's really the logic behind the deal. This is an asset that's important, but there's also been bleeding money, that's been bleeding quality, and Boeing's thinking is, if we get this asset back under our wings, back under the, you know, the protective umbrella of Boeing, then we get a better product here.
Right. My question is, how messy is that process? Because Spirit was spun off of Boeing in 2005. Boeing, of course, has its own challenges at the moment, a transition year, if you will. What does bringing under these Spirit assets really mean for the company, given all the challenges you have outlined?
Well, it'll be expensive for both Airbus and for Boeing to really get Spirit back to where they want it to be. They need the quality to be much better. They need the workmanship to be better. And to remind people why we came to this place, it was a Spirit fuselage that had that blowout at the start of last year where that door came flying out. So that was shoddy workmanship on display, and that really forced Boeing's hand to reintegrate that business. As you say, after 2 decades, sort of financially, it's a value-destructive deal for Boeing, but they had to do this just to gain control again of the asset. Airbus said today that they would put $200 million in credit towards Spirit, so that gives you a sense of just how dire straits that asset is in, just to help them sort of limp over the finish line until they're back on the Boeing books. But this is really a business that needs an injection, both in terms of expertise, but also capital, and that'll cost both companies dearly. We'll hear from Airbus on Wednesday. They'll report earnings after the close on Wednesday, and we might get a better sense then what kind of money Airbus will need to plow into their portion of the deal.
All right, Benedict Kamal out of Berlin, thanks very much for your coverage. Benny runs the global aviation coverage for us out of the German capital, and he's wearing a brilliant tie from Ed Meyer in Munich. I highly recommend checking out that store if you get a chance. Let's look ahead to what's going on this week. Today, Canadians head to the polls in a snap vote called by new Prime Minister Mark Carney. And this week, President Trump marks his 100th day in office. Tomorrow's day 100. It's also the busiest week of earnings season, with 4 of the Mag 7, Microsoft, Meta, Apple, and Amazon, set to report. We're also going to get results from General Motors, Starbucks, UPS, and many more. And then on Friday, it's Jobs Day. This is Bloomberg.
to see over the next 3, 6, 9 months how the tariff discussions play out and what does it mean.
I do factor in some effects of tariffs now on inflation, on prices.
I like the idea of the 10% tariff across the board.
I've spent my entire career focused on fiscal discipline. I don't think these people have the foggiest notion what they're doing. And I think DOGE is doing tremendous damage to government.
Elon Musk is probably the inventor of our age, but who understands that we're in the midst of the most profound convergence among technologies.
When we are facing a once-in-a-generation technological disruption,
we cannot close this retirement gap without private-public partnership. We have to have good policy.
Do you think, Dawn, that the market is correct to be, as of now, pricing in 3 rate cuts in 2025?
I would take the other side of that bet.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asia markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. We begin in Russia, where Vladimir Putin's announced a 3-day ceasefire in Ukraine next week to mark his nation's celebration of the defeat of Nazi Germany in 1945. It comes 2 days after President Trump met with Ukrainian President Zelensky at the Vatican. Correspondent Nancy Cordes from the White House.
Trump told reporters he wants a deal to end the war in 2 weeks or less. But major questions about territory, security, and rebuilding remain.
The White House says President Trump will sign 2 new executive orders today to ramp up his immigration crackdown. Spokeswoman Caroline Leavitt announced new numbers.
Total attempted illegal crossings at the southwest border hit a record low in February, only to fall to another new record low again last month in March.
The Vatican says the conclave to elect a successor to Pope Francis will begin May 7th. CBS News papal contributor Delia Gallagher is in Rome.
Now, what that means is in the morning they will have a mass at St. Peter's Basilica, and then in the afternoon they process, a beautiful procession with the Litany of Saints with songs into the Sistine Chapel, and they have the option of doing one vote on the first day in the afternoon.
Sistine Chapel was sealed today. Spanish utility officials say it could take up to 10 hours to restore power amid a nationwide blackout. The BBC's Joe Inwood.
It seems that the entire network has suffered some sort of massive failure, and we're seeing pictures on social media that show the impact. Traffic lights out. We understand the metro system is out in Portugal, and the railway system in Spain as well.
Play at the Madrid Tennis Open has been suspended. Parts of France also affected. No word on the cause. A boat slammed into a ferry in Pinellas County, Florida last night and got away after killing one person and injuring at least 6 others. Correspondent Manuel Bojorquez reports.
A boat near the city's Memorial Causeway Bridge crashed into the Clearwater Ferry and then took off.
Think of it like a hit and run, but on the water.
The Coast Guard says it has identified that boat. The collision sent the ferry carrying 45 people into a sandbar where it remained stuck. Its roof left in tatters. Wreckage inside showed a scene in complete disarray.
People in parts of the Midwest are bracing for dangerous weather this afternoon. CBS meteorologist Jessica Birch.
The biggest risk today and tomorrow has to do with tornado activity, which is possible widespread throughout the valleys, all the way up into Ohio valleys, and of course back into the plains too, closer to Oklahoma.
Dow is up 195 in early trading. This is CBS News. Volunteers in California spent the weekend fixing up homes owned by people too poor or too old to do the work.
In San Jose, the national group Rebuilding Together brought together hundreds of volunteers to do everything from put on a new roof to painting to landscaping to plumbing. Terry Kiesick wrangled volunteers who were working on one house that had 20 holes in the roof.
You get a solid 20 to 30 people that to show up here physically, and it just everyone leaves here with a good feeling that they did something good for their neighborhood.
Rebuilding Together has 114 chapters around the country, and most of them participated in the 34th annual National Rebuilding Day. Christopher Cruz, CBS News.
A museum in the Netherlands says a child left unsupervised for a moment damaged a $56 million painting. Officials in Rotterdam say there are visible scratches on the underside of Mark Rothko's 1960 gray, orange on maroon, number 8. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube as well, so just head over to youtube.com, search Bloomberg Podcast Live. That's where you'll find us. Alex Steele out today, but not to worry. We got Lisa Mateo. She's here she's always in the studio, so she can help out if we need it. And Matt Miller is rumored to be coming in at the 11 o'clock hour, so batten down the hatches for that one. So we got a lot happening today. Got a little bit of a mixed tape out there on the equity tape. We got a lot to get to. We're going to check in with Brendan Murray, Bloomberg Global Trade Editor, on Trump-China tariffs set to unleash supply jolt to the U.S. economy. That's the concern. Where is the negotiation with China? We'll get the latest reporting there. Sylvia Jablonski, CEO and CIO at Defiance ETFs, discuss her outlook for the market. Anurag Rana and Mandeep Singh, those are the two tech leaders at Bloomberg Intelligence. We're going to get their thoughts on some of these big tech earnings coming up and how the big technology companies are going to be dealing with the uncertainties associated with an uncertain tariff environment. So we'll see what the world of big tech has to offer. So we got a lot coming up in the next couple of hours. Let's kick it all off right here. We'll go to Lisa Mateo and get a Bloomberg Business Flash. Lisa.
You got it in this Bloomberg Business Flash, brought to you by IBKR. Will year-over-year change in U.S. CPI exceed 2.6% in April 2025? At IBKR, forecast rate of the yes recently at 26%. Start predicting today at ibkr.com/forecast. The last trading day for this contract is May 12th. Well, we've got a mixed look right now on Wall Street. Stocks are mixed. This is ahead of a week packed with major earnings from the likes of Apple, Amazon, Meta, Microsoft. as well as more economic data. We have first quarter GDP and April's employment report out this week. So we'll start with the NASDAQ that's down about 0.1%, 23 points. The S&P 500 little changed, up about 3 points. The Dow up about 0.3%, 149 points. The two-year yield 3.74%. That's little change, and the yield on the 10-year 4.26%. That's up about 2 basis points. We have the Bloomberg Dollar Spot Index down about 0.1%. Shares of NVIDIA, they're off about 2%. The reason why, well, the Wall Street Journal says that Huawei Technologies is developing an AI processor that it hopes could replace some NVIDIA products. Then you have Domino's Pizza not delivering. Its shares are off about 0.1%. This is after first quarter revenue missed estimates. And Tesla shares, they're on the rise, are up about 0.7%. The company raising prices in Canada, has its Canadian website encouraging buyers to purchase its pre-tariff inventory. And finally, IBM says it plans to invest $150 billion in America over the next 5 years. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Paul Sweeney live here with you in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Alex is out today, but hopefully back tomorrow. As Lisa was just saying, we got a mixtape out there. Let's get a look now at some of the stocks on the move today. We're joined by Bloomberg's Isabel Lee. Isabel, what are you looking at?
We're looking at Domino's, so it opened flat, but now it's edging slightly higher by 0.5%. We have the pizza maker reporting revenue that slightly missed estimates. So revenue came in at $1.11 billion, 2.5% higher year over year, but ever so slightly lower than estimates, which is $1.12 billion. Profit was higher year over year, though. And ahead, Domino's says it sees a 2025 operating profit growth of about 8%. And get this, the company said it doesn't see tariffs having a material impact on operating profits. So that's really unique compared to others. But it still says that it sees macro geopolitical volatility affecting international demand. So
I don't know the last time I ordered Domino's.
No, I'm going to say college. There was a time when my son is now 29, when he was like 12, and Domino's had just come out with their app. And being a tech-savvy kid that he thought he was, all of a sudden, all this Domino's stuff is showing up at our door. I'm like, nobody ordered this, and we figured out finally who it is. So, but in a lot of parts of the world where they don't have real pizza, that's it.
That's it. Yeah,
that's true.
All right, what else you got?
Merck. So Merck, this is really a stock that's flat right now. So we have U.S. biotech firm Merck agreeing to buy SpringWorks Therapeutics to boost its healthcare division for $47 per share in cash. So that represents roughly a $3.9 billion in equity value and a 26% premium for SpringWorks. So SpringWorks is really just a maker of medicines for cancer and rare diseases. So the purchase is expected to boost Merck's healthcare division because SpringWorks has a portfolio that is already approved by the U.S. and it contributes to treatments to Merck.
How about Airbus? What's going on there?
This is good. We have the stock pairing some of those gains, now edging higher by just 3%, but earlier it was up as much as 5%. So Europe's Airbus agreed to take over some assets from Spirit Aerosystems. So this clears the way for Spirit to really be acquired back by Boeing, its former parent company. So the deal includes Airbus taking over facilities in North Carolina, France, Ireland, and Scotland. So the Airbus deal, it's part of a complex three-way transaction that reunites Boeing and Spirit, and this operation really began in 2005, the spinoff at least. So Bernstein, though, upgrading Boeing, saying it's now making the progress it needed for growth trajectory. So we have shares edging higher by 3%.
It's such an important company for the U.S. economy. I think U.S. prestige, U.S. industrial prestige, in my opinion. So we'll see how that plays out. Isabel Lee, cross-asset reporter for Bloomberg News. Thank you so much. We appreciate that. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere you get your podcast. Let's get back to the trade story, which remains front and center here. It seems like we're in a period where negotiations are happening between the Trump administration and a number of different countries over a number of different tariff measures here. So it's important to try to stay on top of kind of where we are, and we have a good team doing that. Brendan Murray joins us, global trade editor for Bloomberg News. He's in London. Brendan, it seems like the president over the next several weeks, is it fair to expect that we'll get some announcements on trade deals with some of our major trading partners?
Yeah, well, it depends on what you mean by a deal. It's fair to say that we're likely to get a number of announcements
laying out the path for talks for an eventual deal. Trade deals are very complicated. They take a long time to hammer out. And to get anything meaningful, it's going to take a lot of time. But what you could see are some sort of interim proposals, interim agreements that would set the U.S. and the trading partner on that course. Some of those who are sort of have an early lead would be India, South Korea, Japan. These are big export economies that the U.S. wants to trade more with, to reduce the tariff and non-tariff barriers that they have with the U.S. economy. So we could see some action along those lines, but again, to expect anything major, anything fundamentally changing the picture of the U.S. trade imbalances like Donald Trump would like to see is probably a bit of wishful thinking.
Now, Brenda, you said Treasury Secretary Scott Bessent said the administration working on a bilateral trade deal with 17 key partners, but not including China. So where does China stand in all this?
Yeah, well, this is the big, that's the big prize, right? Is some sort of deal with China, and if the U.S. and China aren't even talking, and by all accounts, according to, they're not really having any sort of formal discussions that would lead in the right direction toward a formal sit-down discussion, that you're leaving out a big part of the imbalance, the biggest imbalance that the U.S. has. So you can talk trade deals with Japan and South Korea and India and other countries, but the real prize is that Donald Trump wants is a trade deal with China, and so far they're going nowhere on that.
You know, David Rosenberg, a frequent guest on Bloomberg Surveillance, formerly Merrill Lynch, he's a Canadian, and out with a tweet saying basically, hey, everybody, I know you're focused on China, but you need to figure out something with Canada, because Canada is the big trading partner with the U.S., as is Mexico. Where do we stand, do you think, with Canada and Mexico?
Yeah, well, the Canadians don't sound like they're. Of course, they're in the middle of an election right now, and they don't sound like they're in any big hurry to do a deal. The Prime Minister Mark Carney said the other day, we'd rather have a good deal rather than a fast deal. So we'll see how that election plays out. That could dictate the course of any negotiations. But in the meantime, the Canadian economy is going to suffer. American auto companies are going to suffer because they rely so much on Canadian suppliers. So you could look for a lot more disruption the longer that drags out, with the cloud of uncertainty hanging over it, as it has for several weeks.
And Brendan, what about the big companies, let's say Walmarts and Targets or retailers? They have to replenish their inventories. Where do they stand in all this?
Yeah, so this is a big story we have out today, is that retailers like Walmart and Target, the big ones and small companies, are looking at those 145% tariffs on goods from China and saying, we can't do that. We can't afford that. That's more than twice what we could pay. So we're just canceling orders from China. And so what we're seeing is, in a couple of weeks, when those orders would have already gotten here, we're going to see volumes through U.S. ports go down. We're going to see inventories through warehouses go down. And the big retailers have even said privately to President Trump, according to our reporting, that this could mean shortages and price hikes. So the wave of decoupling that is underway between China and the U.S. hasn't really hit the real economy right now. We hear the administration say, oh, well, Wall Street has had a good run. It's time for us to focus on Main Street. Well, Main Street is about ready to get hit with some of this, and unless things change fast, then we're going to start seeing it in a lot of in some layoffs in industries like trucking and logistics and warehousing, where really the rubber meets the road between trade and the U.S. economy.
Are we past the point of no return, Brendan, in terms of some of the economic damage that could be done, in terms of supply chain not getting the stuff that we typically get?
Well, in the short run, if President Trump announced later today, which nobody would expect this, that he was was freezing all tariffs, and he was gonna try to do this another way. If he kind of backpedaled on everything, we'd still have a supply whiplash. All those canceled orders would be placed again, and we would have the volumes surging through U.S. ports. And we saw during the pandemic what happens when the nodes of supply chains get bogged down. Is we had 120 ships parked outside the port of Long Beach and Los Angeles. So that's the kind of thing. Most people don't think it's going to happen on that kind of scale, but the system can't handle big declines or surges in volumes, and that's what we're looking at over the next several weeks or a few months.
All right, Brendan, thank you so much for joining us. Always appreciate getting your reporting. That's Brendan Murray, Global Trade Editor for Bloomberg News, joining us from London. And again, there's some reporting out of Bloomberg and others over the weekend, just simply the volume of ships leaving Chinese ports, setting sail for presumably the west coast of the U.S. And we often talk to Gene Soroka, who runs the port of Los Angeles and Long Beach. And we'll search to get back in touch with him in the next couple of days. But some of those sailings have declined dramatically just in the last couple of weeks. So perhaps that's reflecting what Brendan was suggesting was maybe some canceled orders from some U.S. wholesalers and retailers. We'll stay on top of that story, which could have a long tail, as they say. We'll have more coming up. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around-the-clock. Well, we've got stocks mixed this morning. This says investors watch for signs of progress in trade negotiations. We have the NASDAQ down about 0.1%, the Dow up about 0.5%, the S&P 500 up about 0.1%. The 2-year yield at 3.74%. That's little change. The yield on the 10-year 4.25%, and that's up about 1 basis point. To commodities, COMEX gold up about 0.6% at $3,320 an ounce. We go to oil, Brent crude down 1%, $66 a barrel. WTI crude $62 a barrel. And over to currencies, we have the Bloomberg Dollar Spot Index down about 0.1%. Few stocks on the move this morning. Shares in British food delivery company Deliveroo, they're up nearly 17% in London. This is after it received a takeover proposal from DoorDash. The offer will value Deliveroo at about $3.6 billion. And some more deal-making news. You have Germany's Merck buying Stamford, Connecticut-based SpringWorks Therapeutics for an equity value of about $3.9 billion. We have shares of Merck up more than 2.5%. That's in Germany. And SpringWorks, they're up about 3%. And finally, Airbus struck a deal to buy some factories that make Airbus parts from Spirit Aerosystems. And Spirit, as you know, in the process of being bought by Boeing. We have Airbus up about 3.5%, Spirit up 3%, and Boeing up nearly 3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Alex Steele out today. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We're streaming live on YouTube as well. All right, I'm looking at a chart of the S&P 500. I don't know here. I guess the bad news is, or the good news is, we're up 10% in the last 3 weeks of trading or so. But the bad news is we're still down about 10% from the highs of earlier this year. So I don't know which way you look at it here, glass half empty or half full. About our next guest, she's got an opinion, I'm sure. Sylvia Jablonski, Chief Executive Officer and Chief Investment Officer of Defiance ETFs, joins us here. So, Sylvia, it's been a crazy year for investors here. We started the year with animal spirits, deregulation, pro-growth government, and kind of here we are today with a lot of uncertainty in the marketplace. What are you telling your clients these days?
Well, good morning. It sure has been an interesting year. And to your point, I think that we expected, and our clients and investors expected, that it would be all systems go, right? And this is going to be the roaring 2020s, and the last 5 years of this decade were just going to be unbelievable because of tax cuts and deregulation and all these things that you said. And now I think investors are kind of sitting back and saying, what's going to happen? Is this administration going to take this so far that they might just crash everything, right? But what we're telling investors, though, is maybe we haven't seen this specific thing before in terms of tariff policy, but we have seen this type of thing with markets where you have these, massive pullbacks, and then over time you have some sort of catalyst that turns things around, and you have these, epic reversals going the other way. So we just tell clients really to stay the course. Don't take any kinds of losses if you don't need to take losses, and if you're in a position to put cash to work, it kind of depends on who you are, right? If you're a young investor, Mag 7 is grossly on sale, right? More than 20% in some cases off of recent highs. If you're an institution and you're over allocated there, look at an XMAG, look at, an equal weight S&P and equal weight NASDAQ and things like this to allocate new money, but don't sit on the sidelines because these are opportunities.
Okay, so Sylvia, that's what you're telling your clients, but how are they taking that advice? Are they a little bit is there unease? Are they confused? Are they just like, okay, I'm going to listen, I'll do it? But how are they reacting to that advice?
Yeah, and that's a great follow-up question, because I think that, if we look at the markets and we see what's actually happening, a lot of times investors, and not necessarily our clients, but just investors as a whole, tend to get spooked, and they do tend to buy high and sell low and take losses. And, I just think that this is a lesson, right? Like, we keep getting reminded that you don't want to do that, whether it's COVID, whether it's the financial crisis, whatever it is. Markets are up over time. If you've been in the markets for the last 5 years, the last 10 years, you're still in a great spot, right? You just have to kind of ride the storm out with this. But again, it's being opportunistic, right? Like you can allocate to different parts of the market that are performing, whether it's things like look at MicroStrategy, right? MicroStrategy, crypto, and gold are up this year, right? So there were places and pockets in the money or in the market to make some money. There's always a place to invest.
So, Sylvia, we're kind of getting into the meat of the earnings season here. What have you seen or heard from some of these companies as they try to articulate what's going on with their business?
Yeah, and this is a really interesting earnings season, right? I think the markets, like the fundamentals and the technicals are kind of divorced a little bit, right? So we see technicals, and technical information looks pretty good. It looks like we're getting a rebound here. It looks like, market, we're getting more breadth, expansion, things like this, some recovery. But if you look at the fundamentals and just the macro picture, it's kind of fuzzy because we can't see into the future. And so earnings so far, you have about 36% of companies that have reported, 73% have beat on EPS, 63% have beat on revenues, but almost all of them have kind of a cloudy outlook. And I think that is what the market and investors are uncomfortable with. And so we really have to just sit tight and see what kind of information we get about tariffs before we can fill in the gaps on the future or near-term prospects for fundamental analysis.
So with that said, you mentioned Mag 7 earlier. We have a few more, reporting earnings this coming week. What's your anticipation? What do you think they're going to say?
I mean, I think that Mag 7 is going to come out pretty strong for the most part. I think we're going to hear, some good stories about the quarter. But the problem is the quarter is backward looking, and some of these tariff issues have, just come into play a little bit more recently, and the future is uncertain. So I do think that, in order for the market to kind of maintain the status quo, which is where we are now, we've had a little bit of a recovery. We need to hear good news from the Mag 7, right, in terms of what happened last quarter. And I think we need to hear at least, kind of benign cloudiness about the future, for lack of better words, right? Because we know that they can't predict what's going to happen. But if we hear things like, we're cutting back on CapEx significantly, we're doing significant layoffs, there's a balance between cost cutting for efficiency and panic. And so I think a lot of the earnings reports will be listened to in great detail this earnings season.
Sylvia, thanks so much for joining us. Always appreciate getting a few minutes of your time. Sylvia Jablonski, she's the CEO and CIO of Defiance ETFs. Well, our good friends, and I think I speak for most Americans when I say that, our good friends up north in Canada, they are having an election today for Prime Minister. We want to get the latest reporting on that. Derek Declouet, Executive Editor for Canada, Bloomberg News. He's up there in Toronto. Hey, Derek, I think most Americans, either we consider Canada to be our good buddies, or we don't really think about it at all here. How did the average Canadian up there think about some of the rhetoric coming from our president?
Well, for the most part, Canadians are pretty frustrated, and in some cases even angry at the rhetoric coming from the president. And I mean, there's two parts of it. There's the trade war, which obviously has a very real impact, and we've already seen some layoffs at companies that have been affected by it, or temporary shutdowns of factories where the company just says the situation's too uncertain, tariffs are making everything too uncertain, and we can't continue for now. So it's having a real impact on people's lives in some cases. But the other part of it is the 51st state thing, and we saw the president again on Truth Social this morning saying Canada should be the 51st state, and wouldn't it be great? And there's just very little appetite for this in Canada at all. And if anything, that has energized parts of this election campaign, particularly the Liberal Party campaign, more than just about anything.
And as I understand it, Derek, kind of where many of the conservative voters actually reside in Canada tends to be out west. How do those folks kind of circle the square here? I can't imagine they like that kind of talk either.
No, but I think that the Conservative Party's done a pretty good job of trying to create some distance between itself and what's going on in the White House. The leader, Pierre Poilievre, is out there, just like the leaders of the other parties out there, saying, we'll never be the 51st state, and so on. And the Conservatives have really tried to turn the discussion back to the issues where they have some clear advantages on, that they are the party of lower taxes, that they are proposing more efficient government. That's very appealing to conservatives across the country, but there happen to be more of those people out west. It's also conservatives have also got more of a pro-energy bent, more about pipelines and exporting more oil and gas, and which and obviously that's where almost all of Canada's oil and gas comes from.
If you can dig more into the difference between the conservatives and the liberals, because there's different polls out there that show, the conservatives slightly in front. What's the difference side to side?
You mean in the national polls currently?
Correct.
Yeah, most of the major pollsters show the Liberals with a slight lead nationally, but under our electoral system, that actually gives them quite an edge because we have the same system as Britain. First past the post, most seats wins, most seats forms the government. And the Liberals have quite a large lead in Quebec, which is about 23% of the seats. And they've got a sizable lead, not a huge lead, but a meaningful lead in Ontario, which is 35% of the seats. So you look at those, and they will also almost certainly kind of dominate in the 4 Atlantic provinces. So you look at those 3 regions, which is most of the House. The Liberals are coming in here with a definite edge. Now, that being said, polls can be wrong, as we have all learned in recent years, and the Conservatives do have a certain amount of enthusiasm among younger voters who like their message on housing and taxes. And if those people turn up at the polls today in proportions that are greater than what they have historically voted, the Conservatives might actually have a good night. And there is not a huge chance, but there is still a chance of a Conservative victory today.
Derek, will Canadians know who their prime minister is by some point later this evening, or they have also the risk, like we do here in the U.S., that it can take days or even weeks?
Yeah, we'll almost certainly know before midnight New York time. The process here is really quick. This may surprise some American listeners, but there's one agency that runs the entire election. You get one ballot, which you mark with one X with a pencil, and then they count it by hand. And it's very simple. You do not tend to have the protracted arguments over voting that you see in the U.S.
All right, Derek, thanks so much for joining us. Appreciate getting a few minutes of your time. Derek Declouet, Executive Editor for Canada, Bloomberg News. He joins us from Toronto via a Zoom thing. So they've got their election here, and it was interesting. I saw some early reporting, Lisa, that prior to President Trump making these comments about Canada, the Conservatives were ready to roll. I mean, they had like a 20-point lead in the polls. They were ready for a change up there. And then that's changed dramatically as the Canadians, I think, have kind of rallied around this national identity issue.
Yeah, and like he was just saying, it has changed. It could change on the drop of a dime, too, the feelings of back and forth from the different polls. Yep,
so interesting. We'll see how it goes up there. And we'll have that reporting for you later tonight and into tomorrow for sure. S&P 500 absolutely unched on the day. I saw Lisa Bromitz earlier. That's why I'm going to use that term. I know she doesn't like it. The Dow's up 115 points and NASDAQ's down 41 points. So we got some red and green on the screen. Looking at the 10-year Treasury yield, about a basis point higher, 4.25% for your 10-year Treasury. We'll have more coming up. This is Bloomberg Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And this Bloomberg Business Flash brought to you by IBKR. Financial advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interest. Learn more at ibkr.com/RIA. Well, we've got stocks mixed. This is as investors wait for key company reports from 4 of the so-called Mag 7. I also wonder if more economic data is going to support the hopes of earlier than expected interest rate cuts from the Fed. We shall see. We'll go to the NASDAQ first, down about 0.1%, 19 points. The S&P 500 up 0.1% or 5 points. The Dow up 0.3% or 150 points. The 2-year yield 3.73%. That's down 1 basis point. We have the yield on the 10-year 4.24%, and that is little changed. We have COMEX gold $3,341 an ounce. Over to oil, Brent crude $66 a barrel, WTI crude $62 a barrel, and the Bloomberg Dollar Spot Index is down about 0.3%. A few upgrades and downgrades for today. We'll start with Peloton. Their shares up nearly 5%. That's after an upgrade from Truist Securities to buy. I know Paul loves the Peloton. Then we go to shares of Eli Lilly. Their shares are actually down nearly 1%. HSBC double downgraded the stock to reduce from buy. And finally, fast food chain Jack in the Box. It was up as much as 4%. Now it's up about 5%. That's after an upgrade from Stifel to buy. They actually point to the new CEO's plan to strengthen its balance sheet. That's the reason for that. For on-demand news 24 hours a day, subscribe to Bloomberg News Now. Wherever you get your podcasts, I'm Lisa Mateo. That is a Bloomberg Business Flash. Paul.
All right, Lisa Mateo, thank you so much. We appreciate that. Alex Steele out today. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, along with Lisa Mateo. And we are streaming live on YouTube as well. So head over to youtube.com and search Bloomberg Podcast Live. All right, big earnings week out there for the S&P 500. We have $20 trillion in market cap. Is going to report earnings this week. That is big. We had about $11 billion last week. And some of the big companies that are reporting are the technology companies, and you really want to get a handle on kind of how they're viewing the world these days. So we asked a couple of the smart folks that we know to join us here. Anurag Rana, Mandeep Singh, they are senior technology analysts for Bloomberg Intelligence. Anurag joins us from Chicago, and Mandeep is in our Bloomberg Interactive Broker Studio. Mandeep, let me start with you here. I mean, just given what you've heard so far from some of the big tech companies and what you expect this week, how are some of the companies, these big technology companies, which have been real drivers for the stock market, how are they kind of saying they're seeing the world out there these days?
Yeah, I think in the case of Meta, I mean, clearly they are exposed to the de minimis rule where companies in China can't really ship any products below $800 anymore. And that was a big driver of ad spending from Temu and Shein and some of these advertisers. So that's going to impact Meta. We saw in the case of Alphabet, the click ads grew only 2%. The pricing was relatively stable. So I think in the case of Meta, the ad pricing may come under more pressure compared to an Alphabet. And the ad impressions may be better than Alphabet. So because of the FTC case against Meta and similarly for Alphabet, these companies have regulatory pressures as well. But there is no doubt that the macro environment has changed for the worse. And I don't see, even though the impact would show up more in 2Q, I don't see how they guide better than they did in the fourth quarter.
What about AI spend? How much of an impact is that going to have? Are the investors going to be looking to that?
Oh, so Meta raised their capex the last time they reported to $65 billion. And in between, there was news that Meta is looking for an Amazon and Microsoft to share some of that capex because they have an open source model. So I think they're under pressure to kind of cut back on the capex or the Reality Lab spend. But so far, no one has pulled back on AI capex, given we are still in a supply-constrained environment when it comes to the GPUs and overall AI infrastructure. So it'll be interesting to see what they end up doing.
Hey, Anurag, I kind of think of even within technology, which is such a great growth story and can batter some slowdowns, I think of the software companies that you cover as kind of maybe one of the safer places to be within technology. What do you expect to hear from the Microsofts of the world?
Yeah, so Paul, on a relative basis, I think you're right about that. But at the same time, they do have an impact on the second degree demand. If the enterprise tech spending starts to cut down, that has an impact on software space as well. So that's something we will be looking for. But I would agree with Mandeep that we are not anticipating a drop in CapEx either from Microsoft or AWS later this week, because those are the names that dictate a lot in terms of how AI spend will shape up over the next 12 months.
Where within the tech stack, Anurag, do you think you could see maybe some of the biggest exposure to, I guess, just tariffs and maybe a slowing global economy?
Yeah, so Apple's going to be, front and center over there. There's so much news about, their ability to move the supply chain. That's not that easy. We do anticipate some pull forward in demand for them. We know Apple stores were really crowded before the tariff date, and that will show up in some of the numbers. But the question is going to be, what kind of guidance can they give? And in fact, if they can even give guidance at this point, and how if there is a big number that goes up on tariffs, can they even fulfill the demand? So there's going to be a lot of noise around that supply chain and what they're doing to offset that both in the near term and in the long term.
And the other big story for today, IBM planning to invest $150 billion in the U.S. over the next 5 years. Mandeep, can you break it down for us? What does that include? That's a pretty big number.
Yeah, I mean, look, in the case of IBM, they are not a big spender on AI CapEx. So clearly, they are looking to expand in terms of their own investments, whether it's mainframe related or any other type of R&D around quantum. But we've heard that from Apple, $500 billion over the next 4 years. So a lot of these tech companies are looking to appease the administration, which is keen to, bring manufacturing back. It'll be interesting to see where IBM sort of thinks about investing the $150 billion, because as I said, they're not a big player when it comes to the AI infrastructure play that the other hyperscalers are involved in.
Hey, Anurag, I seem you remember a lot of the CEOs that you and Mandeep cover making their way to Washington, D.C. over the last 3-4 months, having meetings with the president and members of administration. Is there a sense that they're getting the benefit of that, or is that having any impact? Because I'm not sure I see that.
Well, one could argue that the smartphone exemptions that we got or the consumer electronics may have had something to do with it, but we'll find out if that can continue or not. But, frankly speaking, these companies are the ones that are really putting U.S. at the forefront. Will be very surprised if we see a much more hostile behavior against them. The big question is, as Mandeep mentioned, there are a few antitrust cases going across them right now for a bunch of these companies. We'll find out how the administration takes over or puts their credibility or the backing behind those deals.
Now, Mandeep, you mentioned before quantum computing when we were talking about IBM. I mean, are we going to be hearing more and more of that come in the future? Because we've been hearing so much about AI, but is quantum kind of going to move forward?
I think at this point, given the macro environment we are in, I would focus more on what the companies think is, monetizable in the near term. Quantum would be further out. At the same time, I mean, could 1 to 2% of those CapEx dollars go into quantum? Yes, but the big chunk would still be allocated towards AI and, specifically inferencing, because everyone seems to be quite bullish about the type of use cases that are emerging around AI agents and what it means for the overall enterprises.
All right, fellas, thank you so much for joining us. Always appreciate getting you guys, particularly when we get you guys together. Anurag Rana, Mandeep Singh, they're the two folks that kind of run our global technology research effort at Bloomberg Intelligence. And like you have to do, technology is a global business. Therefore, you need to have expertise on the ground all around the world, and we do. Asia, Europe, North America, we've got it covered for you. And Mandeep and Anurag run that business for us. We appreciate getting a couple of minutes of their time. It's going to be a big week for earnings. Continued big week for technology companies. To what extent is their business being impacted by some of the economic uncertainty that may be building out there as a result of maybe some uncertain tariff policy issues? So we'll see how that plays out this week when you get more. Again, $20 trillion of market cap, those companies reporting this week. Looking at the markets, up 8 points for the S&P 500. Coming up, we're going to check in with Poonam Goyal, Senior U.S. e-commerce and retail analyst at Bloomberg Intelligence, on your shoppers and kind of how they're going to kind of feel tariffs at the supermarket, at the retail level. That's coming up. Poonam Goyal, Bloomberg Intelligence. This is Bloomberg.
Listening to Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Alex Steele is off today. I'm Paul Sweeney with Lisa Mateo here in the Bloomberg Interactive Broker Studio, streaming live on YouTube as well, so check us out there. You know, we haven't really seen the impact of tariffs, I guess, at the retail level yet, but experts say we will in the coming weeks, and you just kind of look at the supply chain and how things work, and that might be the timing, particularly as it relates from China. What are the retailers going to do? What are the wholesalers going to do? Are they going to eat it in their margin? Are they going to pass it through to us? I don't know. Poonam Goyal knows, senior U.S. e-commerce and retail analyst for Bloomberg Intelligence. She's based down there in Princeton, New Jersey. So, Poonam, when are consumers going to start seeing higher prices, tariff-related higher prices? When are they going to see that at the retail level, do you think?
I think it depends on the retailer that you're talking about. If it's one of the bigger retailers like an Amazon.com, it'll be some time before you see those tariff increases because Amazon's big enough to absorb some of them or push it off to its third-party sellers. That said, if we see the China tariff rate continue at 145%, which is where it stands today, it is inevitable to see price increases, though we think you can wait still a few more months before you really see the big price increases.
Now, Poonam, I have to get to the Chinese e-commerce retailers like Shein and Temu. I have to be honest, my daughter, a few weeks before this even started, she was like, Mom, we have to stock up. We have to stock up on Shein.
See, she understands economics and global trade. She
understands. But I think that thought process was in a lot of people's heads too. But even with the price hikes, like Shein hikes U.S. prices as much as 377%. Even with those hikes, is it still, what's the price comparison to what they offer compared to what you get in the U.S. stores?
Yeah, look, it's still cheaper. I actually went onto the Shein app this morning after I saw, the price increases go into effect. And I saw some of the studies. I did. I had to see, right? But I mean, if you take the price of something from $1 to $3, it's a 200% price increase. But will it have the consumer pull back on what they were planning to buy? And that's probably like a makeup brush or something like small like that. So I think we have to look at the price elasticity. And to your point, if that item is still more expensive elsewhere in the US, then you'll still buy it there. But yes, prices are going up there. Remember, they're hit with two things. The first is the tariff, of course, but the de minimis exemption that they no longer can hold is the bigger hit that they have, which is why they're having to face all these tariffs, which other countries are not having to do. It's only China where this exemption was removed from.
Poonam, somehow I think, once again, the small and mid-sized businesses are going to get hurt the most here. As you mentioned, the Amazons of the world, they can deal with the margin pressure maybe more than a mom and pop. And I know when my kids were young, we had to go out and buy a present for a birthday party. We'd go to the local store right in town as opposed to going to Target because we want to shop local, support the local shop owner and all that kind of stuff. But if they see their prices rise, what are they going to do? And that's a big part of this U.S. economy.
Yeah, look, the mom and pop shops, the small businesses, to the extent that they still have inventory, they can probably weather the storm. But once the inventory gets depleted and they have to refresh with new things coming from China, whether it's through a supplier or direct, the prices are going to be higher. And they will not be able to pass along these price increases to their consumers, especially, when you think about it, Paul, you and I, right? If you want to support the local shop, you may go buy the toy there. But if you know you can get it cheaper at Amazon or Walmart because they're willing to absorb much of the price increase, you're going to go where it's cheaper, right? That's where the consumer is going to drift.
Now, you mentioned inventory. When are we going to start to see a difference in the inventory from, let's say, the Walmarts or the Targets?
Yeah, I think a lot of what they sell is stored here through suppliers and their own distribution networks. So they still have some inventory on hand. But when you get into the peak back to school holiday selling seasons, by no means do we have enough inventory to fulfill demand there. So I think in the next 2 months is my best guess is when either you'll start have to bring shipments in at higher prices or you'll have to change what you sell. And Amazon can do that because it does have a marketplace that's very diverse. So, maybe you're selling, yellow erasers, and now you go somewhere else and source pink erasers. It can vary. The other thing you have to look at is just the percent of your mix that's impacted. So when you look at an Amazon.com, we estimate that roughly 22% of their mix is in electronics. And electronics has a lower tariff rate. It's 20% right now, even from China, right? So that's manageable compared to the 145% that they'll be paying from apparel made out of China or coming from China. So it's a little difference in, where the price sensitivity will be across the goods that they sell.
Putting about 30 seconds left here. Are we going to have any empty shelves as we think about over the next couple of months, do you think?
If we continue into June with 145% tariff, I think so.
Okay, there you go. I mean, retail, you're going to have to, I don't know. I really worry about the small and mid-sized businesses because I don't think they have much margin to play with in general to be able to absorb anything. And those are the companies that I think could really be at risk. And I think about the politics of this. Isn't it the economy stupid? Why are we screwing with the economy? How does that good politics?
Yeah.
I don't know. So
but
maybe
I think you're right because I was going in town and I went into a local shop and started talking with them about that. And you get the feeling like they're nervous.
Yeah, I mean, I don't know. We'll see here. All right, that was Poonam Goyal. She's one of our top folks there. We appreciate it. All right, folks, for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by ShipStation. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now as we look at the markets here. Absolutely unchanged on the S&P 500. Got a little bit of a gain here, 140 points or so in the Dow, and the Nasdaq's off 56 points. So not a lot of direction at the index level. But we have another hour coming up. Darkening the door. Mr. Matt Miller is going to join us for the 11 o'clock hour. Lisa is escaping, literally running out of the room.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Darkening the door. Matt Miller, fresh of Bloomberg Television. We got you for an hour here. Thank you for sitting in.
I'm so excited. Have you been following Torsten Slok?
Oh, love the guy.
It's been amazing over the past couple of weeks. He's broken away from like one little chart, one little graph a day to full commentary. And he's proven the point that cars, like global trade is all about cars.
Yep, absolutely. He had some great research on that. And they come from Canada and they come from Mexico. So that could be a problem for buyers. So we're going to get a lot coming up here this hour. We're going to check in with David Gura. He's up in Canada as they elect themselves a new prime minister today. Nancy Cook, national political correspondent, on what it's like the first 100 days, which we're going to commemorate this week, what it means for the folks in Washington. So we got a lot coming up here. Markets are mixed here.
Tomorrow is day 100.
Day 100. There you go. So
if you count his inauguration as day one,
which they do.
Well,
the administration.
Don't you? He signed executive orders on. Did he sign them on day 0? Obviously, that was day 1.
But I believe Bloomberg Editorial has a different opinion here, so I'm just going to say this week and what that covers is.
Okay.
That.
Well, I mean,
I read the memo, so I'm going to go with it. All right, let's kick things off. Charlie Appello, he's got a Bloomberg Business Flash.
Hi, thank you very much. And here's what's going on. We've got the S&P 500 index fluctuating between gains and losses. Right now, higher, little changed, up 2 points. Dow Industrials advancing, up 146. That is a gain right now on the Dow of 0.4%, while NASDAQ on this back-to-work Monday, down 45 for the NASDAQ Composite Index, a drop there of 0.3%. The 10-year, 4.23%, with the 2-year, 3.72%. Spot gold, little changed, up $5 the ounce, 33.25, up just under 0.2%. A retreat for crude, 62.17 a barrel on WTI, down 1.3%. And Bitcoin, 94,515, up by 0.2%. Traders bracing for a deluge of corporate earnings and key economic data, sending stocks churning as they await more insights on the impact of President Trump's trade war. As for the earnings outlook, Lori Calvasina is head of U.S. equity strategy at RBC Capital Markets, and she was the guest this morning on Surveillance.
We got a lot of earnings last week, and, you know, we're in the middle of the busiest stretch. Last week was the first part of that. And not only did we hear from a ton of companies across a bunch of different industries and sectors, we got a ton of detail on tariffs, and none of it was the same from company to company.
Lori Calvasina of RBC Capital Markets, and this Bloomberg Business Flash is brought to you by IBKR. Will U.S. initial jobless claims exceed 260,000 for the week ending May 10th, 2025? The yes was recently at 8%. Trade your prediction with IBKR Forecast Trader at ibkr.com/forecast. Last trading day for this contract is May 14th. Recapping, S&P just turning negative, been that kind of a day, down now, little change, down by 1 point. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pelleton, thank you so much. We appreciate that. Matt Miller sitting in for Alex Steele this hour. We appreciate it. We're here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. What are you looking at, Matt, these days?
I'm looking. So my overriding question to kick off the week is, does earnings overshadow economic data, because this is the busiest week for earnings, as I'm sure you've been saying all morning long, right? $20 trillion worth of market cap is reporting. But we get some big economic data as well. Tomorrow we get the Conference Board Consumer Confidence. We get a bunch of other stuff on Wednesday and Thursday that I can't remember. And then on Friday we get the non-farms payrolls number, the granddaddy of all economic statistics. So you would think like that's neck and neck, like which is more important to the market. But my take is that this economic data is so backwards looking, and obviously non-farm payrolls doesn't give you an outlook, right? Whereas companies will come out and say, man, we don't know what to do. There's so much uncertainty. All I can do is like fire my employees and like close down factories. Like all they can do is cut costs. That's their only lever to pull, and I'm waiting to see whether or not they do it.
I know. We'll see how it goes. And we're seeing that in the marketplace today. People aren't really sure what to do with this stock market. But let's take a look at some stocks on the move today. We're joined by Bloomberg's Denitsa Sakova.
Let's start with Boeing. Boeing rose as much as 4% in earlier trading as Airbus agreed to take over some assets. Of course, the important part here is that this clears the way for Spirit to be acquired by Boeing. This has been a complex deal, three-way transaction. It reunites Boeing with Spirit, which they spun off in 2005. The acquisition was about $5 billion. Of course, it was announced in July 2024, and that's clearly lifting the stock. We also have an upgrade from Bernstein. The stock is now outperformed because it's making the progress it needed for the growth trajectory. They noted the commercial jet production has stabilized, and of course that defense outlook has improved after the jet competition that was won by Boeing that President Trump recently announced. And the stock is up 2% year to date, which is not a bad start considering how stocks have suffered this year. Especially this stock, which is just a giant, old, creaking, practically government-run bureaucracy duopoly. Like, I don't know why people find Boeing and Airbus so exciting. They're just two gigantic government companies that like slowly move pieces around the board, right? We used to own Spirit, then we sold Spirit, now we're buying Spirit. Like, exactly. I don't know why we devote so much time to these companies.
I love Boeing because it represents U.S. engineering superiority until they move the corporate headquarters from Seattle to Chicago.
Yeah, because they used to make a great plane like the 747-800, and now what?
I just flew on a
now the 737. That's not a good plane.
It's the workhorse. Eli Lilly, what do you got?
I feel so there isn't that much competition. Two big companies makes sense. Eli Lilly shares up as much as 2%. Of course, we're talking about HSBC downgrading the stock to reduce, which is the sell equivalent, saying the drug maker's risk-reward is not attractive. We have competition. Of course, we're talking about Ozempic, Wegovy, all those big drugs, and Novo Nordisk is a big competition there. We also have very high valuation. That's something that HSBC is noting. The stock currently has a forward price to earnings ratio of about 40 times. Right. The S&P is 20 times.
They have the one I want, though. They have Zepbound is what I want to get hold of.
That's your favorite?
Yeah. Well, I mean, I can't get it.
Yes, you can get it.
Twice I've been not approved by my insurance company. Yeah, I could pay for it myself.
Go get the over-the-counter stuff.
$1,000 a month.
Go get the...
Yeah, you want me to get Hims and Hers?
The stock is up 14%. It's working.
30 seconds on Peloton.
Peloton is up. Shares gained as much as 6.5% in earlier trading. We're talking about an upgrade from Truist. It's buy, saying the stock is finally nearing a point where the company is improving fundamentals, should support a recovery. The stock is down 24% year to date. The new price target from Truist is $11. This implies a 70% jump.
Nice.
So clearly, very bullish thesis there.
All right, Denitsa, thank you so much. We appreciate that. Denitsa Sakova, cross-asset reporter. For more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. Listen to Stock Movers on Apple, Spotify, or anywhere else you get your
Such a great idea.
It is.
That's a product this market needs. And I'm not being sarcastic at all. I'm dying for more stock movers, but 5 minutes is not enough. You know,
they update it all the time.
I need a little bit more.
They update it a lot, so it's always something new. Let's go up to Canada. That's where David Gura is. We always follow in his footsteps. He's correspondent for Bloomberg and host of the Big Take podcast. He's up in Quebec, I believe. I think he's on the banks of the Ottawa River. I guess the Canadians are going to the polls today, and I bet you they're not too happy with the United States. How's that impacting what's going on up there, David?
Well, Paul, it's casting a huge shadow over this election, as you rightly expect. And this election kind of turned on its face about 2 or 3 months ago when President Trump began making comments about trying to subsume Canada, make it the 51st state, and of course ratcheted up his rhetoric on tariffs and the economic relationship between these two countries. And so what that's meant in real tangible terms is the Liberal Party, which was greatly lagging behind the Conservatives late last year, has gained a ton of ground and surpassed Conservatives in the latest public opinion polling. So they're now looking at the prospects of a victory in this election today. Mark Carney, the Prime Minister, who's been on the job now just for a couple of weeks, hoping to keep that job. And so much of what he talks about, to your point, Paul, is about how he, in his estimation, is best positioned to, yes, deal with President Trump, go into those negotiations over trade and tariffs, but also just has a host of experience from the jobs that he's had in the past. They haven't been political jobs. He was the governor of the Bank of Canada during the global financial crisis, governor of the Bank of England during Brexit. He's bringing all of that to bear, and that's the sell that he's making. Now, you look at the Conservative Party, Pierre Poilievre, who's a bit younger, 45 years old, from Alberta. He is positioning himself as a change agent. He said the Liberals have been in power here for too long. Carney is just an extension of Justin Trudeau's Liberal Party, trying to make the case that what this country needs is somebody different. And he also doubling down on the rhetoric that Canada needs to present a strong front against the United States.
So Mark Carney has been a governor in the past, but he doesn't want to be a governor in the future. How much has President Trump's trade war and rhetoric helped spur the Liberals towards what looks like a certain victory?
It's just been a huge help here. And, you know, Mark Carney from the beginning of this contest has said that he's never thought that President Trump was joking when he would talk about that 51st state issue, that those remarks about sovereignty weren't something that he could laugh off or shrug off. He said that he's taken him serious from the very start. And so the people in this country, who many of them were dissatisfied with the way that Liberals have been running the country and the economy, are now looking at him as somebody who's a more stabilizing force here, again, drawing from that experience that he has as a technocrat in Canada for so many years. And so he's hoping that that's going to be a ballast for him. And it's interesting when you look at the demographics of support here, again, presented in those public opinion polls. Pierre Poilievre, the Conservative candidate, does have a lot of support from the western provinces of this country, from younger people. Mark Carney, the Prime Minister, has a lot of support from older Canadians in particular, and those in the eastern part of the country. So it'll be interesting to see sort of how all of this shakes out. But again, the polling has been working in the Liberals' favor here for the last many weeks.
And this really changed, didn't it, David? Prior to President Trump and some of this commentary regarding Canada, the Conservatives were looking to take over. They had a big lead, didn't they?
You're absolutely right. And so, you know, back in the fall, when it looked like Justin Trudeau's political future was very much in doubt, his hold on that power was very tenuous, you looked at polling and Conservatives were up by 20 points, double digits. And the argument that they were making was an economic argument. Again, that this country faces some rather large economic challenges when it comes to affordable housing, for instance, the debt and deficit, to growth, inflation. And again, they were presenting themselves, the Conservatives, as a way of changing course and trying to take those issues more seriously and making the case quite effectively at that point in time that the Liberals hadn't done right by this country. Again, in the last few weeks only, we've seen a dramatic reversal here. And not only were Liberals able to make up that deficit, but they've been able to surpass it as well. So we've seen the Liberal Party running ahead in those public opinion polls here by 7 or 8 percentage points. That's been reduced a little bit in recent days, but still having a lead that, again, a couple of months ago would have just been unfathomable if you'd looked at those public opinion surveys.
Wow, just amazing. All right, David, thank you so much for your reporting. Really appreciate it. David Garr, correspondent for Bloomberg and host of the Big Take podcast, joining us remotely from Quebec, Canada, on the banks of the Ottawa River. So right there in the middle of it as they elect a potentially new prime minister today. We'll have to see how that plays out. Boy, you think about the President Trump and his administration, the one thing you have to admire is how quickly they're moving. And not a minute goes by that there's not news coming out of that administration. That's the subject of a great Bloomberg story today. Nancy Cook joins us here, Bloomberg senior national political correspondent. The title of the story is Welcome to the Thunderdome, inside 100 dizzying days of Trump 2. So, Nancy, what's the gist of your story here? Because, again, like I say, it just seems like if you're in the news business, this is a full-time job covering President Trump and his administration.
Oh, it's a more than full-time job covering President Trump. And thank you so much for having me. The gist of the 100 Days story is really just that they, have done so many things at such a breakneck speed. And, they have signed over 100 executive orders. He has really, reshaped the way that the U.S. thinks about trade policy. He's trying to come up with all these different foreign policy deals. There's been a ton of outreach to different CEOs, and he has a lot of new relationships with tech CEOs. And what we reported out is that a lot of the preparation happened actually, as long as 4 years ago when he first lost the 2020 election. Some of his aides, particularly like Stephen Miller, who's a deputy chief of staff in this White House, have been planning things like their immigration move over the past 4 years. And then there was a ton of work done during the presidential transition. So it's not just that they came to Washington January 20th, the inauguration day, and started to move quickly. It's that they really laid the groundwork for months and even years in some cases to think about all the policy moves that they wanted to make.
So, Nancy, I talk to executives all day long on my television show, Bloomberg Open Interest, weekdays from 9 a.m. to 11 a.m. Oh. And they're always saying, when we get to the other side of this, when we start to see more certainty, when we start to see more stability, is that expected? I mean, was the idea this first 100 days we'll do like 20 executive orders a day, and then after, Tuesday, April 28th, then we'll start to build in some stability to this economy?
No, I think that they are going to continue at this breakneck speed. I talked to one senior administration official for the story who argued that there are a lot of torpedoes under the water. That was his phrase, just meaning that there is a lot more to come. And I think that their philosophy, even if it pains business executives, is that they want to continue to move quickly. They want to cut all these trade deals. I would say the next 100 days is going to be very focused on foreign policy. President Trump is going to Saudi Arabia. They are very focused on negotiating with all these individual countries to deal with trade imbalances and come up with new trade agreements. And so, but the pace is going to continue.
Nancy, to what extent is the administration concerned about the declining poll numbers of President Trump, particularly as it relates to his handling of these tariffs and the economic uncertainty?
I don't think that they're very concerned, honestly. President Trump does not have to run for re-election. I think what they are paying attention to is the midterms, which will be in a year and a half. And so I think that they are focused on that, and they want to make sure the economy is in a good place. I do think that all the instability in the stock market around the tariffs did freak them out a little bit, and is something they're aware of. But I don't think that he's not planning to run for re-election. So I think that they're thinking about it differently. And I think that they are also very confident. Some could say maybe blindly so, but they are very confident. And the poll numbers so far are not stressing them out.
I wonder about Doge, because it's been a huge part of this first 100 days, right? And Elon Musk is only allowed to work for the government, I believe, for 130 days. So if January 20th was his first day, tomorrow will be his 100th day working for President Trump. That means, there's only a month left of Musk at Doge. How would you grade them, Nancy? I mean, how much have they cut in costs? Initially wanted to do $2 trillion, then $1 trillion. What is it now?
Well, we didn't get sort of super into Doge in this story. I would say they haven't cut as much as they have said they are. The Doge people are embedded in the agencies, and I think that they are there to stay. Elon Musk, though, is on his way out. And you have to remember it's kind of a tricky dance. I think the Trump people are sort of tired of the political liability that he has brought to the White House. He also has sort of moved quickly and not really always kept them informed.
Right.
And so
we're
I think
going to have to
there's
leave it at that, Nancy, just because of time. So appreciate your reporting. As always, Nancy Cook, Senior National Political Correspondent for Bloomberg News. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks. The S&P 500 index trading at the low of the morning right now, with the Dow higher by 40, up 0.1%, but the S&P down 24 right now, 5,500 even. The S&P 500 index down 0.4%. Nasdaq down 158, drop there of 0.9%. Going to be a busy week for Mag 7 earnings. The 10-year yielding 4.23%, the 2-year 3.71%. Gold right now up $13 the ounce, up by about 0.4%, 33.33 the ounce. And West Texas Intermediate crude down 1.8%, 61.88 for a barrel of WTI. Tesla is raising prices in Canada and encouraging buyers there to snap up cars imported before counter tariffs were imposed on U.S.-made vehicles. Tesla shares they're down now by 3.5%, and the Japanese construction and mining equipment maker Komatsu says it may raise prices in the U.S. in response to tariffs, with the company projecting a 2.27% drop in operating profit this year because of the levies and the stronger yen. Komatsu shares, though, they are advancing right now. Komatsu up by about 2.7%. Recapping, S&P 500 index down 26, down 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Matt Miller sitting in for Alex Steele this hour. We appreciate that. We're coming live from the Bloomberg Interactive Broker Studio, streaming live on YouTube. Matt, as you mentioned, I don't know where to focus this week. I got a huge swath of companies reporting earnings, and we're really going to be focused on the guidance for a lot of these companies. And then we've got a lot of economic data, and maybe the question is, when are we going to start seeing some of the uncertainty in some of the economic data, whether it's GDP or inflation and that kind of thing. So we got to pay attention to that. So if you're a professional money manager, there's plenty to keep you busy. Kim Forrest, founder and chief investment officer at Bouquet Capital Partners, joins us here. Kim, kind of with that setup, what do you think is driving stocks here? Do we earnings or some of this bigger, I guess, economic data issues, or is it just what comes out of the Twitter account or X account or, of a certain president?
I think all of the above, but here's what I've learned from doing this for the past, I can't believe it, 26 years of looking at markets, is in a given day, they can really only process one or two ideas. I kid you not. If you go back to what happened on Friday, you can suss out what drove the market. And you look at the stocks and you look at the data that comes out and you go, aha, this is what drove the market. So I'm going to make a bold prediction that the thing that drove the markets last year clearly was NVIDIA and the AI trade. And this week, we're going to get a little bit more information on whether or not the AI trade is dead. And I think the answer is no, because we got a sneak peek from what happened on Thursday. I think it was Thursday. Every day seems like a lifetime. Anyhow, with Google. And Google reiterated that they are going to continue spending on their AI build-out. And so we expect Microsoft, Meta, and Amazon to all say the same thing.
It's actually a very good point. And Kim, I've been asking the question all morning, are we going to see more cost cuts? Because there was a story in the Wall Street Journal that said corporate CEOs are saying the market version of the Serenity Prayer right now. Costs are the only thing that they can really control, and in the face of total uncertainty, that's the lever they're pulling. But I was talking with Gargi Chowdhury of BlackRock this morning, and she said, well, you know what? Google didn't cut its CapEx. So maybe we won't see a cut in CapEx from the other hyperscalers, and that's really what's driving this market, is that AI trade that we obviously saw so big last year. What about other companies, though, Kim? Are you worried that we're going to start seeing, especially smaller companies, start to fire employees, start to, close down stores, start to reduce costs wherever they can?
So the answer is always yes, right? For the troubled. Like Macy's is going to close a store in this, I don't know how big, it was a huge, huge mall, and there's only 3 things in it now. Maybe 4 if you consider the collectibles shop that's in there as well.
That doesn't count as a real business. That's like somebody's
No, it really doesn't, but I'm painting this, right?
Yeah.
Joanne Fabrics pulled the plug there, but we've got Macy's that is now going to pull the plug. Dick's Sporting Goods is going to pull the plug, but the Township of Fraser has its township building in that building, but it's massive. It is the hugest, most empty building I've ever seen in my entire life. But that is what we get, is companies that aren't succeeding are going to reshuffle the decks. Now, Dick's is doing pretty well, but in that mall, nobody's going to the mall. They're going to move somewhere else. No kidding. So that goes on all the time. But I would even say smaller companies that are successful are not going to just indiscriminately hire. What companies do have right now is technology that tells them what the pipeline is doing in real time. Most, even small companies, have a CRM system where they can see what demand looks like. And I think that is going to drive things, not tweets, not headlines. It's going to be what's happening with our business. And if your business is sick, you're going to make some cuts.
Kim, I mean, looking at the S&P, I made the comment earlier that depends on kind of if you're a glass half empty or half full kind of person. That the bad news is that the S&P is down 10% roughly from its peak earlier this year. The good news is that it's up 10% from the bottom. How do you view kind of what's going on out there in the stock market generally?
Well, again, I'm kind of a mathematician. That's my basic training that's what I graduated with a degree in, that and computer science. So I like to take apart the pieces of the S&P. And if I look at what was driving the S&P last year, and pretty much through the end of the year, was the AI trade. So that's the big Mag 7. I was going to call them the Big 7. Mag 7, and then, especially NVIDIA. Now, NVIDIA's come down a lot, right?
21% year to date.
Yeah. So that is overweight in the S&P, or it was really overweight in the S&P 500 calculation. So you have to look at that. And if you look at the rest of the S&P 500, they're really not going all that up or down, right? That most of that dip down and dip back up was the Magnificent Seven. And that was the blessing last year, and it's the curse this year. So you index buyers are just going to have to put up with that.
It's actually, at one point, it was down 37% peak to trough. Yep. With the peak being like the very beginning of January and the trough being 2 weeks ago. We've had a pretty powerful rally, though, over the past 4 days. Today, it's, not looking like it's going to continue, but we had the SWIG breadth thrust indicator triggered for at least the 18th. I've seen 3 different estimates of how many times it's been triggered since 1943, but it's been at least 18 times. And each of those 18 times, Kim, it's resulted in double-digit gains, on average like 15% 6 months out and 25% 12 months out. Do you put any trust into the SWIG breadth thrust indicator, which basically just says NYSE stocks, only I think 40% of them were at new highs, and then within 10 days, 61.5% of them were at new highs.
Totally clear.
Yeah.
So I'm going to use one of my favorite phrases that I think irritate people. That's interesting, but irrelevant. Because the truth is, a lot, and remember, I'm a math person. I used to be an AI person, which is math. I love math, but it tells me what happened in the past, not what's going to happen in the future. And there's so much that can happen in the future, like deals, tariff deals signed, not signed, wars, not wars, just everyday life that doesn't necessarily let you, with assurance, know what's going to happen to your stocks in the future. So I'm cheered by this. If that happens, go whatever indicator. But I'm not going to, run my money based on it.
I was excited last week about it. It's the SWIG. Martin SWIG invented this. The SWIG breadth thrust indicator.
Oh.
All right, put that out on social media. I'm sure that'll get a lot of hits. Kim Forrest, thank you so much for joining us Kim is founder and chief investment officer of Bouquet Capital Partners. All right, you mentioned Torsten Slok and his note on autos and how that's really where you're going to see the impact of tariffs. What are the, you know all these auto companies all over the world, what are they saying? Like, what are the Volkswagen people saying about?
Well, I think they're all saying different things. I actually had dinner on Saturday night with Jose Munoz, who runs Hyundai and Gemini.
Okay.
And what he's saying is, hey, guess what? We make a lot more of our cars in the U.S. than you realize. And so he's not worried because he's got a ton of production here, and it's not the Mexican production that they also have or the Korean production that they also have that needs to come here. So for him, it's almost a benefit, right? Obviously, it depends on what happens when it comes to the auto parts tariffs. But other companies are, like Jim Farley from the beginning has been saying, this is going to cause costs and chaos because so many, even if they only sell cars in the U.S. that they assemble in the U.S., which Ford has a better shot at that than GM, and they both have a better shot at that than Stellantis, they still use a lot of auto parts from other countries. And you don't necessarily want to be bringing back wiring loom manufacturing to these great shores, right? It's okay to leave that in Ukraine.
Right.
It would cost a heck of a lot more if you brought it back here. And we're already looking at, I was putting together a Chevy Suburban yesterday, looking at a new family truckster, right? And it's $75,000, $80,000. Like, that's very expensive for a Chevy Suburban. But if we start producing wiring looms in like Indiana instead of just outside of Kiev, then it's going to be $100,000 or more. So, yeah, I think some car makers are SOL.
But how about, how about like Mercedes and things like that? Or
So Mercedes just doesn't produce enough cars here. Okay. They're going to have to add whatever import tariffs onto the sticker price. And that's going to be a real problem. And what they're going to do is they're just going to stop selling their more affordable models here because they will be less affordable. And then who's going to want to buy? You don't want to pay $80,000 for a C-Class, right? Maybe if it's an S-Class, it makes sense that you're paying $150 instead of $125. But they're not going to be selling, and a lot of companies are not going to be selling their more affordable vehicles here. Did you see, by the way, this new Amazon Slate truck?
No.
So cool. At least the idea of it. They're going to sell a $20,000 truck. Actually, after incentives, it'll be less than $20,000 for a two-seater electric pickup with no range, right? Only like 150 miles, but you don't really need much more for certain purposes. And then you can change this truck into anything you want. It can change into a 5-seat SUV with certain additions. You can add a stereo, but it doesn't come with one. You can add a screen, but it doesn't come with one. Like, very cool project. I'm interested. It's the Amazon Slate truck.
Amazon Slate, I'll go check that out. The last vehicle I bought, which was like a couple of months ago for the number 4 Offspring, we leased it hybrid. How about that? Going
so green of you, Paul.
Going green, exactly. In New Jersey, I'm sure it'll have a big impact. Coming up, Mark Daly, he's going to join us, Bloomberg BNEF, on innovation and technology in the energy space. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got the NASDAQ 100 index down by about 0.9%. This in the countdown to tech earnings this week. Right now, the S&P 500 index is down 25, close to session lows, down by about 0.5%. The Dow swinging between gains and losses. Right now, the Dow Jones Industrial Average up by just about 0.5 point. This update brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio. Small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about their consultative support and technology. The 10-year 4.23% with the 2-year 3.71%. Gold little changed, up by just under 0.1%, 33.22 the ounce. And West Texas Intermediate crude down 1.8%, 61.90 for a barrel of WTI. Bitcoin right now down 0.6%, 93,764 on Bitcoin. White House tariffs on China are set to unleash a jolt to Main Street. Let's get more from Bloomberg's Vinny Del Giudice.
Inbound cargo has plunged since the U.S. raised tariffs on Chinese goods to a punishing 145%. In 2 or 3 weeks, thousands of companies, big and small, will need to restock. Giants like Walmart and Target have warned the White House that American families are likely to encounter empty shelves and higher prices. It could echo the pandemic supply shock, with the CEO of Florida toy maker Basic Fun saying, "We're paralyzed." Vinny Del Giudice, Bloomberg Radio.
Wells Fargo says the Consumer Financial Protection Bureau has terminated a consent order dating back to 2018 relating to the bank's compliance risk management program. It is the 6th since the order ended this year. Right now, Wells Fargo down 0.5%. Recapping, the Dow little changed on the day, up 1 point. S&P down now by 0.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Matt Miller sitting in for Alex Steele. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's check in with our next guest, Mark Daly, Head of Innovation and Tech for Bloomberg BNEF. This is usually a spot for Alex, because Alex likes to talk about energy, old energy, new energy. She doesn't care as long as it's tech related, but I'll try to make do here. Hey, Mark, I know you kind of want to talk kind of like about the funding activity in the climate tech space. Has the funding around just new energy, whether it's technology or not, has that changed in the last 3 or 4 months? Have you sensed any different change? Because I think we have an administration that views the evolution to, or the transition to newer, greener technologies, maybe not with the same support that some other administrations have. Have you felt that in the funding area?
Yeah, so my job at BNF is I track equity funding, so it's companies that are raising money. Asset investment, we still continuing to grow, so capital investment in things like solar panels and the farms that are actually producing renewable energy, that's still going up. The equity funding environment has actually been on the decline for 3 or 4 years, so it's not something that's kind of been on the same upward trajectory. And that's not because it's necessarily people expect solar panels to stop being invested in, or things like lithium-ion batteries. It's just interest rates went up a few years ago, and that kind of crushed the equity capital market across the spectrum, even in things like climate or new energy that might have been on the up overall. The last year, I'd say there's been a bit of a divergence. 2021 was kind of peak interest in startups for climate in the last 5 to 10 years. And the hype has now kind of moved on, and artificial intelligence is where a lot of the generalist investors are putting their interest. So there are still lots of climate-specific people who are investing in startups. But yeah, definitely in the last few months with the new administration, I would say there's been a noticeable change in terms of what people or how people talk about the things. People don't talk so much about climate tech anymore. They talk about investing in new energy, because everyone's pro-energy and pro-producing lots of new energy. But it's not so much about climate anymore. And we've even seen reports of lots of companies kind of scrubbing mentions of that from their websites in order to be part of that energy storyline rather than climate.
Right. So they changed the way they talk about it. And because of rates, you've seen investment for startups on the decline. But I imagine the current administration sentiment doesn't necessarily affect funding for VC, for startups, because they're not expected to exit for like 5, 7, 10 years, right? So we'll probably be in a completely different administration by that time. Unless Donald Trump, obviously, unless he changes the Constitution and stays as our permanent dictator.
That could be on the table.
Yeah.
I won't comment on that. What I will say is on the whether it's good or bad for VCs right now, I think it's probably not the main driver of activity. I think, to me, there's kind of two groups of new energy technologies. There's things that are working, things like solar, electric vehicles, wind. They kind of have a product market fit. People will build them even without like massive policy support because they produce energy competitively, and people like buy electric cars because they're cost competitive products. There's a different class of new energy technologies, things like carbon capture, hydrogen, the things we need to abate, like harder to abate things like steel or cement manufacturing. They don't really have product market fit yet. They're not cost competitive like solar and wind are. And there's a bit of a divergence in the kind of investing in new energy companies in that there's lots of capital available for things like solar and wind and lithium-ion batteries, electric cars, charging, for things that have business models that work right now. If you're trying to raise capital there and you can prove that your revenue is growing and you have margins, people will be willing to invest. But there's a bit of an issue where a lot of people raised new venture and growth equity funds on the hype of 2021, 2022, but those investors now say, well, lots of that stuff we invested in didn't really work as well as we thought it would. We now have much more stringent requirements in terms of what a startup needs to meet, in terms of KPIs for us to invest again. And so I'd say the biggest issue in the industry right now is there's a huge glut of capital that wants to be deployed, and there's not necessarily enough high-quality companies for that to be deployed into. So yeah, I hear a lot these days about how it's hard for venture investors to raise new funds.
Well, how about if I have a new technology? Where do I go to raise the money? Is the U.S. the place to go? Is Europe? Is Asia? Where? Do I just go to
Has it
Silicon Valley?
shifted?
Yeah.
I would say like the U.S. is the biggest venture market in terms of the entire global economy. China is the biggest kind of supplier of clean tech manufacturing equipment, but actually the U.S. is the biggest market for climate tech startups or energy tech startups, whatever you want to call it now. It's not really a function of it being the best place to be a pro-energy or a pro-climate company. It's the fact that the capital markets are really, really mature. Europe theoretically would be the best place to do this in terms of demand, but actually it's a really, really fractured market. Pension funds can't invest in venture. And so if you're a climate tech startup who really wants to scale, really wants to raise growth equity, you'll probably end up coming to the US.
What are you seeing in terms of, I mean, I imagine exits are paralyzed right now. Certainly there's no IPOs. Are there sales? Are things going as distressed?
So we do actually also track mergers and acquisitions in the space. And we've only recently started doing this for the reason of we're trying to see where all the companies are exiting. IPOs, we're seeing a lot of talk about, particularly in APAC, IPOs this year in big transport companies. Mergers and acquisitions are actually on the rise in the kind of energy space. It's not necessarily what I call startups. It's mostly like massive renewable energy developers being acquired by private equity funds, being acquired by utilities. There's also an enormous amount of activity in the battery metals supply chain. So big lithium miners, big copper miners, they're also being acquired by the big mining conglomerates. And really the reason that these are the sectors that are undergoing these M&A is just because there are natural acquirers in the space. Like a utility will acquire a renewables portfolio, but an automaker is not going to acquire a Tesla. By the time they've kind of de-risked and become a big enough company for an automaker to acquire them, they're already too big for that to happen.
All right, Mark, thanks so much for joining us. Mark Daly, Head of Innovation and Tech at Bloomberg BNEF down there. They're here at, down on one floor down, I think, right below us, fourth floor down there. So have you seen the movie Landman, or the TV show Landman?
I have heard about it.
Okay, you need to watch that, my friend. That's where I get all my
all his misinformation comes from Landman.
Exactly. All I know about the oil and gas business comes from Landman. Same thing, all I know about ranching and cows.
I watched the first couple of episodes, but it was filled with so much untruth that I just couldn't go any further.
But nobody delivers it better than Billy Bob Thornton.
He does a great job. I love his acting.
Pound for pound, the best cursor, I think, in movies.
I love John Hamm in that show, too.
Yeah, he was good. He was good. So anyway, Mark Daly, Head of Innovation and Tech at NEF. Coming up, we've got Michael Hand. We're going to talk about the restaurant business. Is that where they could see some tough times, both in terms of their costs and as well as consumer demand? So that's coming up in just a moment. This is Bloomberg. Good morning.
is Bloomberg Intelligence with Paul Sweeney and Alex Steele on Bloomberg Radio.
All right, Matt Miller sitting in for Alex Steele doing mendable duty here today for this hour. We appreciate that. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. We always like talking to our next guest because A, he covers cool companies, and B, I think his companies give us a good read on how the consumer's doing. That's Michael Halen, Senior Restaurant and Food Service Analyst. People got to eat, right? For Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio. It's in his contract. He has to be in New York at least one day a month, and that's kind of what he does here. So, hey, Mike, I think about the restaurant business, a great view onto the consumer here. What are you seeing? What's the data showing you? What are the companies telling you about how they view the consumer here in a world that's got a lot of uncertainty?
Yeah, what I like to say is restaurants are the canary in the coal mine. Usually we lead consumer discretionary spending lower. But restaurants really felt most of the pain last year. Last year was a terrible year for dining, especially full-service dining, down significantly. In my view, for full-service, it was a restaurant recession.
What caused that?
It was low-income consumers primarily, but consumers pushing back against all of the price hikes that they've dealt with since 2020, right?
Yeah, it's very expensive and terribly unhealthy, right? Compared to buying your own Whole Foods and then cooking your own dinner. Something Paul never does.
No, not anymore.
So which ones are, I'm looking at your universe of coverage, right? So you have the burger joints, like the giant ones from McDonald's, to the smaller ones like Shake Shack. You also have Paul's very favorite chain of all time, Cracker Barrel.
There Saturday.
And you've got those, those other, like you said, full service, right? Texas Roadhouse. So you really span the gamut. Which ones are doing the best out of the ones that you cover?
So right now, believe it or not, it's casual dining. A lot of
What's casual dining? That's
so
Roadhouse.
casual dining is Texas Roadhouse. Okay. Chili's is really elevating all of the numbers because they did a 30% comp last quarter. Wow. They've been absolutely crushing
Everyone's going to Chili's?
Everyone's going to Chili's. They're absolutely crushing it. Yeah. And it's been a great turnaround there. And they're all lapping really weak results from last year, and that's kind of helping them. Quick service has more exposure to low-income consumers. They're also lapping stronger results in the first 4 or 5 months of last year, which is kind of hurting their results right now. The names that we like, though, Shake Shack, Cracker Barrel, and we expect Starbucks to really start to gain some momentum here. And it's all
That's weird. Every Starbucks near this office has shut down. Right? There used to be one in this building. They closed that. There was one across the street. Closed that one.
Those are two small, dumpy things.
Also, we're in Midtown. Who's in Midtown, right? Yeah, exactly. Everybody's working from home, right? So they put them all in the suburbs.
And that's a problem, yeah. And poor site selection will hurt when you're opening stores right across the street from each other.
And when you got in a building that's got 5,000 different types of coffee given away free to everybody. So in the restaurant business, if I'm seeing maybe some of my costs going up because of tariffs, you can quantify that for us. Maybe some of my demand waning because the economy's slowing and we might go into a recession and inflation and all that kind of stuff. And maybe I can't get my busboy and my dishwasher because they're not coming into the country anymore. What are these companies telling you about these potential headwinds here?
Well, this is going to be an interesting earnings season. So we have data right now in April that's not that bad. Quick service is about flat. Maybe up a couple of percent for full service in the first 3 weeks of April. So I'm not hitting the panic button just yet. Gotcha. Our P&Ls aren't going to be impacted that much by tariffs. Chipotle's talking about 50 basis points higher costs due to avocados and some paper products. But Domino's doesn't really have much impact exposure. Most of the food items are being sourced domestically by our restaurant chains. And so the P&L is not going to get hit, which is good. All of our companies are saying, we're on E-Verify and all of our employees are legal. So now we're not really worried about the immigration as much. Obviously, it could force labor prices higher, but this is an environment they're used to dealing with. It's been 4 or 5% labor inflation for as long as I can remember. And so I don't think they're positioned that badly. I'm not ready to hit the panic button. I think You know, people still have to eat. People are still employed. People are going to work. They're strapped for time, right?
And they're broken up in terms of, for example, when I think of Yum Brands, I don't know why I think of big Chinese business, but I feel like, did they separate that? So do they have Yum for China and then a Yum that focuses on us? They do what? Pizza Hut. They do Kentucky Fried Chicken. They have, what else do they have? Taco Bell?
Yeah.
Yeah.
And so Yum is, they're a massive franchised system. So Yum China is their franchise business in China. So it's nice running a franchise business because you're not exposed to the higher costs of food and labor, right? It's Yum China that actually has to foot the bill for whatever higher costs they're going to experience through tariffs or through higher labor and stuff like that.
What's your favorite place to eat? Of all the companies you cover, Shake Shack, McDonald's, Yum, Chipotle, Jack in the Box, Cheesecake Factory, Starbucks, Wingstop.
I didn't know Jack in the Box was still...
What's your favorite one, Michael?
To actually eat at?
Yeah.
Oh, man. That's a good question. I don't know.
You've never thought about this?
I mean...
you have a coverage universe of fast food restaurants.
I'm a little bougie, though. You know, I'm like, I might have to say, I don't know, it would have to be one of the steak places. I mean, I love a good Ruth's Chris steak, which is owned by Darden right now. So, I mean, that might be it. Texas Roadhouse is great.
Yeah. All right, Mike. Great stuff as always. Michael Halen, Senior Restaurant Food Service Analyst for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker Studio. Matt Miller, thank you for sitting in.
Pleasure.
For Alex Steele. I hope she shall be back tomorrow. Looking at the markets, we got a little red on the screen. Balance of Power with Joe Matthew is next after this global news update.
This is CBS News on the Hour, sponsored by Progressive Insurance. I'm Steve Kathan. Proclaiming success at the southern border, the White House says President Trump will sign 2 executive orders today to back up his immigration crackdown.
The first one is aimed at strengthening immigration enforcement.
To pursue criminals and protect innocent citizens.
White House Press Secretary Caroline Leavitt.
The second EO is centered around protecting American communities from criminal aliens.
She says it will direct the Attorney General and Homeland Security Secretary to publish a list of sanctuary cities the administration says obstruct the enforcement of federal immigration laws. Stacey Lynn, CBS News, the White House.
The Kremlin's announced a 3-day ceasefire next month in Ukraine to coincide with Moscow's World War II commemorations. Ukraine's foreign minister, who has sought a 30-day ceasefire, says, why wait? CBS's Charlie D'Agata at the Pentagon.
This will be a welcome development if it is to hold, because it was only a couple of weeks ago, Easter time, that both sides had announced a sort of 24-hour ceasefire in order to mark Easter. Hundreds of violations on both sides.
The Vatican has closed the Sistine Chapel and says the conclave to select the next pope will begin 1 week from Wednesday. CBS News contributor Delia Gallagher in Rome says that leaves a lot of time for discussions ahead of time.
They don't have to go into seclusion, as it were, until that day. They will have up until then to talk to each other in dinners and informal meetings, and that's really important for them because they have to get together to get a 2/3 majority.
It's Election Day in Canada, and what's being done and what has been said in the U.S. is a key factor. Asa McKercher is a public policy analyst in Canada.
It's an election, as Liberal leaders, really been framed against the threat of Donald Trump, the trade war launched by your president, and his comments about turning Canada to 51st state and erasing the border between our countries. And that threat has really galvanized support behind Mark Carney. We've seen a sort of historic shift in support for the Liberal government, which had, under previous Prime Minister Justin Trudeau, had sunk to really like 18% popularity in the polls.
On the weather map, CBS News meteorologist David Parkinson says parts of Minnesota, Iowa, and Wisconsin are in line for potentially nasty storms today.
4 out of 5 on the severe weather index, meaning it is likely that we will see several tornadoes. They could be long track, they could be EF2 or stronger. So the potential is there for a really pretty serious tornadic outbreak during the afternoon and evening hours.
And checking Wall Street, the Dow is down 98 points. This is CBS News. From the suburbs back to the big city for an NFL franchise.
D.C. Mayor Muriel Bowser said the city and the Washington Commanders have reached an agreement to build a new stadium on the site of RFK Stadium, which is being demolished in a process that could take 2 years. She posted a video narrated by team legend Joe Theismann.
The time is now. Let's bring Washington back to D.C.
The team's much-maligned current home in nearby Landover, Maryland, is widely considered one of the worst stadiums in the league. Washington has played there since 1997. Christopher Cruz, CBS News, Washington.
A trial in Paris has started over the 2016 heist that saw armed robbers tie up Kim Kardashian in her bedroom and steal millions of dollars worth of jewelry. 10 people are charged with robbery and kidnapping. 2 have acknowledged their participation. Kardashian's lawyers say she will testify in person. Steve Kathan, CBS News.
From the world of politics to the world of business, this is Balance of Power. Live from Washington, D.C.
It's the Monday edition. Lawmakers coming back to Washington from recess just as the White House begins celebrating the first 100 days milestone. Why wait? Ever more questions about trade and tariffs. The backdrop of our conversations today as we're joined by Bloomberg Politics editor Laura Davison with new polling straight from Cliff Young at Ipsos, and we'll have analysis from our political panel. Bloomberg Politics contributors Jeannie Shanzano and Rick Davis are with us as we balance both ends of Pennsylvania Avenue on a Monday in Washington. We start, as always, on Wall Street, on the fastest show in politics with Charlie Pellet in New York. His check on the markets. Charlie, where are we?
Indeed, I got you covered. We are at the lows of the day right now with the Dow, the S&P, NASDAQ, all in the red right now. Investors bracing for a deluge of corporate earnings and key economic data sending stocks lower. S&P right now down 44. That is a drop of 0.8%. Dow Industrials down 121, a decline now of 0.3%. NASDAQ now down by 211 points, down 1.2%, and the NASDAQ 100 index also down by 1.2%. The 10-year, 4.23%. The 2-year, 3.70%. Gold up 0.3%, higher by $10 the ounce, $33.30. And West Texas Intermediate crude down 1.8%, $61.86 for a barrel of WTI. As for Washington, tariffs and the market recovery, Abby Yoder is U.S. equity strategist at J.P. Morgan Chase.
Obviously, time is ticking in terms of how long this uncertainty persists. And, you know, the president heard this from some companies last week when he met with them saying, like, look, this is a matter of weeks in terms of empty shelves. And that is very important, right? Like, the longer this goes on, the more uncertain the uncertainty pervades, the less likely, you know, the upside becomes a reality.
Abby Yoder of J.P. Morgan Chase. IBM plans to invest $150 billion in the U.S. over the next 5 years, including funds for research and development and manufacturing, mainframe and quantum computers. IBM shares on a down day for the rest of the market, up now by 0.1%. Recapping, stocks are lower with the S&P down 0.8. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, good to see you, my friend, and thank you for being with us here on the Monday edition of Balance of Power on Bloomberg Radio, on the satellite radio channel 121, and on YouTube. If you dare see us in the studio, search Bloomberg Business News Live. You'll catch our live stream that goes through the day from New York to D.C. Yeah, Monday edition. We could call it the hangover edition here in Washington, D.C., coming off the weekend no one was supposed to talk about. The White House Correspondents' Dinner and all the parties and trappings that surround it, not including the President of the United States. And I mention this because it was not lost on me. When the pool call time dropped for this morning at the White House and the press secretary, Caroline Leavitt, calls a news conference, the White House press briefing at 8:30 in the morning, knowing that people might be peeking out of one eye. But I'll tell you what, it was a full room. She showed up with Tim Homan, the border czar, to start what is essentially a rolling celebration of the first 100 days, right? We're almost there, and he's going to be speaking tomorrow night. Big rally in Michigan to mark the occasion. Immigration is the narrative, if you will, or the story that's certainly being pushed by the White House, starting before the opening bell. Here's the press secretary from a short time ago.
We're working around the clock. The trade team is working all day. I was on the phone late last night with Secretary Lutnick. I was on the phone this weekend as well with Secretary Bessent. I mean, the entire team is working 24/7 to get these trade deals done. And I think you'll be hearing more about them this week. I don't want to get ahead of the trade team or the president in announcing potential deals, but certainly I can assure the American public that this administration is full speed ahead.
Did she say trade deals? I thought we were talking immigration today. Tom Homan certainly was. Mass deportations, part of the president's first 100-day agenda. Trade deals, not so much. This is going to take a lot more than 100 days. We did see the Treasury Secretary making interviews, making the rounds this morning, talking about progress, but making it very clear that we don't even have a framework, not even with our nearest Asian partners, never mind the likes of China. So we have huge questions going into the second 100 days with Laura Davison, Bloomberg Politics editor, with me here at the desk. Great to see you. You're back to reality here, trying to cover now both ends of Pennsylvania Avenue. I will add, lawmakers are returning following recess. But let's start at the White House. What is there to celebrate for this president? He's going to talk, I'm sure, about the border, and we did hear Tim Homan talk about the most secure border in American history this morning. But then we turn right to trade deals and ever more questions about this tariff policy.
The White House clearly is very worried about where they are on trade deals. They have, 70-some days, a little less, until those July deadlines when the 90-day pause ends. Yeah. And they're talking a lot, but there has been no evidence that's come out that these deals are actually progressing. Really what's been established so far is sort of, agreements to keep talking. But there's a lot of really thorny issues that they have to get agreements with 60-some countries on, in order to stave off all these tariffs. And so there's a lot of concern that they need to show some progress, even if there is not progress being made.
So is that what's happening? And at some point we have maybe an announcement with South Korea or Japan on a framework. This idea of China being in regular talks, though, and China says it's not talking to the White House. We ended last week with this narrative. We're starting this week with the same one. Who do we believe, and what's Beijing doing here?
Well, and, as we saw last week, Trump, repeatedly said that, the U.S. and China were talking, and China said, whoa, we're not having any talks. Right. There's still that complete disconnect there. And so there's, a couple different pressure points that they're feeling. One, markets continue to not perform particularly well. You also have members of Congress starting to get squirrely about this and say, look, if we don't see some significant progress from the administration, Congress may exert a little bit more authority. Plus, you also see a series of polls that came out over the past couple of days that show really, really bad news for Trump on his handling of the economy. There was an NBC poll, only 39% of people approve on his handling of the economy. Another poll showing 39% approval on the tariff plan specifically. So these are broadly unpopular stats for what was supposed to be Trump's signature issue of lowering prices and making people feel better about the economic outlook.
As usual, you put your finger right on it. We're going to be talking with Cliff Young from Ipsos a little bit later on this hour, with numbers suggesting exactly what you're saying. And specifically on immigration, to find this president underwater on the issue that really, you could argue, carried him into the White House, and one that has gone better than maybe most of his goals in the first 100 days, tells us what about the political reality of this administration?
It really shows, and then there's a new poll out also from the New York Times this morning showing that just Trump has gone too far on, that people wanted to see, a more secure border. They wanted to see, really a clampdown on illegal immigration. But hearing stories of American citizens being deported, American green card holders being deported, some of the sights and sounds from the prison down in El Salvador and just the brutal conditions. Also realizing, too, that people that they know and are in their community are being affected is really starting to give people pause of maybe that the administration is doing too much too quickly without a regard for sort of the immigration laws and processes that are in place. Yeah.
Taking a look at the guidance, the schedule from the White House today, the president's having lunch with J.D. Vance, and then we'll later speak with the Speaker of the House. They're coming back, and I know as a creature of Capitol Hill in a former life, this is always a fun time for you. What are we in for in a meeting like this, walking into actual markups of this legislation? This is, of course, the reconciliation package that includes the Trump tax cuts and a lot of other big initiatives that he'll be judged on once again.
So what you're seeing right here is Congress and the White House sort of trying to build the tax cut plane as they're trying to fly it. So they are starting to roll out pieces of this reconciliation bill. Largely, these are sort of the smaller pieces, the less controversial. What they have not decided in is what is in the tax portion. That'll go to the Ways and Means Committee to get marked up, as well as what are the healthcare spending cuts that they're going to pursue. There's a big division, particularly between the House and Senate, of do they cut Medicaid? If so, how much? All of that has to be decided, and that's what we'll see play out in a series of meetings. Trump and House Speaker Johnson are scheduled to meet around 2 o'clock today, and then later in the afternoon, Bessent and Kevin Hassett will go to the Capitol Hill to meet with congressional leaders. They have to make a bunch of tough decisions that are not going to be easy with the majorities they have, and they want to do it in the next 3 to 4 weeks.
Yeah, I know you were a tax reporter at one point. You have a green visor stashed away somewhere. Tell us what's real, because we're hearing about extending or making permanent the Trump tax cuts, no tax on tips, no tax on overtime. SALT is in there somewhere. We're also hearing from this White House that you can't touch Medicaid. So is this all a massive multi-trillion-dollar deficit spending plan in the end? How do they pay for it?
Yeah, basically this will be add a lot to the deficit. They're doing some budget accounting gimmicks that will essentially mean that the extension of the Trump first-term tax cuts won't be registered.
This is the baseline.
That's the baseline thing, but that'll still add, in real terms, about $4 trillion to the deficit over the course of the decade.
How do those two coexist, by the way? What's the rule that we're using?
Budget accounting is fake, funny math, but that's sort of the real economic cost. So what to look for here is there's sort of a handful of things that will be in the bill. One, this extension of the first-term cuts. That's the vast majority of the tax cut package, which is important to remember because, CEOs, Republicans on the Hill are pointing to, this is going to be a big new tax cut that will really boost the economy. Most of what it'll be is just extending what people already have.
Yes.
Then there'll be a couple little things thrown in, and that SALT is a high priority item. No tax on tips is a high priority item. Maybe they fit a couple more of those things of, deductibility for car loans or no tax on overtime, but they're not going to be able to do a whole lot more there. It's going to be a little bit to juice the economy, but it's not going to have a big sweeping effect.
Debt limit is its own issue. It may, in fact, be folded into this, but we're going to get an X date potentially this week, right, or an updated X date. How is that going to impact the conversation around tax cuts and the rest of it? Will this all be, as the president says, one big beautiful bill? Or do they have to get to the debt ceiling on its own?
It really will depend what Treasury says either later this week or next week. They've signaled they'll come out with the X date, and their estimate is the one that matters. We have other groups, CBO and others weighing in, but this Treasury date will tell us, do they have until August or September, as previous estimates have indicated, or do they only have until June or July? If it's the latter, if it's earlier than people are thinking, they may have to separate the debt ceiling
everything and start
from
working
the
on
tax.
that,
Yes,
right?
and then they're going to have to negotiate with Democrats on the debt ceiling, which makes it even more complicated. It will delay the tax piece. So Republicans are really, really hoping that this date is somewhere in August or September. That way they can get the tax package done, move the debt ceiling with it, and then go home for their August recess.
Laura Davison always tees up the next question. It's a remarkable talent that you have, because I wanted to ask you if Democrats are going to play along. Where's Hakeem Jeffries on the debt limit? They got to get something for this, right?
If Democrats are able to get in here, this will give them incredible leverage. This is sort of the one leverage point that they'll have.
So they want an early X date.
They would love it, because in the House they could still probably pass this. They may, depending on how the Freedom Caucus is playing along, they may even need Democratic votes in the House. But certainly in the Senate, they'll probably need 10 to 15 Democrats to come on to vote for this. So this is where Democrats are starting to scheme of what can you ask for that is a big enough win, but not too big that it blows up the entire negotiation. That's the conversation that Jeffries and Schumer and everyone are having right now.
Fascinating conversation as always. We cover the waterfront with Laura Davison, our politics editor. That's why she's running things here in the newsroom. Great to see you. You survived the weekend. We'll do it again in another year. I'm Joe Matthew in Washington. We're going to get to these polling numbers that we're talking about here. Cliff Young from Ipsos with us on the administration's first 100 days and Elon Musk. It's coming up next on Bloomberg.
12:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index has halted a 4-day advance led by losses in big tech. Of course, this week we will be hearing from a number of Mag 7 names, including Apple, Microsoft, Amazon, and Meta. Right now, the S&P is down 42, a drop of 0.8%. The Dow lower by 109, down 0.3, while NASDAQ is down 221, a drop there of 2.3%. The 10-year, 4.23%, with the 2-year currently yielding 3.71%. Gold is up 0.4%, 33.32 the ounce. West Texas Intermediate crude down 1.9%, 61.81 a barrel on WTI. Bitcoin lower by $800 at 93,500, down 0.8%. And West right now we do have the S&P, as I mentioned, trading lower by 0.8%, 44.96. Down 44 points right now on the S&P 500 index. Airbus has agreed to take over some assets and sales from Spirit Aerosystems, clearing the way for the struggling American aerospace supplier to be acquired back by its former parent, Boeing. Shares of Airbus, the ADRs, up 2.3%. Boeing higher now by 2.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. And Balance of Power continues right now. Back we go to Washington. Once again, your host, Joe Matthew.
All right, Charlie Pellet with a Wall Street kind of subdued on this Monday, a little like Washington, as the White House turns the knife on a group of very sleepy, I'll say hungover journalists from a White House Correspondents' Dinner weekend with an 8:30 a.m. press briefing at the White House. And guess what? We're doing it again tomorrow, says Caroline Leavitt. Yeah, Scott Bessent will be the guest of honor tomorrow morning, 8:30, as they throw the 100-day party at the White House. And that's coming with, as you typically would see, a series of high-profile interviews, big events. Donald Trump's going to be in Michigan tomorrow night doing a campaign-style rally. Can't imagine how late that's going to go, but we'll have it for you here on Bloomberg. Time Magazine had the big interview last Friday. Today, the Atlantic interview dropped. Fascinating to read through these. The quote that jumps off the page from the Atlantic. Think about this, 100 days in. The first time Donald Trump said, I had two things to do: run the country and survive. I had all these crooked guys, he told the Atlantic. Going on to say, quote, the second time, I run the country and the world. That's a direct quote. Remembering, of course, run the world. We're still waiting to hear on reciprocal tariffs, the 90-day review period that'll last until July, and the market's apparently going to be guessing until then, with references to trade deals that we have not seen emerge yet in a series of negotiations that we're told are underway, but governments from Beijing and beyond tell us that they're not even in touch with the White House. So a lot of questions that we're asking on this Monday, that we were asking on Friday, and will likely still be in the second 100 days. Flurry of polls over the weekend, and I'll tell you what, they've been busy at Ipsos because we've talked about them from last week, with another new batch of numbers coming out today. Really interesting to see the approval rating here, and then specific ratings on issues that are so close to this White House, that are dear to the president, from immigration to the economy. And we have a great opportunity to unpack some of these numbers with Cliff Young, the president of Ipsos Public Affairs, a good friend of the broadcast. And it's been some time, Cliff. It's not a campaign season, but it's nice to see you. I hope you're doing well.
It's great to be here on this lazy Monday.
It does feel kind of like that,
yeah,
right?
Where is everyone?
Take your time, put your elbows up on the barrel. I don't know.
Exactly.
They're apparently waiting for tomorrow's press briefing. I want to start with approval ratings. We saw one as low as 39. I think you came in at 42 at Ipsos on your most recent round here, or your aggregate. What does that tell us about this president at this point in time? Because the superlatives have been flying. We haven't seen an approval rating this low, this early, in 100 years or something. What's the truth here?
Well, Trump has always been lower than the historic average. We live in highly polarized times. He's a highly polarized individual. So I think that's less telling. Okay. And what's more telling is the decline. It is normal for any administration to lose creds, to lose some people as they make decisions.
Honeymoon ending.
Honeymoon ending, exactly. The historic average over the last 70 years is a 3-point decline.
Okay.
Trump is at 6 points. And so he's outstripping the average. by about twofold or so. What does that mean specifically? We have to wait and see, obviously, but I would characterize it with one word: friction. There's friction around the edges. It doesn't matter what the policy area is, but the administration is bumping up against public opinion.
Including immigration, which jumped off the page for a lot of people and made some waves when you released that poll last week. This is supposed to be the winning issue right now as he grapples with the economy. Tom Homan this morning said, most secure border in history. We're hearing reports of mass deportations. Everybody knows what's happening in El Salvador. He says, this is what I ran on. Promises kept, promises delivered. And what did you find?
Well, it is his bailiwick. He won in 2016 on immigration. He mobilized and fortified himself in 2020 and 2024 on immigration. And indeed, it's a signature issue. And if you look at the polling, a vast majority, super majority of Americans agree, yeah, we should deport illegals who are criminals. Okay? But what is happening, actually? They disagree about how it's being done. It's not fair to spirit away someone in the middle of the night. There's a need for due process. So ultimately what we're saying, and once again I go back to my concept of friction, we're seeing a lot of friction relative to this issue, and Americans ultimately saying, I agree in principle with what the administration wants to do, but they're not being fair.
That would also suggest an opportunity to improve perception if the process changed. Is that fair to say?
I think that's fair to say.
The end game is popular, to your point.
Yeah, this doesn't mean he can't improve again. Right. That is, he gains back those 3 additional decline points of decline, let's say. Yes, that's true. So if they modify the way they go about operationalizing policy, indeed, maybe Americans or some Americans go, okay, so like they've changed their tack a bit. They're more fundamentally fair when they're dealing with illegal immigrants. I can get behind them. Yeah. But right now, that's not happening.
The economy is another big one and helped to bring Donald Trump back to the White House. It had so much to do with prices and inflation. And now we're watching prices in many cases rise. We're seeing consumers anticipate further increases. How much of this has to do with tariffs versus everything else?
Well, there's a general sort of noise quotient.
Yeah.
And we've done a lot of focus groups and talked to Americans, talked to consumers, and this generalized sort of uncertainty is not good, right? But really what's driving the dissatisfaction is the anticipation, as you said, of tariffs and more specifically inflation. You already have households going, you know what? I might not travel in the summer with my family. Right. Maybe I should buy a few more rolls of toilet paper just to kind of stock up before things get really bad. And so you already have anticipatory behavior in regards to tariffs and inflation.
I thought we were supposed to be buying wine. Are we buying toilet paper again? That's actually something that you know a lot about going back to the pandemic, the sort of human behavior that kicks in when you see something coming. But that sounds entirely emotional, doesn't it? If prices aren't actually rising and we're making judgments on leadership based on what we think is going to happen, is that a new realm? How do you measure that?
Well, I mean, we do it. We measure it by past behaviors, right?
Okay.
But yeah, we're in a realm, we're in a moment now that's unprecedented in some ways. Like, how do you model that behavior? It's very rare, especially in the American context, to have a leader. Yeah. The leader of the nation making decisions that potentially will affect directly the economy in the near future.
Yeah. And people see it in real time, Cliff. In about 2 minutes, producer James is going to call me and tell me that we're ending this interview because we're going live to the White House for something. Please don't do that, James. I'm enjoying this conversation, but I'm saying that because this is every other day around here. Okay, note, he's coming out now, he's in the Oval, and then the president will talk for 45 minutes. You look up the wall, all the networks take it. What kind of an impact does that have on people who are making decisions in real time or getting a phone call from somebody like you?
Yeah, uneasiness, right? Once again, it doesn't seriously impact behavior, but it impacts it around the margins, and that's what we're seeing today. As I said, Americans are uneasy, there's trepidation, and once again, specifically they worry about inflation.
Case in point, the title of this deck of polling data that you gave us. This is what people see when they hire Cliff to come in and talk to them about what's going on. It's actually called, What the Heck is Going On? That's knowing the new America, what the heck is going on should tell us a lot about where we are as well. Does this not reflect the conversations you're having with people every day?
Yeah, our clients are actually asking what the heck is going on.
What do you tell them? You send
and
them
I
the
just
deck.
emphasize we have a political actor that's butting up against a convention, and when you butt up seriously against convention, that creates friction and unease in humans, right? And that's what we're seeing today specifically. That's fascinating. We're seeing households changing their behavior, anticipating potential problems, and now we're starting to see it affect him politically with his approval ratings.
You're really getting to the Trump brand in a way, though, aren't you? Right? Has any other president occupied that space?
Yeah, no. You typically don't have, once again, a president or political actor bumping up against the extremes, testing the boundaries, right? That is not normal behavior. And that's why, in general, Americans are at unease.
It's also why his supporters love him, because they want somebody to come here and break it, as they say.
Yeah, that's part of brand Trump, to be irreverent and sort of go against the system and break the system. Yes, it is broken. You have to break it down to build it up again.
But he's found a line, hasn't he, on the number of people who look at the world that way?
Yeah, he has his base, which still supports him, by the way. It's important to emphasize that point. While he's weakening on the margins, his base, that is Republicans, still support him. But we will see, especially when it comes to the economy, if there's inflation, that will erode as well.
You wonder, and I ask this question frequently, what happens when we consider the second 100 days, the cadence? Do we still have this news cycle that we're living in now? Do we do the weave every day? Because these are the things that you're suggesting are adding to consumer anxiety.
Yeah, but first, we don't have a crystal ball. We don't know.
Sure.
But I do believe
Does it start to wear off if that is the case?
No,
Do people start to get numb to that, or
they get used to it, right? There's part of that. I also think that Trump is a very savvy political actor. He sees what's happening with all the metrics out there, not just approval ratings. And obviously we will see, but I would expect some sort of pullback a bit from the edges.
Interesting. Do you continue doing polling, doing sampling like this straight through an administration? A lot of people associate you with the campaign. We had a normal great dive with you throughout the 24 campaign. What's Cliff Young doing now? How does Ipsos continue during a new administration?
We keep on going.
Yeah.
Because we have clients and stakeholders and people like you that want to know what's going on.
Is it different than an election cycle sort of cadence? How do you keep these polls rolling?
We're in the field every week.
Every week.
We probably have 2 to 4 polls on different issues every week. Yeah. Because we have a lot of clients, a lot of stakeholders that want to know what's going on.
Absolutely. So the second 100 days you'll be out there. Whether the cadence stays the same, we'll find out together. But that approval rating, technically underwater now, could be moving throughout the next couple of weeks here. Would trade deals be the salve that lifts all of this?
Well, I think that meaning trade deals implemented, tariffs implemented, right?
Actual deals, yes.
Yeah.
Maybe tariffs going away.
It'll all be about inflation ultimately. I think right now we're seeing a lot of noise and public opinion reacting to the noise, but in the longer term it'll be about whether there is effectively actually inflation.
It's great to see you. Cliff Young, what the heck is going on? That's who we ask. And a little bit of a better sense now of at least what voters are thinking about it. Find a lot more at Ipsos. I'm Joe Matthew in Washington. We'll assemble our panel coming up next. Jeannie Shanzano and Rick Davis are on the way in on Bloomberg.
12:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks very much in the red, giving up earlier gains. The Dow, the S&P, NASDAQ all declining. Shares of big technology firms leading losses ahead of crucial corporate earnings later in the week. Among some of those names, Apple, Meta Platforms, Amazon, Microsoft, they're all down today. The S&P is slumping 41 points now, back at 54.83, down by 0.8%. Dow Industrials down 120, down 0.3, while the NASDAQ Composite Index is down now by 1.2%. The 10-year yield, 4.22%, with the 2-year currently yielding 3.69%. Gold is advancing $17 the ounce. Spot gold up 0.5%, 33.37 the ounce on gold, while West Texas Intermediate crude is down 2.2%, 61.61 for a barrel of WTI. This week's economic indicator features April's employment report and data on first quarter economic growth. And with a look ahead, here's Bloomberg's Vinny Del Giudice.
Bloomberg Economics says White House tariffs will probably have an adverse effect on employment in transport and logistics, leisure, and hospitality. Another negative, the impact of federal job cuts on civil servants and contractors. That said, we could see April gains in construction employment bolstered by good weather and Biden-era infrastructure projects. Meantime, forecasts point to weakness in first quarter GDP, illustrating the impact of White House trade policy. We'll get GDP Wednesday and the jobs data Friday. Vinny Del Giudice, Bloomberg Radio.
Tesla shares now down by 3%. It is raising prices in Canada and encouraging buyers to snap up cars imported before counter tariffs were imposed on American-made vehicles. Tesla shares down by 3%. And the Japanese construction and mining equipment maker Komatsu says it may raise prices in the U.S. in response to tariffs, with the company projecting a 27% drop in operating profit this fiscal year because of the levies and stronger yen. Komatsu ADRs, they are advancing by 2.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. And back we go to Washington. This Balance of Power continues. Once again, your host, here he is, Joe Matthew.
All right, Charlie, thank you so much. You know, the president's got the Eagles at the White House today, too, not the band, the Philadelphia Eagles. This is a busy day at the White House. Everybody's back. The Speaker of the House will be there to meet with the big boss in about an hour and 15 minutes if they stay on schedule, because lawmakers are coming back today. And we're going to be talking a lot more about that in our second hour of Balance of Power, with reconciliation, right? Extending the Trump tax cuts, maybe even dealing with the debt limit all at once, the next charge for Republicans on Capitol Hill, unless, of course, the X date that we expect maybe we're going to get this week, if not next. The X date could move the line on this dramatically in a way that they have to deal with that separately and maybe cut a deal with Democrats. That could be some of the high drama coming in the next couple of months. Not that we can discount the drama of the first 100 days. After he spends time with the Speaker, President Trump will participate in a visit with the 2025 Super Bowl champions. Then we'll sign some executive orders today, we're told, focused on restoring law and order and securing the homeland. This after the press secretary opened up the shop at 8:30 this morning with a very early press briefing. Tim Homan looming large, talking immigration. And all of this has to do with wrapping and packaging the first 100 days into something that Donald Trump can celebrate tomorrow night in Michigan. He's got a big rally planned. And as we've been telling you here, we've got some new polling data out that kind of tells a different story on the first 100 days and expresses great concern that people have about rising prices and even the way that immigration is being handled. We just had numbers from Cliff Young here in studio that pointed us in that direction at Ipsos. But the interviews are also flying as the White House tries to control the narrative. We had the big Time magazine interview, big close-up. Did you see the close-up on the cover? Now, today we get the Atlantic, of course, not the president's most favorite publication, and a fascinating story that came from the writers of this column, including the man who was on the Signal chat. Like, how this ended up happening is amazing. How they landed the interview at 10:45 Saturday morning in late March. They say they called him on his cell phone. This includes Ashley Parker, who has the byline on the story. Don't ask how he got the number. All we can say is the White House staff have imperfect control over Trump's personal communication devices. They got his cell phone. president was at Bedminster. The number that flashed on his screen was an unfamiliar one, they write. But he answered anyway. Who's calling, he asked. Amazing. We assemble our political panel, also surviving White House Correspondents' Dinner weekend here in Washington. Bloomberg Politics contributors Rick Davis and Jeannie Shanzano are with us. He is our Republican strategist and partner at Stone Court Capital. Jeannie, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress. Great to see you both here. We've got a lot of reading to do because these are pretty lengthy interviews here. But Jeannie, I wonder your thought on the way the White House is getting to this, the communications strategy and optics effort here to prop up the president on day 100. What he told The Atlantic in this interview, I mentioned this a bit earlier. The first time, referring to his first term, I had two things to do, run the country and survive. The second time, I run the country and the world. What does that tell us about his view on things? Because that doesn't sound like a man too worried about polls today.
It is quite a quote. First of all, Joe, do you think that they held that 8:30 press conference today just to get at the press after all their celebrations?
Of course they did. Yes.
That was that was actually very funny for me who didn't have to be there. It is quite a quote. First of all, I give Donald Trump credit for sitting down with journalists, even those that he has said publicly. And in the case of both of these reporters and Jeffrey Gold.